my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby, and twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, but I don't wanna jinx it, baby. Let's not get ahead of my time. Oh, but I don't wanna miss you, baby. So I stand up and speak my mind. Oh. Baby, you give me ice and fire. You're channeling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Baby, you give me ice and fire. You're channeling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, oh,
Okay, good morning, ladies and gentlemen. Welcome to the second day of the CEE Sustainable Finance Summit 2023. And as many of you probably already know, the second day is focused on banking. And if you look at the partners of this year's summit, you will notice there's actually quite a few banks, and which I think is understandable given the importance of banks in the transition to more sustainable economy, especially given this region as well. And we actually have a very packed agenda focused on sustainability in banking, what it means exactly, what is the role of banks, and how they can support companies and the region in the transition. So I'm actually really excited for this day personally as well, as someone who really believe in the role and the position of banks in these topics, but also because of all the amazing and inspirational speakers we will hear from today. And the agenda is actually so packed that maybe without any further ado, we can already move to the first keynote of the day to open the discussions and open this topic of sustainability in banking. So if I can very kindly, Munir, ask you to come to the stage. So we will start with a keynote by Munir Nanji, who's the Managing Director of Central Europe, and is Central Europe Head and Ireland Cluster Head and Country Officer for Citibank here in Prague.
Great.
The floor is yours.
Thank you. Well, Dobre rana, good morning. Thank you, moderator. I'm actually very delighted to be here today, to be asked to be the panelist speaker and to be hosting the opening keynote speech for the Banking Day. So before I start, a bit of a disclaimer. I know a lot of you are going to spend the whole week here, and you probably be very sort of in tune with sustainability. My job really means I am very much a practitioner. And so what I thought I would do today is really talk a little bit more about, as a practitioner, how I work with the environment obviously in Central Europe. This week is going to be exciting. We've got two of Citibank speakers. So we have Val Smith, who's Citi's Chief Sustainability Officer globally, will be talking during the week. We have Catherine Mintoff, who's in the back there. She's EMEA's Chief Sustainability Officer. She'll be on a panel. So they are the experts, and they'll speak a lot about what Citi is doing on sustainability and what our goals and commitments are. What I would like to do is, in the time I have, really touch upon some of the key hot topics that are out there in the news. And the reason I want to touch on these hot topics is because I firmly believe that the financial world is very interwoven when we talk about sustainability. And I think if you're aware about what's out there in the macro environment, it helps us reflect back into what's taking place within our sustainable experiences. I'll then talk a little bit about why we're in Central Europe, the opportunities here, which is very exciting. And then I'll talk about the path the CEE is taking towards sustainability. And then finally finish off with the Citi framework on sustainability. So hopefully we have a good conversation. I'm not going to use any slides. And if you need some coffee, I encourage you to have some coffee as well, yeah? So let's start off with the four hot topics that are out there. The first one, which you probably have read in the newspaper today, is the US debt ceiling. Very topical. And, it's sort of a political gridlock right now. And I think it's going to take a lot of brickmanship to get out of the situation we are in. So the clock is ticking, as Janet Yellen has put it as well in the paper today, is June 1st is the X date, where the US has to decide on the increase of the debt ceiling or not. And in the past, the US has been in this situation. So 2011, 2013, very much in the same situation. However, the US has never defaulted on the debt. But in 2011, S&P downgraded the US. So, we did some analysis and we went back to 2011 and said, what happened then? So when that happened, over 10 years ago, you realize the equity market resulted in a lot of volatility, the US dollar weakened, and there was a lot of unrest. So we are in a moment of time where we're sitting at that sort of pinnacle time. And why is it important for us? Well, the US economy, the US dollar is very well interwoven within what we do financially. Commodities are traded in US dollars, reserves are in US dollars, exchange rates are in US dollars, and so on and so forth. But for Europe, it's quite significant because the US is the largest trading partner for Europe. So in the event that the US cannot pay its bills, European companies that are dealing with the US will have to find a way to get their source of funds. So it has ramifications downstream. And if you look at some industries, they're heavily reliant on the US being the biggest market. So this is an important one out there. It's important for us to watch and see, and hopefully we come to some agreement. But as you can see from what we're seeing, the US government's funding rates have gone up over the past couple of days. The next hot topic I want to touch upon is the recent bank failures, which is close to heart. I think it's the banking day today, so you can't run away from not talking about it. A lot of people are concerned about, is there a contagion effect between what happened in the US? Will it spread to Europe? Now, there are a couple of things to put in mind. One is the concentration in Europe is not as significant as it is in the US. If you look at banks like Silicon Valley Bank, First Republic, Signature Bank, and you look at what happened to them, they're very isolated examples. In Europe, the regulations are fairly strong. So, for example, the interest rate risk on the banking book means that all banks have to hedge the interest rate risk. It's very different to what happens in the US. If you look at liquidity ratios and capital ratios, the regulators in Europe have very high requirements. So liquidity coverage ratios in Europe are higher than that they are in the US. If you look at FFCR, higher than Europe than in US. So our ratios are higher, liquidity is stronger, strong capital buffers, so we are in a better position. Now, having said that, one should be aware about where we are coming from. So Europe has been in a negative interest rate zone with euro rates being subdued. They've obviously started increasing in the recent past. But when the rates were low, what happens is financial investors, institutions are looking for yield. So what does yield mean? You take more risk. So is there more risk out there today? And I think this is what I would say is a black swan out there within the European banking sector. The other one, which is evident, is the rise of fintech. If you look at Europe, there's been some amazing banks who've accessed and gone into the fintech space, and it's created a difference between traditional banks and the fintech banks. So can traditional banks now compete with the banks that are in the fintech space? And I think this is one area that I think European banks need to think around their competitive dimension and landscape. The third big issue, hot topic out there, is one that's probably close to all our hearts, is buildings and homes we live in. So we all love real estate, we live in homes, we buy homes, we want to buy homes, etc. There's been a lot of talk in the markets around, is there a real estate bubble and so forth. So let's try and demystify a bit about that. So if you look at the global financial crisis in 28, 29, the large banks in the US had a lot of the mortgage-backed securities. Today, in 2023, there are over 4,000 regional banks in the US that have taken over these assets. So they're spread around the domestic market in the US. In Europe, the systemic issue does not exist. The reason why, European banks, roughly 15 to 17% of their real estate portfolio sits on the balance sheets. In the US, it's over 40%. So there's a very big difference there. The other thing is the way the books are funded. In Europe, institutional investors, so be it the hedge funds, the asset managers, pension funds, they fund the pension, so the mortgage book, unlike the US. So it's quite a diversified portfolio. And also in Europe, a lot of the debt securities are hedged. So the risk is limited. But, I use the word but, the thing to note is the divergence of prices. So we've come out of COVID, and what we're seeing is that real estate prices in the rural areas versus the urban areas, there's a disparity. So it's creating a bit of an inflection in that market. And the other thing to keep in mind is the commercial real estate. So as we move towards green and we move towards more sustainable buildings, European companies that have infrastructure that doesn't meet those standards will have to pay a lot more to become more sustainable when it comes to real estate from a commercial standpoint. So these are the concerns out there within the European kind of real estate market. The last hot topic I want to talk about, and I think I'm glad it's a banking day as well, because my banker friends in the room will relate to, is a term that we've heard about a lot when we look at our capital models, is the weighted average cost of capital, known as WACC. Why do I talk about this? So we issued a paper in the bank towards end of last year. It was quite eye-opening. So weighted average cost of capital within within the world has gone up by has hit the 40-year high. And in Europe itself, year on year, WACC is up by 150 basis points. And the reason is because you've got increased interest rates, we have credit tightening, and this is, besides us talking about inflation, recession, talking about, what's going to happen to the headwinds I mentioned. So cost of capital has really gone up. This is a concern because if you're a company that is highly leveraged and rates are where they are, you're basically servicing debt. So it's quite a risky proposition. And if rates continue to rise, that brings more risk in the environment. The other interesting fact is that this is not across high yield or even companies that are AA rated. This is across all grades of companies and all sectors. And return on invested capital in Europe for about 30% of the companies is lower than weighted average cost of capital. And you can see this in the public markets. If you look at the M&A activity, it's pretty subdued. And one of the reasons for that, we believe, is because investors aren't looking for growth. They're looking for value. And if your weighted average cost of capital is more than your return on invested capital, you're pretty much servicing debt. You're not really investing in the future. So I think this is a concern that I think bankers should have, obviously in terms of stress testing your portfolio and keeping a view of how this is going to be played out. Advice we give our clients is really look at capital ratios, liquidity ratios of your customers, make sure they have liquidity, focus on derivatives to hedge your interest rate risk, and importantly, on a strategy basis, make sure you prioritize how companies are investing. Focus on the key strategies and things that can be pushed out later. It's worth doing because cost of capital is on the rise. So just to summarize, I spoke about 4 key hot topics. We touched on the US debt ceiling. We talked about the banking turmoil. We talked about real estate. And we talked about capital and capital adequacy. Switching gears to a much more positive note now. I want to talk about where we are in Central Europe. So personally, when I think about Central Europe, I've been here for 2 years now, and I've been associated with the region for many years in the past. As a bank and as obviously a person living in Prague, I love being here, and I'll tell you why. I think we are in an amazing part of history, and the reason I say that is because we are living in an environment where we have political stability, unlike many other parts of the world. We are living in a cluster which is very close to markets that require our products and services, next to Germany, Italy, France, etc. And we're located in a very good place. Our economies are growing, which is positive. We're getting FDI into our economies. And lastly, Central Europe has amazingly high quality of skilled manpower, which is very important. Now, what does that mean for business? So firstly I think entrepreneurship is the future of where we go. Entrepreneurship creates the growth we want for future generations. So what's the proxy for that? So one proxy is venture capital. If you look at Central Europe, just last year, $6 billion invested in venture capital. Doesn't sound like a big number, but it's 200% more than it was a couple of years ago. Whereas in Western Europe, it's been decreasing. If you look at startup, 2 billion of that has gone to startups, and startups are the future. So clearly, there's money going into the place that we want it to go to. But let's look at some certain examples. So I was looking at some statistics, and I was trying to look at the unicorns that Central Europe has created. So I'll name a couple. So unicorns are companies that are valued at $1 billion or more. And we've created a fair share. So for example, Bolt, which is the Estonian e-commerce company, which we've all used. It comes from our region, does really well. In the Czech Republic, we've got Avast. In Poland, we've got Allegro. If you go down in the Czech Republic, you've got Kiwi.com, you've got Bitpanda, for example. And as you go down that food chain, you realize all these companies that are in the unicorn space are into e-commerce, into cyber, into fintech, into logistics, which is really where things are moving towards. And you also got companies like UiPath, which was valued at one point at $30 billion. So clearly, we can see the unicorns, we can see the entrepreneurship drive. If you move a bit further and you say, okay, well, that's good. Tell us more about FDI, tell us about growth. So we spend a lot of time in the bank looking at industry segments. And one segment that excites us a lot is the mobility segment. And I don't use automotive, I use mobility. The reason is because if you look at the mobility ecosystem, it's quite fascinating. We talk about green, we talk about moving towards electric vehicles and so forth. But if you look at the ecosystem, it's not just the car, it's the charging station, it's the battery, it's the advertising, it's the technology, it's the chips, etc., etc., etc. It's a huge ecosystem. And I spent 12 years of my career in Asia, and I've seen how Asian companies have done. I was in Asia 2 weeks ago. I was blown away, where companies in Asia are talking about putting more money in this region. Why? Because you're closer to the biggest markets, you can service them better, and so forth. And as we have geopolitical tension in Asia, all the more better for us. Therefore, if you look at mobility in that spectrum, it does give us a lot of hope to where the cluster is going. And there's some good examples. So I'll take a company like Toyota. They put $1 billion in Poland into hybrid technology. It's going to lift up the Polish market. If you look at Samsung, $2.2 billion in Slovakia into semiconductors. This is all recent stuff. And then we got real examples of going concerns. In the Czech Republic, Liftago, which is a rental e-scooter company, live. In Poland, we got an electronic vehicle company called Telemobiliteka, which is running as well. So you got real examples of companies that are in business here. So mobility is the future, and we are sitting in the future. The last thing I want to talk about when it comes to Central Europe is the defense sector. I know it's a sensitive topic, but I think it's worth bringing up here. And the reason I bring this up here is because Central Europe historically has got amazing manufacturing, amazing relationships in the defense industry, and amazing manpower. And today with GDPs going towards 22% or more towards defense, the defense sector is seeing the boom. And there are some examples of it. So if I look at Lockheed Martin, US company, they put in close to 2,000 jobs in Poland. It's going to lift up the defense sector. If I look at the Czech Republic, CSG Group made an acquisition of an Italian defense company called Finosci. There are many examples. So you've got defense as a very good pinnacle for growth. And then obviously the reconstruction of Ukraine is going to create another uplift as well. So I think we're in a very good space, very excited to be in Central Europe, and I think it's good to have this sort of engines of growth really at our doorstep. I'm going to switch gears now. I'm going to talk about sustainability. So, and it is a sustainability event, so I can't not speak about it. So it's quite evident to us, as we look at ESG profiles of companies, and I think, as as a bank, we do a lot of the advisory around ESG. We look at things like share price, we look at outperformance, we look at valuation, we look at volatility, and it's very clear that companies that have an ESG roadmap perform much better, and companies that don't are getting penalized. And it's clearly happening, and more so in Europe, because we're in a much more advanced stage of embracing ESG in finance. Now, Central Europe, where are we? I think we've made significant progress in recent years, but we still have some room for improvement. And the reason I say this is because according to the 2020 index sent out by the SDG index by United Nations Sustainability Development Goals, Central Europe countries, so Poland, Czech Republic, Slovakia, etc., ranked in the middle of the pack. So we've got some work to do. So I want to applaud the conference organizers for doing this event, because there's the glass half full for us. However, there has been some outstanding examples of leadership and sustainability in the region. So for example, in Poland, there's been significant investments in renewable energy, and Poland is now the largest producer of wind energy in Europe. Fascinating. Hungary has implemented a successful carbon pricing system that has helped reduce emissions and incentivize cleaner energy sources. The Czech Republic has implemented policies to encourage use of EV vehicles, and we've clearly seen the rise in EV vehicles in the recent past. If I go to Slovakia, it's made huge progress in terms of reducing waste and increasing recycling, and they have a goal to have 60% recycling by 2025. So this is all very positive. Let's look at specific companies. So if you look at, in the Czech Republic, there's a company called Pegas Nonwovens. It produces sustainable non-woven fabrics that are used for diapers and for other things. In Hungary, we've got a company called GreenGo, which produces cleaner energy for cigarettes. It's quite an oxymoron, cigarettes, clean energy. The Polish company PGE is transitioning towards clean energy and has goals very clearly to get carbon neutral by 2050. Hungary has a company called Pletio and has developed a solar panel system that can be integrated to payments and public infrastructure. And lastly, in the Czech Republic, a company called Giva is developing a platform for energy trading, for peer-to-peer energy trading. So fascinating examples in Central Europe. So overall, great work done, but I think we're making progress in sustainability, and I think sustainability has to happen both at corporate levels and at national levels. Let's talk a bit about CEE before we close. So what do we do at CEE in terms of how we view companies and how we measure sustainability? So at CEE, the work we have done is around building a framework which captures measurements that's based on measures and reflects investors' perception of the firm's clean energy innovation profile. So we've come up with 5 criteria that we use when we talk to companies and we assess companies to see their path towards green and how does that glide path look. So the 5 of them are, one is, do companies communicate a clean strategy and a transition roadmap and strategy, which we can see from financial reports, from conversations with companies and so forth. So that's one aspect. The other aspect is, do they actually, when they say they'll do it, do they really do that? And one way we look at that is, do they issue sustainability-linked bonds, not necessarily just for financing, but as a signaling and a commitment towards their goals? Thirdly, are companies building a supportive investor base and targeting ESG investors? We've clearly seen in the bond market, the profile of investors coming in today are very different, and ESG investors are out there looking for that investment. So are companies looking at that? Fourthly, are companies do they have a plan for reducing greenhouse gas emissions? And if they have it, is it done with intensity? And lastly, and very importantly, and we see this a lot in the energy space, is are companies increasing the sale of revenue generation that's coming from renewables, and are they segregating the renewables business into a separate business and focusing on it? So these 5 are the glide paths we look at to see how companies are actually moving towards ensuring they clear a clean energy innovation profile. I want to finally just touch on two quick bullets about CEE, and we've been asked this by investors in town halls and Q&As. One of them is around, does CEE approach the net zero? How does CEE approach net zero, and what's our methodology? So in the bank, we follow very much a credible science-based methodology that is informal, and we use very many frameworks that are out there to assess us. We've got goals internally to get to 2050 net zero, but we've got markers to achieve that at 2030 across different industries, so aluminum, agriculture, aviation, cement, and shipping. So that's how we are planning to get to our net zero commitments. And in terms of what we do in terms of priorities, the 3 priorities, which have a lot of initiatives and money attached to it. One of them is low carbon transition, climate risk, and sustainable operations. And this can all be read within the reports that we publish, and my colleagues will speak about that. So in conclusion, the hot topics in sustainability finance are complex and they're interconnected. While there are challenges to overcome, there are also opportunities to create a more sustainable future for all of us. As we work towards creating a more sustainable future, it's important to recognize that the role for corporations and financial institutions play in this fight is critical and vital. By prioritizing sustainable practices and investments, businesses can only reduce their environmental footprint, impact, but also contribute to economic growth and to social progress. And as we connect the dots between climate change, energy scarcity, and other global challenges, it's clear that the efforts are more important than ever. By embracing sustainability and taking a holistic approach, corporations can be part of the solution and the pressing problems. As a goal, and as a bank, CEE is committed to playing a leading role in the transition to low carbon economy by promoting sustainable finance. We've been involved in a lot of advisory, a lot of transactions, and willing to support as economies and corporations transition. We believe that by working together, and hence this forum is so important, we can create a better future for generations to come. I want to end with a quote from Mahatma Gandhi that my colleague shared with me at work that really stuck in my mind a few years ago, and I want to say it back to you. So Mahatma Gandhi once said, "The world has enough for everyone's need, but not enough for everyone's greed. So with that, thank you very much for listening to me. Thank you for hosting, and thank you for the panel. Have a good day. Thank you very much.
Thank you very much, Munir, for this amazing opening to the Banking Day, with a really good overview of not only the challenges going from global challenges to Europe, and even all the way to what is happening and what's the scene and context in our Central and European region. And also as actually in the spirit of this conference, where we try to not only bring people together to speak and share best practices, share knowledge, but exactly as you pointed out, to actually showcase some of the amazing things that are happening, some of the examples and practical examples of companies and what, some of the success stories of what is happening in the region. So thank you so much for that and for this very positive outlook and for kicking off the conference and the Banking Day. And now we will move to the second keynote by Mark Campanella, who is the founder and the executive director of Carbon Tracker Initiative, which are one of the leaders and pioneers when it comes to research on the impacts of climate risks on financial markets. So Mark, please, the floor is yours. You have the clicker. Thank you very much, and enjoy the keynote.
Thank you for that introduction. If you pause for a second and think for a minute, we're the first generation in human history that is able to heat, cook, power, and transport ourselves without having to set fire to anything. We can do everything today using electrons, electricity, and there is a battle between the molecule and the electron. Everything we've done in the past that's created the wealth we see today has been based on a fossil fuel system. What we're seeing being created around us today, right now, is a revolution. It's a revolution that's moving from an old energy system to a completely new energy system, and one that doesn't require us to set fire to anything at all to heat homes and power ourselves. I couldn't help but just take this quote from one of my favorite films, The Matrix. Hopefully some of you will have seen The Matrix. Agent Smith, you hear that, Mr. Anderson? That is the sound of inevitability. And it is inevitable that we'll come off the use of fossil fuels because the economics work, the technology works. We don't need any new breakthroughs for power and for transport. Most of the technologies we need are with us now. It's just a matter of scaling. And that's really what I want to talk about in the few minutes I'm going to speak. And it's a point that's made by Vice President Al Gore a few years ago. Investors are waking up to the biggest investment opportunity in the history of the world. In economics, things take longer to happen than you think they will, and then they happen far faster than you thought that they could. I set up in the fund management industry some 33 years ago. My first job was as a green investment analyst. I did my first renewable energy deal in 1993. It was a geothermal energy company. And I did my first clean tech private equity deal in 1994. But it took another 20 years, really, before the world got to a point where these new technologies were able to compete with the old technologies. I set up Carbon Tracker a decade ago, and during that decade, what we have seen is the complete collapse in the costs of production of all the key new technologies, from wind, offshore wind, solar, onshore wind, battery storage. And you just here's some of the examples of some of those technologies. And it's really about learning curves. Coal as a technology, the internal combustion engine hasn't really changed very much in the last 200 years. Nuclear energy, though there's space for it, as a technology hasn't got cheaper the more that you build. All these other technologies which are being deployed at the moment at scale have just got cheaper and cheaper and cheaper. It's a bit like when you bought your first mobile phone. People were paying £1,000. Today, you can get your mobile phones very cheap. It's a bit the same like color TV. It's all about the deployment and the scaling of the technologies. Here's one that will surprise some of you. Last year in the UK, fossil energy was 6 times the cost of clean energy in the United Kingdom. And that really just reveals the competitive story. This is only going in one direction, ladies and gentlemen. And this is the surprise. This is the statistics from Ember. In last year, EU wind and solar generated more power than gas for the very first time. There's the wind and solar in green, there's the gas in the grey, and there's your drop down in coal as a proportion of all energy generated. And solar capacity is set to overtake all other power sources globally within the next few years. And in the United Kingdom, we've got enough renewable energy stacked up, being built today, needs to get connected to the grid, that is multiple times more than the United Kingdom's energy needs. And that will make the United Kingdom a net energy exporter into Europe at current growth rates. So what this is all about is S-curves of growth driven by the energy transition and innovation, as these costs have dropped by some 90% over the last 2 decades. So what did the analysts at Carbon Tracker, we're a non-profit think tank, there's about 50 of us between the US and the UK. What do we write about? We're looking at the potential for oil and gas demand destruction due to new EV growth. About 20 million EVs on the road will probably kill about 500,000 to 1 million barrels of oil a day. And this shows the rapid deployment. This is the United Kingdom. The country that's going at far faster rates than this is obviously China, and China will be a global exporter of EVs at prices well below existing prices for European manufacturers of cars with the internal combustion engine. It's staggering to think it was just three years ago when EV sales as a proportion of all sales were negligible. Now it's hitting 20% of net new sales and growing up to 40-50% elsewhere. Last year, another key milestone, $1 trillion deployed into low-carbon energy globally, electrified transport being the big one. And so demand is really driving the supply equation. It's the new technologies on the demand side around electrification that is changing the way we supply energy. And for me, the key ones remain still solar and wind, with battery storage for dispatchable power coming up quickly behind it. And this is exponential growth is all around us. It's not just in Europe, it's not just in a few isolated countries that we know about, like Denmark, or as we heard just before, Poland. This is global. So in 90% of the world's economies, renewable energy is now cheaper than fossil energy. Why is this important for the banking system? If you look at the 8 of the 10 largest sovereign wealth funds in the world that create the liquidity that drives up asset prices, of course, they're all oil and gas-based sovereign wealth funds, of which Norway is the largest. As the fossil fuel energy system declines, we're going to have to start thinking about the liquidity that drives global asset prices, where the sovereign wealth funds have been some of the biggest players in markets. Have we seen this before? Of course we've seen this before. We've seen this in every technology that's come to find us: the mobile phone, the microwave, the radio. You can just list them all. Very similar S-curves of growth and adoption, and we've seen it in history through infrastructure systems on the right there, from the deployment of canals, which then got replaced by the railroads, and then ultimately by mobile traffic. We're seeing the same deployment. So what will this mean for people who bank the fossil fuel system? We anticipate and are beginning to see a major drop. We're on the plateau before the end of the growth expectations, particularly for coal, which we know about, but also for gas and global oil demand. Gas use in Europe has dropped 20% in the last year because of the war in Ukraine. I believe that the new infrastructure that's being built around European gas is unneeded, as we'll be adopting and moving to other technologies. So what do the fossil fuel companies think that are central to so many of the activities in capital markets and the debt markets, to lending, to equity capital markets? They still believe that there's space for growth. Ultimately, I think that's probably going to be an error. And as we switch from the old system to the new system, we have to be mindful as investors. Are we going with companies in an undisciplined pursuit of more from the extraordinary hundreds of billions of dollars of excess profits we saw last year, to one where inevitably that fossil-based system will be placed with a clean energy system? And are the management and the boards of these companies, are they really fit for the next stage, for the next 10 years as we move over to a cleaner energy system? I'll stop there. Those of you who don't know about Carbon Tracker, we work with pension funds and asset managers around the world, and all of our analysis is funded philanthropically. It's funded by some very good people who allow us to do this research and analysis, and you can download it for free at carbontracker.org. And I share this analysis as part of the advisory board of GFANZ, the Glasgow Finance Alliance for Net Zero, and others working on this really important goal as we move to net zero. Thank you very much.
Thank you very much, Mark. Thank you for setting the scene as well. And I think with both keynotes, I think the context and the scene has been set really well. And also, we have seen again some of the challenges, some of the trends when it comes to the transition to more sustainable, greener economy. And now, I think with the panel discussions moving forward, we will probably go in much more detail. And so I would like to now kick off the first panel discussion of the day, and I will very kindly ask to the stage Eric Jones, Director of Schumann Center from the European University Institute, who will be the moderator of the next panel discussion. Then Helena Horska, Chief Economist of Raiffeisen Bank, Professor Peter Bofinger, Chair for Monetary Policy and International Economics of the University of Würzburg, and also Miroslav Plojhar, Strategist and Senior Economist of Česká spořitelna. Good. So the stage is yours, and over to you, Eric.
No, super. I hope you guys can hear me okay. And I apologize in advance for my Texas accent. I hope it doesn't create any confusion in terms of what I have to say. I have to say that these two opening keynotes shocked me with the level of optimism. And particularly as I listened to Munir Nanji describe the political stability in Central Europe as opposed to the geopolitical tension in Asia, I thought, wow, this is a level of optimism I haven't seen in a long time. And so I'm very happy to introduce a panel of economists who will hopefully lower that optimism down to something that's more comfortable for somebody who spends a lot of his time studying political risk. And what we're going to do is introduce the conversation with three set-piece questions. I'm going to introduce the panelists in the order in which they're listed in the program and ask them a setup question to give them 5 to 7 minutes to sort of set the stage from their perspective. And then hopefully I'm going to bring them into some kind of controversy that'll depress you a little bit and encourage you to engage with us as well. Now I'm going to start with Peter Bofinger from the University of Würzburg. Then I'll go to Helena Horska from Raiffeisen and Miroslav Plojhar from Česká spořitelna. Peter, my question for you is, what are the great challenges facing the European banking system today?
Yeah, thank you very much for inviting me to this summit. And I will talk mainly about the risk of interest rate transformation. And so when people talk about the situation in the banking system today, many ask, do we see a repetition of the financial crisis in 2007, 2008? Is it this kind of same story? But one can say this time is different. In 2007, 2008, the problem was excessive lending, especially in the mortgage sector, which led to a boom in the real estate sector and then to a crash, and which had created lots of problems for the banking system, especially in the United States, but it was also transmitted via securitized assets to the European banking system. And one can say this is currently not the problem. We don't have a problem that we have losses on the asset side of the balance sheet. The problem today is maturity transformation. And why is the problem so severe? Well, we have observed a period of very, very low interest rates and a very long period of very low interest rates. And this is now followed by a very abrupt and unprecedented increase in policy lending rates. And of course, this is a major challenge for the banking system, because at the core of banks is maturity transformation. And therefore, banks now have two interrelated problems. First, on the asset side, they have lots of assets which were acquired or bought in the period of very low interest rates and which have a relatively long maturity. For instance, in Germany, banks have real estate loans to private households of about 1.6 trillion euros with an average interest rate of 1.8% only. And they have loans to the corporate sector, again, most of them long-term, of 1.3 trillion euros with an average interest rate of 2.5%. And the problems on the asset side are propagated by the very short-term maturity of the funding on the liability side. So again, in Germany, banks have sight deposits of 2.9 trillion euro. So we have this very long maturity with low interest rates on your asset side, and you have this very short maturity on your refinancing side. And of course, this creates problems for banks. And the question is regulation really well equipped to deal with these challenges? And if you look at the Basel regulations, and in Pillar 1, where you have to provide capital for risk on a kind of standardized basis, there is no need to provide capital on this kind of regular basis in Pillar 1. It's only in Pillar 2 on a kind of discretionary basis, and the calculation for the so-called Basel coefficient are based on a kind of scenario of an upward or downward shift of rates by 200 percentage points. And what we observe now is an increase of 275 basis points. It was 200 basis points up and down, not percentage points, sorry. And now what we observe now is in the case of the ECB that the policy rates have been increased by 375 basis points. And of course the question is regulation, has it been able to deal with these problems, whether it has been really sufficient? I think that's a risk that's looming, but nobody really knows it. The related question is whether we are now facing another doom loop, as we observed it in the years 2010, 2012 in the euro area, and which was a major contribution to the euro crisis. What was this doom loop about? Well, in 2010, market participants realized the increase in government debt and the threat of government debt in the euro area. As a result, risk premia went up, and higher risk premia, of course, had an effect on the banks who had lots of government bonds in their portfolios. The governments had to save the banks, which increased government debt, and increased government debt led to an increase of risk premia. So it was a kind of doom loop. And I would say today the situation is better, so some optimism might be there, because the ECB had been quite clever in protecting the banking systems against this kind of doom loop with this transmission protection instrument. And the transmission protection instrument is designed in a way that the increase in policy rates, which is inevitable, does not lead to an increase in spreads. And so far, the ECB has been quite successful in dealing with this problem. We haven't seen an unusual increase in risk premia, but nevertheless, one has to be aware that European banks have increased their bond portfolios quite considerably during the COVID phase. So they've sold large amounts of government bonds, so there's still some risk in the banks. So overall, if you look at the European banking system, it looks like a forest with an increased risk of fires. And if in this situation, it's really important to have an effective fire brigade to prevent that local fires spread to the whole forest. And if you look at this metaphor, and you look at what was happening in Switzerland with Credit Suisse, you can say, well, the Swiss fire brigade wasn't very effective, because in its financial stability report in September 2022, the Swiss National Bank attested to Credit Suisse a capital position which was above average, and they also said the Credit Suisse is quite resilient as far as shocks are concerned. So there was a very positive assessment, and by the end of 2022, Credit Suisse had an equity of about 43 billion Swiss francs. And even only a few days before the failure of Credit Suisse, Swiss National Bank said Credit Suisse is a solvent bank. But they did not, they were unable were not willing to save Credit Suisse. And I think this is something which is not in the textbook of what central banks have to do, because the normal procedure is if a bank is solvent but illiquid, it's the task of the central bank to rescue this bank. And I don't know why Swiss National Bank was not willing to do that. And I think that's a bad signal in a situation where you have increased risk of fire, if an important central bank is not willing to fulfill this task, which is normally its ordinary task. And therefore it's really important that the central banks make clear their commitment that if banks have a liquidity problem, and this is something that can happen every day, we never know which bank it is, but if the bank is solvent, it will be saved at 100%. I think this commitment is really required, and I was a little bit scared to read in Frankfurt Allgemeine Zeitung that the German central bank president said we are not the fire brigade for the financial system. But if the central bank is not the fire brigade, who else will provide fires in the banking system? So I think here is a risk that should be that one must see, and I hope that central banks will be more determined to fulfill their function as a fire brigade. And of course, governments also can contribute to more stability in the banking system by increasing the amounts that are protected under the deposit insurance scheme. I think some people ask for that in the United States, and I think by doing this, also governments can help to prevent forest fires in the banking system. Okay, thank you very much.
Peter, I feel so much better having heard you talk. I guess the point of tension in what you say, though, that it will come back to later, is between the idea that there are key members of the governing council and the ECB that don't believe they should be the fire brigade, and the confidence that you have in the TPI, the transmission protection instrument, because that may be confidence that we don't want to test in any real world experiment. Having said that, I guess the question that you point to in the context of this maturity transformation problem is how resilient our underlying macroeconomic performance is. I mean, are we going to be able to grow out of this and correct this inflation problem? So, Helena, I'm going to turn to you on that. What do you think is the macroeconomic outlook for the Czech Republic, for the region, and for the euro area as a whole?
Yeah, thank you for the question, and thank you for having me here. I like the positive view and opportunities as Murin mentioned before. Definitely I like it, but I see more challenges, but also some opportunities, definitely. But in the case of macroeconomic development, not only in the Czech Republic, but also in the region, is the question of the model of the future growth, because all our CEE economies were based on, as you mentioned, FDIs. Question is if there will come also in the future, if we will be able to cope with rising, let's say, energy costs, with lack of laborers in Czech Republic, not only in Czech Republic, with other challenges regarding the change in supply chains. We see the return from China to Europe and see that some part of our economy, especially automotive sector, is really challenging with the import, or is challenging with the import from China. So yeah, we need to find new growth model in the Czech Republic and in the CEE region. We also need to focus on our shortages, including labor markets. And now we see the period of very high inflation. So it means the very fast growth in living costs. Some part of this, it's definitely the convergence of our price and living standard and living costs to west part of Europe. But some part of it, it's also based, or it's impact of maybe not not very smart economic policies of the governments. I'm speaking about the Czech Republic, I'm speaking about also the Hungary and other countries, because the COVID, I would say, helicopter money, as I can see in Czech Republic, was at least 1/3 of the problem with high inflation in Czech Republic. So definitely I see lots of challenges, but I share the optimism, because I definitely see the pressure from business side, the pressure from the government to move on and to change the situation and to keep the Czech economy and CEE region to grow. And the bank system has a very important and key role in this, would say, transition. Because in my view, we are facing the new kind of transition just now, because we went through, like, I would say, perfect storm, COVID shock, then energy shock, and finally the war shock. And all these shocks, as I mentioned, perfect storm, just show what we need to change. And this is the model of the growth, this is the lack of labor force, this is modernization of our education, this is also the risk of very fast increasing public debt. But what is also positive, and I would compare the banking sector in Germany, in the US, with the Czech banking system, because even in the period of global financial crisis, the banking sector was strong, was safe, and was stable. And even now, we have even higher deposits to a loan ratio. So we have more deposits than loans. So thought we are still credit market, still like premature. We, thanks to conservativeness of our households and conservativeness of our companies, very high share of savings. The savings rate, by the way, in the Czech Republic is more than 20% of a disposable income. And in Czech economy, we have roughly 5% to GDP over savings from the COVID times. So our companies are conservative, financial conservative, our households are financial conservative, and this is also things that can help to stabilize or making the base for the banking and financial sector very tough and strong. Regarding the challenges, one of the things as a macroeconomist I'm thinking about is the change of the normality. What is normal? Was normal the very low interest rates before or ahead of the shocks? Almost zero rates in EU, even negative rates in the case of Eurozone, and very low inflation. Was this the normal, or we are approaching the new normal, not with in this double-digit inflation and very high interest rates, but the new normal in which the inflation will be single-digit, will be close to, I hope, to central bank inflation targets. The interest rates will reflect the situation in economy, will be not negative but positive. There would be no pressure to build up another bubbles or high increase in sectors like housing prices, or the debt increase and very low interest rates of the government and also companies' debt. So I hope in the new future, in the new normal, in which we will see more balanced economic growth, and I wish for Czech Republic even faster economic growth, if I may.
Yeah, you're allowed to wish for that. So, Helena, that was really fascinating, and I guess there is a point of tension, though, in the sense that when you talk about the high level of savings in the Czech Republic, it does make me wonder if, together with the helicopter money that you alluded to, the Czech Republic is going to have a hard time controlling domestic demand, right? Because the money is already in the pockets of households. So we may have to come back to that at some point in the future. Before we do, though, Miroslava, I want to bring you in to ask you what you think about our ability to manage risks within the banking system. The risks associated with the maturity transformation that Peter raised, the risks associated with the exogenous shocks that Helena raised, and also risks that are associated with this huge transformation that's underway. I was struck when Mark Campanella put up the slide of the S-curve transformation from infrastructures, the canal system and the railroad system. In the middle of those S-curves was 1835 and 1891, which were big financial crises in the United States associated with both of those innovations. So are we ready to deal with that? I mean, can you give us a sense of how prepared the banking system is in that context?
Good morning, everybody. First of all, small disclaimer: in bank, I'm paid to be a pessimist, and to look at, because I'm looking all the time at financial risk, fixed risk, interest rate risk. So maybe I may sound a bit pessimistic, but as a person, I'm optimist one, of course. So I must agree with what Peter told about I call it the duration risk rather than transformation risk. And I would wish a lot that there can be no problem as what happened in the United States, like Silicon Valley Bank and so on. Unfortunately, what I see from interest rate risk point of view, we got similar symptoms here. I don't want to talk about any particular bank, but when you got higher rates on deposits, you're paying on short term of the curve, and you got a lot of assets, long-term assets that's simply hard to survive. Yeah, and the case is that that is non-linear. When rates go up about 2 percentage points, nobody cares about what the deposit rate is, because that's one of important thing in Europe, especially Eurozone, and even that was the case in Czech Republic, that when the rates are relatively low, no one pays attention whether the deposit rate is 0 or something. When it goes up and up, more and more people are trying to get deposit higher rates, and it is non-linear. It's really changing, and that is what we saw here in Czech Republic when rates were 2%. Nobody pays attention. When currently rates are almost 1 year 7%, everybody is trying to get 6% on deposit. Yeah. And when you got a lot of assets on fixed rate, imagine, for example, just in numbers, when you got bonds and bought it 2 years ago, the bond price is down 20%, which is quite hard to manage. So coming back, how to manage it? I think banks and most of banks are doing it, trying to solve it earlier than depositors find out there's the problem. For example, what was Silicon Valley Bank when Peter Thiel came? Oh, this bank is basically bankrupt and cost bankrupt and was bankrupt. So that's the first case. And second, maybe related to interest rate risk, I have to mention whether it is longer term story, the inflation or not. One of the guys who is the clear winner of this interest rate mismatch are governments, issuing a lot of bonds at low prices. Unfortunately, the cost must be paid by someone. Partially by banks, partially by insurance company, pension funds, but mostly by central banks, who hold the biggest chunk of bonds in their portfolio, and who are taking slow losses. They are, of course, much bigger capacity to take loss than normal banks. But it is like going back into fiscal policy and creating money again. To close it, this I think, being on optimistic note, I think it's still time for not just for banks but for corporates to get ready, even at higher rates, because for example in euros, European Central Bank is going up, but you can fix your long-term liabilities at 3%, which is still good, being on positive note.
But if I understand what you just said, Miroslav, and I want to make sure I get this point correctly, what you're arguing is that in contrast to what Peter was suggesting, the central banks are already being the fire brigade. They're already absorbing a huge amount of the risk that's in the system. Did I get that right?
Yeah, they are absorbing, but they are creating loss. Yeah, and some banks, central banks are showing the loss, as for example, Czech Central Bank or Swiss Central Bank. Some are there is no mark to market, for example, Fed. And but at the end, that is about this transformation, but the loss is taken. Yeah, and imagine, for example, for some central banks that their assets are going down by 50%, which can happen. Yeah, and then you got smaller assets, higher liabilities. So that's kind of quasi-fiscal policy.
Okay, but they're not just taking a loss on their assets. I mean, Helena, if I understood you correctly, they're also taking a loss on their liabilities, right? Because there's all these reserves in the banking system that they have to pay out at ever-increasing deposit rates. Did I get that right? So we've got losses on both sides of the portfolio of the central bank.
Yeah, definitely, and this is also expansionary. So if we are speaking about the price stability and financial stability, the central bank, not we, the central bank needs to tackle that. And the risk is that if they would like to reduce their portfolios, they will, at least officially and financially, realize the loss from the change of the price. So this is, in my view, the challenges that the central bank face now, because as I mentioned, like in the previous period, we see not only very low interest rates or negative interest in the case of Eurozone, but a very huge increase of the balance sheet of the central banks. And the question is if they will be really able, without the very hard impact of the market and hard impact on the banking system and banking stability, to reduce the balance sheet. And in my view, it's maybe the biggest challenge for the big central banker and central banks than rising or reducing the interest rates in the future. So I think definitely, like in the Czech Nation Bank, we see the balance sheet close to 60% of GDP, and it's gradually reducing. But why? Because the revaluation of the central bank balance sheet is caused by corona appreciation, and then also the reduction of the prices of assets, bonds and equities.
But Peter, this gets back to the point that you were making about Nagel, right? I mean, because the Bundesbank in particular, but all the central banks in the Eurozone must be coming under intense pressure because they face imminent losses, because they have this requirement to reduce the balance sheet. So for them, the idea of being the lender of last resort must seem incredibly unattractive, because it would create, and this is a question that comes from Kestutis Kupsis, it creates conditions of moral hazard. And I guess, so my question for you is, have we put our central banks, by allowing them to get so overextended, have we put them in a situation where politically it's very hard for them to do what institutionally they're supposed to do, be the lender of last resort in case of financial crisis?
There are 2 points. First, the lender of last resort function, there's no alternative to it. And so whatever problems central banks might have, refusing to act as a lender of last resort would be a disaster. I think because then you really have a fire spreading over the whole financial system, and I think there's no alternative to this. The second question is, what about the profitability of central banks, so to say? And yes, it's true that central banks somehow stabilize the financial system because they are paying relatively high interest rates on the deposits held by commercial banks with the central bank. So that's somehow, and of course the deposit rate that the ECB is paying to banks is much higher than the rate on deposits held with commercial banks so far. And so that's of course something that stabilizes the profitability of commercial banks. But overall, even if central banks have a negative equity, that's not a problem. I think that's something one has to communicate to the public. A central bank is a different animal than a commercial bank, because a central bank has no convertibility for the deposits held with it, while a commercial bank promises convertibility of commercial bank deposits into central bank money. And so it's a completely different animal, and I think it might be difficult to communicate it to the public, but I think it will be inevitable that there will be losses by central banks, but that's not an economic problem.
The problem can be from the financial markets. If they were reduced too fast, or?
No, that's true. So if,
Okay, so about the reduction of the balance sheet, because this is the risk that I'm seeing now.
That's, of course, that's another question. How fast do we reduce the bond holdings of the central banks? But I assume that the ECB will do it in a moderate and gradual way and will not contribute with this reduction of its bond holdings to additional increases in long-term rates. And so far, I think you said it, we can say that the long-term interest rates on government bonds are still relatively moderate.
And if I may add, for the countries that are still outside the Eurozone, the negative equity of the central bank is also the risk for the euro adoption in the future, because then can be the requirement from a European institution to, as was in the case of Slovak central bank and Slovak country, to balance the negative equity of the central bank. So, if we are speaking out of the Eurozone, we as a Czech Republic, as a country that should somewhere in the future, we don't know when, adopt the euro, we definitely should also look at the negative equity of the central bank, because it's one of the obstacles and one of the risks of the future euro adoption.
Good point, yeah.
To put all the risk together, because this is another point from the bloc of the Eurozone countries and outside the Eurozone or outside the US.
Yeah.
But here, I guess I would raise a big question mark about the reasonableness of the pace of running off the ECB's balance sheets, because the euro system is about to release 477 billion in collateral back onto the market when the TLTROs mature at the end of June, which happens to coincide almost precisely with the peak of tension around the debt ceiling debate in the United States. Do you think, Miroslav, if I can bring you into this conversation, that the sudden withdrawal of all of that liquidity is going to create problems in the financial system, or is this something that the banks will be able to manage easily?
Would create a problem. Why I started with this central bank balance sheet and so on is not about criticizing central banks or so on. It's about implication for normal guys, normal companies thinking about ESG investment and so on. Does it mean that these problems create longer-term inflationary environment or low inflationary environment? I think all these problems, it can happen with banks when you hike the rates, short-term rates too fast relatively to long-term curve, is that the central bankers are not able to go high enough. So that is creating kind of stop-and-go policy we heard from textbooks from, I don't know, a long time ago, 70s. We're thinking why they really did in the 70s like this stop-and-go policy. And thinking about it, well, they didn't see it, what's wrong. They probably try to hike it, and then again see that something's wrong happening, cutting again, and that is exactly what the markets are pricing right now. Like the rates in US, in Eurozone, and even in Czech Republic will go down sharply because there will be some problems, some recession, and so on. But I think that is a process that central banks cannot really withdraw enough liquidity, cannot really hike the rates high enough, because their actions causing problems, they have to go back down, probably, to go again up. It's just like going to the mountains, you go to the base camp, then trying one move up, go for adaptation, go back, and go up again, and it is process.
So Peter, I take Miroslav's point very seriously. Do you think that there is a danger right now that we have begun moderating the pace of monetary tightening in the Eurozone prematurely, and that we're going to find ourselves in a stop-go cycle as a consequence as we battle against the inflation that's being created?
No, I don't see that problem. I see the problem a little bit that the ECB started to hike rates relatively late. I think they should have started, I would say, 3 or 4 months earlier. And now I think the risk is that they're hiking, that they stop hiking also too late. And so if you listen to what central bankers say, nowadays they say, well, we don't see that core inflation is coming down. That's why we have to continue hiking rates. But as we know from all textbooks, the transmission lags of monetary policy are long. 1 year, 18 months, or even more. So if you take the actual development of the core inflation as the guidepost for your interest rate policy, it's definitively wrong. So I think there I see the risk. If you listen to central bankers, they say, oh, well, so far is core inflation still increasing or not declining? So we have to go on tightening. I think that's definitely wrong. And so my fear is that the ECB will also be too late in stopping the interest rate hikes.
Now, if you're right about that, Helena, I need to bring you in on this. I mean, what is going to be the impact on bank lending, particularly bank lending for these huge infrastructure investment projects that need to be undertaken? Because if they get it wrong, and we know from the most recent bank lending survey that credit conditions have been tightening because of the withdrawal of liquidity and the end of the TLTROs, but they're also tightening now increasingly because of the impact of monetary policy. If they get this wrong, are we going to get the investments that we need in order to have the kind of transition that Mark and Munir described earlier?
Yeah, so it's a very interesting question because, what's the intention of rising interest rates? It's definitely reducing the credit issue and the credit cycle. So this is the impact. And the question is if we need to move on and invest to future, invest into infrastructure, new technologies. We definitely would say lower opportunities because the number of plans or number of investment projects that will be able to be profitable with the higher interest rates is definitely smaller. So, of course, it will reduce the opportunities for investment from the fiscal point of view. But on the other side, you have the government policies that are not only supporting ESG, because we are an ESG summit, we should speak about a little bit about the ESG as well. And we also, as a government is doing, is invest to still physical infrastructure. Like in CEE region, you still need a very high demand and high increase in physical infrastructure, digital infrastructure, this is also investment into human quality. So I think the government in this has also the positive role to at least rebalance maybe the negative impact of higher interest rates on investment activity. But me as an economist, I definitely expect a relatively lower investment activity in CEE region because of higher interest rates. But I think this is that we need to do, definitely, because of price stability. Because for investment project, the price instability and higher double-digit inflation is even worse evil than higher interest rates. So the first thing is to stabilize the price development, and then we can speak about if the rates should be a bit lower or a bit higher, but the first thing is to really stabilize the price development.
Peter.
Well, I think one should not overestimate the effect of short-term rates now on longer-term investment projects. And still, as I said, the long-term government bond rates are still relatively low. So in Germany, we have 2% and something for 10-year government bonds. And with an inflation rate of 2%, assuming it's still close to zero, the real rate. In the average of the euro area, it's maybe 1% real rate, so it's not that high. But I think you made a very important point. As far as investment in renewables and the whole renewable ecosystem is concerned, I think the government has to play a decisive role. And if you look at the United States with the Inflation Reduction Act, there's a lot of investment now going on, even with higher interest rates than the euro area. And what I see as a major problem for the business model of Germany, but also the euro area and the European Union in general, is that we don't have the same incentives provided for investments like the Inflation Reduction Act. And I think that's the greatest challenge, that somehow the Commission is trying to become a little bit more generous, but overall we are not able to match the conditions that the Inflation Reduction Act offers to investors in the United States. And you can see once the government incentives are strong, interest rates are only of secondary importance. And I think here we have a huge gap, and I hope that sooner or later, that especially also in Germany, the politicians will realize that subsidies are inevitable if you want to have a business model which is based on renewables and everything that is related to that.
If I may add to this, because this was a great point about the long interest rates. And in this sense, I think it's very important to have a very, I would say, sustainable fiscal policy. And this is another challenge for Europe and also Czech Republic in the CEE region, because otherwise, if the market will see the risk of a very fast rising public debt and huge fiscal imbalance, the long interest rate will go up. So at the same time, the fiscal policy should definitely support the long investment project, but needs to reduce the fiscal imbalances. Otherwise, we will see another increase in long interest rates.
May I contradict a little bit? If you look at the United States, they have huge fiscal deficits, and the government debt is increasing, and hopefully if it's not stopped. but I'm optimistic in this regard. But if you look at what the United States do not care about fiscal deficits, and it's successful in attracting companies. And if we have fiscal, like most of my German compatriots like it, if you have a balanced budget, but nobody is investing in the long term, this is not a good idea.
So Miroslav, I need to bring you in at this point because so far Peter's been advocating for a lender of last resort and a spender of last resort. But what I guess I'm curious about is, let's not forget, Munir started off his presentation by talking about the fact that the weighted cost of capital, weighted average cost of capital, is actually higher than the return on investment in these projects. I mean, is that what you're seeing in the market? That what we have in our business sector are a bunch of people servicing debts rather than making profitable investments? And if that's the case, how do we get that fixed unless we appeal to what Peter is offering, the spender of last resort model where the state steps in and covers the gap?
I have to say, with longer term rates where they are right now, I think the shift from very low interest rate environment to higher interest rate environment was so quick that almost everybody, I think, of course, even me, we are still thinking in the previous environment. But the environment has clearly changed, and that there's a risk that it will change even more. So current rates are not that bad because we must take into account possible development in the future. I wish a lot that central banks would not be as expansionary, that fiscal policies would not be at that big deficit. But I'm a stoic, so I think that is happening. I have no power to influence it. Of course, Helena can influence it a bit, or Peter, but as a guy on the market, I'm not able to influence it. I must simply take it as it is and try to live in it. So current rates maybe look higher relative to return on investment, but return on investment in what inflationary terms? If in higher inflation, then the return on investment will be definitely higher than currently projected.
Well, I think Miroslav, most macroeconomic policymakers would say they're actually trying to influence you, and they're not succeeding in influencing the market in a way that's predictable. And partly, I think that comes from the fact that as we move toward this sustainable finance model, we're confronting the reality that we don't have viable macroeconomic models on which we can all agree, right? And so my question, and I'm going to start with you, Peter, and then go to you, Helena. My question is, what are the core macroeconomic principles that we should all agree on? Because it doesn't seem to me, even as I look at the Governing Council of the ECB, that there are very many of those that are the subject of positive agreement at the moment.
Well, of course, we need price stability. I think that's undoubted. I'm relatively confident that we will get inflation rates down. If you look changes of inflation on a month-to-month basis, you can already see that the momentum is declining. But I think that's obvious. I'm not so sure whether we need balanced budgets. As the example of Japan shows, but also of the United States. If you are a large currency area, there are no financial constraints for governments. The only constraint is a real constraint. And of course, you have to be careful as a government to look at this real constraint. For instance, in the United States, the very generous transfers made by Trump and Biden to households, they violated the real constraint and inflation went up. But so I think this is something you have to have in mind. But I think what is really the first importance is really to support this transition to renewables with all financial means, because in the long run that will also save a lot of money.
So I'm surprised that one of the things that you did not bring in as a core principle that we should all agree on is this too big to fail aspect, or the bailout of solvent institutions aspect. I mean, there's an excellent new book out that looks at the origins of modern financial capitalism in the decision actually to begin bailing out institutions at the end of the 17th, beginning of the 18th centuries, without which we wouldn't get the kind of risk management that we see out of the banking system, because they would just be too conservative. But Helena, would you agree with these core principles or add to any of them?
Yeah, definitely I would agree with price stability, because I already mentioned it. But as the first word that I would use is sustainability. And sustainability in many aspects. This is regarding the price stability. It's about sustainability of the price growth. Sustainability. If you look on the labor market, this is the long-term problem of aging population. So we have the demographic trend through which we need to go through it. Then sustainability regarding fiscal dominance. This is I'm really speaking about, because it's not really a question if the fiscal budget is balanced. In my view, is the question that the fiscal situation should not limit the economic growth, should even support it. The fiscal dominance means that the fiscal policy has implication for monetary policy. So central bank needs to think about the interest rates hikes and impact on the budget deficit, on the debt payment, and this is wrong. So the fiscal dominance should be also tackled. So I'm not thinking we should have in any time balanced budget. I'm thinking the balanced budget or the budget needs to be flexible. At a bad time, at the time of crisis and shock, the fiscal policy needs to be flexible to react. And on the other side, at the good time, they need to make the reserves. And in this case, I think German economy and German government is a nice example, because ahead of COVID, they did some reserves and they used them during the COVID shock. While in Czech Republic, we haven't, or we did not have any reserves. And what we did, we increased the public debt and deficit, in my view, too much. So sustainability. And then we also can speak about the sustainable economic growth. So the question is not about fast grower, and so grow faster and faster, but to grow to leave the sources for another generation. So in my view, I would use in a macroeconomic policy the new term, and we should in macroeconomic policy focus on long-term sustainability in many aspects.
But I guess my concern is that these principles that you're talking about, we're not actually seeing. And the more that we advocate these principles, Miroslav, the more market participants must experience a kind of cognitive dissonance, and they get into that Peter Thiel moment where they WhatsApp all of their client companies and provoke a run on the bank on which they're all dependent, right? So to what extent are we in a situation where market participants could actually, in a rational way, do terrible harm to our financial and real economies?
Well, I don't want to sound alarmistic, but from the market, what I see, for example, there's a smoke definitely in Europe as well. For example, some banks are taking euro deposits at 3.5% above ECB. So that means that they are desperate for money. Yeah. The problem is here. And maybe coming back to your question about fiscal whether central banks should support governments and on large bailout and so on. They did it basically in some extent. Yeah, and one last issue here. Regarding to what should be done in policy and what is the assumption, what is the wishes I would like to see as an economist that government and central bank should do, and what is the assumption about what I should do as an investor, and as an assumption I would say do not mix assumptions and wishes. As James Bond told, shaken, not stirred. Yeah. Unfortunately, from the point of view of what's going on, I see environment and inflationary and accelerating inflationary, even though short-term outlook is much better. In Czech Republic, in Germany, in Eurozone, given decline in energy prices and so on, long-term, I think we are building inflationary environment. And the reasons are all we talk about today. Take it to the one pot and say, is it inflationary or not? And decide what to do with your financing of your long-term projects.
So I guess one of the things that I've really enjoyed about this conversation, I want to thank all three of you for engaging with it, is that we have really covered a whole range of issues associated with economic policymaking and its impact on the financial system. The last thought I would leave you with, though, is that what about the impact of other policies that are being made right now? And I'm struck here by a recent speech that was delivered by Jake Sullivan, the National Security Advisor in the United States, who argued at the Brookings Institution last April that foreign policy in the United States should be made without looking at market rationality and should be focused much more on strategic considerations. The IRA is one illustration of that. But the heavy use of sanctions, not just against Russia, but also against China, is another. And the extent to which that could provoke decoupling of this global economy is quite important, I think, in the way it would impact not just on Europe and on Germany, but on the Czech Republic by dint of the implications for the whole economic model that Europe has succeeded in creating, a model that depends critically on globalization. I realize I've used up all of our time without giving you, the audience, an opportunity to ask questions. I apologize for that, but I hope you found it to be an engaging conversation. Please join me in thanking my panelists for their participation. I really found it very useful to hear what they had to say.
Thank you.
Thank you very much, and I completely agree, Eric. That was and I think hopefully all of you agree, a very strong panel, but also really strong first section of the day, and really good kickstart to even more discussions on banking and sustainability in banking. So I thank all the speakers and the moderator for the amazing discussion, and now we will have a 30-minute coffee break, so I invite you all to get some coffee and refreshments, and people online, hopefully you can also get some coffee where you are. Thank you very much.
Climate change is a speeding train. It's ramming through stations and headed straight for us. So what's ING doing? We're trying to help slow it down while also preparing for what could happen if it doesn't. It starts at home, so we monitor our environmental impact and have targets to keep doing better. But as a bank, for us it's really about two things: how our business impacts the climate and how climate impacts our business. Our biggest impact on climate is through our financing. ING finances today's society, which means, yes, we do finance things that aren't green, but we also finance billions of euros of green projects and companies around the world. We say a flat-out no to certain businesses, and yes, but to others, outlining sustainability changes they'll have to make first, and then helping them to make them. We innovate with things like sustainability-linked products, where rates are linked to sustainability performance. And we aim to steer the most carbon-intensive parts of our portfolio towards net zero by 2050, financing the new technology needed, like battery storage and newer, greener ways to make steel. This is our Terra approach. Of course, while we try to make a positive impact on climate change and continually strive to do better, we also have to limit the impact of climate change on our business. There's physical risks, like floods and wildfires. And there's transition risks, like what happens to car makers who haven't started making any electric cars once those are the only ones legally allowed to be sold. To be resilient to these risks, we have to identify them, understand them, figure out how likely they are, and what their potential impact could be. Those insights shape our business strategy. We work hard to do our part as a bank, together with our clients, and commend others who are doing the same. But fighting climate change has to be a united global effort. We call upon regulators and governments and others to play their important role as well. We've come a long way, and we know that we still have a long way to go. But sitting still is not an option. We're focused on the future, moving step by step as we aim to make the difference. For us, for our clients, for the world.
Okay, welcome back after the break. And now we are moving on to the second section of the day, and which will focus on banking and also on all the climate pledges and basically how we move from all the pledges and commitments to the action. Because we have seen many pledges and many commitments and targets over the past, let's say, 5 years, maybe 10 years on when it comes to climate targets, when it comes to environmental targets, and we know that now some of them are made for 2030, some for 2050, but in any case, we are needing some of the deadlines. Now, I'm really curious to hear what the next two speakers in the elevator speeches, but also then in the panel discussion have to say about it and how we can actually materialize some of these targets and how can we actually bring about the action. So now we will start with two, as we call them, elevator speeches, so short, energetic, and very punchy presentations. So we will start with David Carlin, who's the head of climate risk and TCFD program lead at UNEP FI. So David, the floor is yours.
Great. Thank you so much. It's great to be here, and very much looking forward to speaking with you today. And I'll really just make a few remarks, but in the context of what is an expanding field of climate data and why it matters to the work that we all do, whether we're working directly on sustainability, whether we're thinking about financing opportunities, or from a governmental standpoint, the commitments that firms are making and other governments are making. And so to begin, I think that there are three big themes that I'll come to, which is, one is the element of imperfect information, which is, to me, the heart of finance as well as the heart of risk. When we think about the future, we know that we're always going to be dealing with uncertainty. We know that we're always going to be looking at a field of vision where we're not necessarily fully able to consider all of the different impacts. And in fact, over the last years, we've realized that despite having good tools, having good information, we miss a lot of the key concerns. We obviously saw this in the global financial crisis when we had reams of information, but it wasn't properly considering the level of risk exposed. And now we see this again, despite the fact that we've put in improved regimes of assessment, better statistical modeling capabilities. We saw in the world of rising rates, the fact that ultimately what happened was in the US as well as in Europe, a number of banks have seen significant mismatches in their investment portfolios and have been forced to take significant losses as that became apparent to the market. So the key here is not to say that the information, the analysis, the assessments that we do are useless, but it is to say that we should approach this with a degree of humility and a degree of recognizing that finance begins with the idea of uncertainty and this idea that maybe we are making a prediction about the future anytime we make a loan, anytime we make an investment, anytime we underwrite something. And so as a result, we are operating in that world where our blinders are on. And I think the key is to find data, to use data in ways that reveal a little bit more of the operating space to us. We're never going to get to that full view of the future because there are always going to be things that we miss and always going to be things that we don't fully consider. However, I think it's important to recognize, though, when it comes to that uncertainty, where we are with climate is a bit of a unique challenge because fundamentally climate is what I would call, from a statistical standpoint, a badly behaved problem. It's one that really demands that what we look at in the past and what we look at in the future are two fundamentally different things. So how do we draw lessons from the past in terms of previous physical events, in terms of loss rates, in terms of impacts? How do we draw that when we're really struggling with the idea that the whole premise of climate change is that that future is going to not look like the past, that there are going to be relationships that strengthen, relationships that weaken, relationships that fundamentally break down. And I think this is really where the heart of climate data comes in, which is to say, can it provide us with this view of safety? Can it provide us with a barrier and a view of resilience for our assets, for our portfolios, and for those of our clients to really think more extensively about the risks? And so rather than, I think, the very tunnel-focused work, which we've seen a lot of in the data space over the last few years, of can we get, for every geolocated asset, a view on the particular factors that are going to be climate sensitive? Can we think about data more in the sense of a holistic view of where are our uncertainties, and if we're not certain where the risks are going to come, what are the things that are going to be protective? What are the things that are going to help us? The analogy I often like to give about this is we're driving on the highway. We don't just decide to buckle our seatbelt when we're about to get in a crash. We recognize the seatbelt protects us from worse outcomes, despite the fact that we don't know when an accident may happen. And I think that that's kind of the fundamental idea here of climate data is where might there be risks that we may have missed? Where might there be information that we might not have covered? And then can we use climate data to open our eyes to more structured thinking about where we need to be preparing and where we need to be thinking about those contingencies. So I think the best initial uses of climate data begin with this idea of helping us see things that we haven't otherwise seen. And that kind of gets into the second theme, which is what is the use of climate data? What does useful data really look like? And I think useful data gets back to that old adage about all models being wrong, but some being useful. And in this case, the idea here is we know, as I said, that all predictions about the future will be wrong in some way. But the ones that are going to be useful are the ones that are going to be able to shape our future decisions, that are going to leave us better prepared for the future, and importantly, are going to help change the way that we think. They're going to do that either by showing us something we would have otherwise missed, or instead by showing us something that we had an inkling of or a hypothesis, and this helps to confirm or disconfirm that. And so when I think about the data that is used on the risk side, but also on financed emissions, what I'm really trying to get at and what I'm trying to express here is this notion that the most useful data is going to be something that tells us something that we don't know or helps us confirm or disconfirm something that we were thinking toward. And so when we consider the models we build, when we consider the information we have, we don't want to get to data for data's sake. We want to get to data for a clear use, for a real purpose. And I think that that is really widening our perspective of the world. I think we naturally walk around with blinders. We look at the past and we look at the present, and we assume that change happens in a linear and slow way. And yet we have countless examples, from COVID to rising inflation now to the conflict in Ukraine, of the potential near-term perspectives being a lot broader than we actually had anticipated. And I think the value of good data, of good information, isn't to get into these sort of high-tech discussions of how this supply chain 3,000 miles away is operating. That is useful, but I think in a broader conceptualization, it's to say, what are the key indicators? We need to be able to digest and use this data to draw insights that we otherwise wouldn't have been able to make. And I think those insights, in the case of climate, look like potentially where are systems shifting from one mode to another? So where is climate action strengthening and the transition heating up? Where are there potentials for risks to really emerge on the physical side? How do interrelationships between these risks exist? And so this, to me, really moves into kind of the third area that I would say, which is making us active users of this information. It's not about collecting data. It's not about gathering this information simply for the fact that we can put it in a report, simply for the fact that we feel better informed when we have it. It's really only what we do with it. And I think the main uses of this information, whether it's on the risk side or the opportunity side, really boil down to how does this influence your decisions? So what I often talk about with people is this sort of transmission mechanism of here's a climate-related shock or a transition-related shock. How does that flow through into the companies that you finance, into the counterparties that you have, and where does that show up in terms of the credit risks and market risks that you may experience? And I think that fundamental translation is going from what is the magnitude of that shock, how might it translate into things such as changes in revenues, impacts to overall outlook for the industry, changes in potential compliance costs that an organization might face. We see in the US just now the US EPA, the Environmental Protection Agency, is making a requirement around power plants and their carbon emissions. What is that going to do to the competitiveness of certain fossil assets? I think these are the kinds of questions where data can be useful without us saying at an individual level, we have all of the pieces we need. We can begin acting by saying, if then, and by really focusing that premise of the data on the links between climate-related, transition-related shocks and the impacts on the real economy. And then many of us have the models already in existence to think about how those shocks on the real economy, on real companies, flows through into our portfolios. And one of the questions here is not only for us to understand how it flows through, but also to realize where our architecture needs to be updated. Are there elements that are climate sensitive that are not being taken into account in your risk ratings, in your risk appetite, in the way you're engaging with clients? And so in thinking about this, both to spot the opportunities and also to manage the downside risks, and importantly, to help companies to make their transitions, one of the keys is really thinking about what information do I need to make a decision? And that gets back to this real point, which is thinking about what is the decision useful criteria? Where are the elements where you could be flying a little bit less blind with information? And I think, as I said at the beginning, it's not about information for information's sake. It's really about focusing on where this plugs in to a risk score, where this plugs into a valuation model. And understanding these relationships, there's quite a lot of work both being done in the academic space as well as empirically between relationships between climate policy and valuation of companies, between how markets are assessing and evaluating the long-term viability of certain sectors. These are pieces of information that can help us build those links. And so I really would recommend for all of us in the audience to be active users of this information and to recognize that we are doing a challenging thing here of trying to fix the engine while we're on that highway. We are trying to move towards sustainability. We're trying to get to the heart of decarbonization and building a sustainable future. But the only way we're going to do that is to recognize that in the face of these uncertainties, we need to be collecting data. If data can be that useful engine, it's an engine that needs to be operating even as we're moving along the road. And so what I would really recommend as main takeaways for you here in thinking about the uses of data, the applications of it in the climate space are first off to consider how it's being used within your organization. If you don't have a clear use for it, then thinking about either is that a failure on the data side itself, it's not useful, it's not impactful data, or on the process side, do you not have a way to ingest that? Secondly, I would think about how does this data change the relationships you have strategically and then tactically with the clients that you work with? What information is helpful to assess transitions, to assess opportunities, to manage the risks that clients are facing? And then finally, I think, and this is one of the more exciting spaces of data, how can data tell us things, give us insights that we otherwise wouldn't have? And this is where the space of machine learning, AI, that we've seen so much about in the popular press, really links back into this question of climate and sustainability, which is all of these tools can be very valuable, but they can only be valuable if they're going to help us provide insights into things that we don't already understand or help us confirm or disconfirm patterns that we are already seeing. And so without that, this sort of undirected view of data, the collection for collection's sake, is going to leave us in a place where we have a huge stack of data and limited action. We're in a world that not only is generating more data than ever before, but it also is moving and changing faster than ever before. And I think our challenge and the push I would give to all of you here is to recognize that this is a simultaneous process of getting the information you need and applying it. And it's those two things together that are going to make your institution more effective, more resilient, and getting to the heart of sustainability. Sustainability is not just about the overall global society, but organizationally, sustainability means that you will be around for the future, means that you will be able to weather challenges in this changing world, whether they be environmental or not. And so when I think about data as the heart of sustainability, it's about using this data, bringing it in, and having processes in place for that continuous improvement, even as we go along this road that we're all following at rapid pace. So thank you, and very much looking forward to hearing the rest of the session.
And thank you very much, David. And thank you so much for a lot of food for thought as well. And also touching some of the topics we actually already opened yesterday. I'm really glad you brought the data perspective to this too, because that resonated a lot yesterday in the discussion about ESG ratings and how it's not only collecting data for the sake of data, but also actually looking for that purpose and how to use it and how to apply it practically for solutions. And now we will move to the second elevator speech, which will focus on fixed income and debt, and will be delivered by Ulf Erlandsson, who's the founder and CEO of the Anthropocene Fixed Income Institute. Yes, Ulf, the floor is yours.
Thank you very much. Impressive pronunciation of the Anthropocene Fixed Income Institute, which I founded 3 years ago, and which is a very organization very much focused on exactly what David was talking about, the transmission mechanism. We have the data, we have the knowledge, but how does it actually apply in terms of what happens on a day-to-day basis for fixed income portfolio managers? And the picture that we're using for our sort of brand, the sprouts coming out of the Bloomberg keyboard, reflects this. The capital allocation decisions in fixed income markets, they are done through the Bloomberg terminal. That's where you actually trade, buy and sell securities that eventually then shift the cost of capital towards a more sustainable future. Given the short attention span of portfolio managers, I have developed a way to put QR codes in the presentation, and it's extremely hard to spell our organization's name. So please feel free to use those. They will be referencing a couple of the research pieces that I will be mentioning here. To kick off, leveraging fixed income for positive impact. Why? I will actually start out with saying that there was a gentleman yesterday suggesting that ESG investment is pretty much meaningless. If I sell a bad asset, someone else buys it, and it doesn't really matter for the company. That is fundamentally wrong, at least if you look at fixed income. Fixed income is predominantly what we call a primary market relative to equities, which is predominantly a secondary market. In the primary market, for example, an issuer is looking to raise capital. They go out to investors, and investors say, we are going to lend you money or not lend you money. And if there are fewer investors lending you money, you are going to have to pay a higher rate on that loan in order to incentivize them. It drives cost of capital directly in fixed income. ESG investment, exclusion rules, all of those things actually apply in fixed income, whereas the argument is less strong in equities. Secondly, the reach of fixed income is much broader than in equities. We, or the portfolio managers, the CIOs, and the fixed income books, they speak to everyone. They speak to the EIB, they speak to governments, they speak to private companies, they speak to all these different outfits across the financial biotope, whereas the equity, by definition, is focused on public equity companies. And especially when you're looking at the energy transition and some of the issues that's going on there, the non-public entities are the big important players, especially if you want to manage your things such as your carbon footprint. And this brings us to the third part where, activist fixed income investors have historically been shown to transform complete economic systems. Think about the European sovereign crisis in the 10s. It was fixed income investors, actually hedge funds, starting to short certain securities on the back of fundamentally non-sustainable macroeconomic policies, debt situations that were untenable. And by moving interest rates, by selling bonds such that interest rates moved up, people were, or a whole system, the European Union had to, or the Eurozone, had to change their view on macroeconomic policy. That is powerful. So how do we leverage and get that to actually work with regards to climate? It already is working, actually. I am exemplifying two things here. Number one is a letter to shareholders from Semcorp, a Singaporean sort of infrastructure conglomerate, which is essentially saying that we have this coal asset, we're trying to sell it, but no one is providing finance to the guys who want to buy it, which was a private Omani consortium, by the way. So we have to provide the financing instead. They were unable to find public finance for a particular coal project. On the right-hand side, and it's going to be extremely hard to look at you, so I'll color code it. Over here, we have in green Saudi Aramco, and over here we have fixed income investors in a vehicle called Green Scythe, or Green Sword, if you translate it. Green Scythe is a special purpose vehicle from Luxembourg, which is working as a financing vehicle for Saudi Aramco's pipeline network, set up through a private consortium. Now, wouldn't it be easier for Saudi Aramco to actually borrow money straight out, rather than go through this sort of very convoluted green safe structure? No. It turns out that Saudi Aramco, for many of the ESG indices, is excluded because they're not scoring well enough on certain factors. Whereas if you can restructure this and get it into the green side structure, you can put those bonds into the ESG indices and people will buy them. And you access a lower cost of capital and perhaps also better sort of reputational financing. On the positive side, and fixed income people are generally very depressing because, you know, you're sitting there, you're hoping to get your money paid back, you can clip a couple of coupons, and on the other side, you can lose all of your money. That's the sort of the risk-return profile, whereas equity investors, they can, you know, make 10,000% on their smart Tesla bet or whatever. So we are generally depressing, but this is the one thing that excites me when it comes to transition, sustainability-linked bonds. Which is a way to put in a conditionality in a loan, in a bond structure, to say that if you achieve certain performance target with regard to sustainability or something else, you are getting a lower interest rate. You're not getting a stepped-up interest rate. But what's interesting is that these are general corporate purpose instruments. They affect the whole balance sheet. They're not trying to sort of asset-back some part of the balance sheet. They're looking at the whole balance sheet of a company. So you get a holistic view of the company. And it's been very effective in terms of actually reaching smaller companies that don't have as much assets to put them into green bond structures, also lower-rated companies. And the market is actually working okay-ish. It's not great, but it's working okay-ish. And we had a case discussed yesterday, the Polish oil company, PKN Orlen, who were the first in the market to actually not achieve their performance targets and hence pay a step up on that coupon, which is an essential feature of this market, that this sort of step up option actually works. And why is that? Well, we've done some work, and this is a more of a technical paper, but it is, I think, a fundamentally important idea about where SLBs need to go. We call them greenback SLBs, and greenback as in a dollar, and a dollar as in the option premium in an SLB needs to be at least $1. Oh, that sounds like a lot of theory, but that's a nice thing, because this is driving a couple of interesting results out of economic theory or financial theory, rather than trying to, you know, play some sort of non-pecuniary soft angle on why people should buy it. So what's going on? In a step-up bond, the investor might get the step-up in the future. So they have like an expected value to this step-up. There's, you know, an expected value of the option of having the coupon step-up. That's going to materialize with some probability that we can discuss what that probability is going to be. But what we're seeing in the greenback SLB proposal is that that optionality, if we assume a 50% step probability, has to be at least $1. If it's not worth $1, so 1% of bond price, why should we bother if it's non-material? I mean, your traditional fixed income portfolio manager, they won't react on this because it's not enough meat there in order to analyze it. The flip side of this is also that if the issuers are offering this optionality, well, they're supposed to get a lower coupon, a lower fixed coupon on their SLB. They're supposed to get a lower cost of capital. So if you are offering optionality to investors, you should have something in return as an issuer. And that's the fundamental problem that we've seen in the sort of the labeled bond market, that it hasn't really given you like that boost in terms of lower cost of capital for the issuer side. The last thing which is exciting about this is that one way to increase optionality is to increase ambition level of the sustainability targets. If you're more ambitious, then there is a higher likelihood of failure. It's you're more likely to fail going for the Olympic gold than you are when you're going for the district championship. But we want that ambition, right? And investors want that ambition. So that means that the probability of the step up happening is increasing, the optionality is increasing, which means that the ambition level should then be reflected in a lower fixed coupon on the sustainability-linked financing. So the more ambitious you are, the lower your interest rate. And that's just from a no arbitrage condition. We're not talking about any sort of green wizardry here. And you can start pricing that and so on. We're more than happy to engage and discuss with people who would like to look into these structures. Investors are excited about it, some banks as well. We're talking about banks in this session, so I also want to highlight some of the work that we've been doing. We've been looking at, the banks have a central role in terms of, providing transition finance. And one way to parameterize that is say, okay, how much do you do in terms of green and sustainability-linked financing, and how much do you do in terms of, fossil fuel-related financing? And let's net those numbers and normalize it so JP Morgan doesn't look worst or best because they're always the biggest. And this is the resultant list, where you'll see the 1, 2, 3, 4, 5, 6th column gives the headline number, the net that banks are generating in terms of their fee intake from green versus fossil funding activities. So you get the ranking, which banks seem to be generating more business and money from the good versus the less so good. Counterparties are starting to look at this. Bond issuers, predominantly, I think it's important that you go, if you're issuing a green instrument, you should go with a bank that has green credibility. You shouldn't go with one of the guys at the bottom of the list, because they are generally not as strong in their green franchise. This can become systemic as well, and this might be a little bit controversial, but if you look at the rolling sort of 12 months of green bond issuance, thank you EIB for this conference and for being the biggest green bond issuers. The runner-up is the Saudi Public Investment Fund, so the sovereign wealth fund of the Saudi government. And they have issued slightly north of $8 billion of green bonds. And you can discuss, and we do that in our research, whether those should be eligible as green bonds or not. They're not issuing any other bonds. They are the second biggest owner of Saudi Aramco, and they are a big investor in the NEOM Giga project, and that might be especially controversial if you follow some of the human rights organizations. The problem here is that if you look on the right-hand side, which banks have been on deals for PIF over the past 12 months? Or been providing loans to PIF over the past 12 months? Everyone, except the two in the bottom. And that obviously creates a sort of a systemic dependency on one single issuer, which might be controversial. So with that, I'll finish up and say our research is free. It's available on the web. You can do that QR code, and they will send an email that sort of subscribes you automatically to it. I learned that function last night, and I think it's very cool. Thank you very much.
Thank you very much, Ulf. Thank you, Ulf, and thank you also, David, for setting the scene and setting the context for the next panel discussion we have, and also mentioning climate data, again, debt and fixed income instruments, which are essential in the next topic we'll be discussing, and that is achieving net zero. So, to the stage, I would like to invite the speakers and the moderator of the next panel, which will exactly focus on how to practically achieve net zero, because we can always go, and probably some of you may have, and I sometimes go and Google, okay, so what exactly is net zero? So in theory, it does make sense, and we know it's about reducing or finding the balance between the greenhouse gas emissions and how much we produce and how much we can actually absorb or remove. But what exactly it means in practice, and how does it look like to be in that net zero economy, and also how do we get there, and what is the role of banks in getting there? So I thought people would be joining the stage while I speak, but it's not happening. So if I can please invite to the stage Laura Negrisoiu, Strategic Project and Sustainability Director of Mazars, to moderate the discussion. And then we'll start with Catherine Mintoff, who's the head of EMEA Sustainability and ESG at Citibank. We have Tomáš Nievola, Head of Structured Finance, Co-Head of Investment Banking at mBank, Professor Ben Caldecott, Co-Chair Global Research Alliance for Sustainable Finance and Investments, and of course, Gabriel Marosi, Group Sustainability Officer at Erste Group. So the floor is yours. Enjoy the discussion.
Thank you. And I just wanted to say that, again, the dynamic of this event changed because the last two speeches were about optimism. So we are going again up. And also, in addition to the members of the financial sector, I hope that also people from the real economy, let's say, watched the last speech, because it's very important for them to understand also what is the trend in financing, so that they can also adjust their policies. And let's say a more practical way that I read lately on thinking about climate change is about having in mind two figures. One, it's 51 billion, and second one is 0. 51 billion represents the number of tons of greenhouse gases that are entering the atmosphere every year. And even if numbers can differ from time to time, the general tendency is growth. And this is the stage that we are now. The second number is 0. And this is our objective. And let's see practically how we can go there with the help of the banks today. Because in the end, the banks are making the link between the financial system and the real economy. So that's why it's extremely important to see how banks can actually contribute to this. So I will start with Gabriel as a general question to see how would be your approach to tackle the sustainability challenges.
Thank you very much, and I'm happy to be on this panel. I think that we will have on this topic very interesting discussion. I'm also happy, that the banks are still enjoying so big trust that we should be an active player on the net zero transition. Although sometimes I have a feeling that we are not really the players who can manage our own business. Just to relate back also what we have heard from David, and then this links very much to the understanding of what the banks can effectively do. What we are seeing, what we do see with the climate change is that basically our conditions are changing. Yeah? And the banks are primarily institutions who do understand, current opportunities and current risks. Now, what we are speaking about is that if our risk profile is going to change in the future, we need to think in a completely different way. Yeah? So this is point number one, a big challenge for the banks, to look ahead and look for risks which today we don't see, we haven't seen them in the past, but we still need to start to deal with them. Point number two is that that banks are typically, in a kind of relationship business with their clients. That means that we are operating in a certain region, we have there a certain set of clients, they have certain operations, certain business model, and they are relying also very much on the policies of that markets, the governments and the public sentiment. So we cannot, just pick assets from the other side of the globe and shape our portfolio in a very dynamic way. We need to think about how we can together with our clients make a change looking forward. And thirdly, usually the banks, I think that there is a kind of overly optimistic picture how much influence the banks can have on their clients. Yeah? I mean, we are providing service to our clients, and our clients has a certain business model, have a understanding where they are heading to in the future. And the banks can a little bit shape it with fees, with negotiations, but we cannot change the complete business model of the clients. So, taking these three things together and translating it into the net zero ambition and the kind of fair share of the impact what the banks should take out of this journey, I need to say that I am really surprised how many banks are taking how big commitments. We have seen also a reference to the UNEPIFY initiative, and we are part of the Net Zero Banking Alliance. Last year in October, there was the annual report of this alliance stating that 60% of the banks are already taking interim commitments, so most likely toward 2030, by how much they commit to reduce the financed emissions. Now, taking those three things, what I'm just outlined from the banking, and taking, the big commitment of the banking sector toward a net zero journey, I think, this is a quite ambitious status what the banks are building up. And it's still the easier part to make the commitment. The more difficult part is then, to deliver on. And from the Erste side, we spent basically 2 years to build up, firstly, our understanding where we are currently. Secondly, to build up a kind of understanding based on our clients, based on the financed assets, and based on our business model in the region of Central and Eastern European region, how we can shift our kind of business strategy going forward, how we can motivate our existing stock of clients to make the transition happen. Yeah? And on that one, we just recently published our interim targets, where we are stating that in the real estate sector, be it on the side of the retail or the corporate or the commercial real estate, we see that we can reduce the financed emissions nearly 40–45%. In the energy sector, we do believe that together with our clients, and some of them yesterday were on panels, we can reduce the financed emission by 50%. And these two sectors are at this moment, I do believe, the most important ones. They are the kind of early movers. So I'm happy that finally, with all the thinking process involving all the countries what we have, we were able to outline where the journey might happen in the portfolios of Erste. And we are, of course, building to that engagement policies, products, and motivation schema also for the internal stuff as well.
Okay, so your focus practically is on prioritizing sectors so that you get the biggest impact. To leverage on what you said about risks, what do you think, Catherine, about how banks are embedding sustainability risks in their policies?
Thank you, and thank you to Linda and the team for their excellent organisation and for the opportunity to join you today. I guess the first thing I'd say for banks managing sustainability risks is that these are not new risks. Banks have been managing environmental and social risks to some extent for some time, but we know that climate change and biodiversity loss are accelerating, and we're starting to see risks really materialising. So there's still much more to do. When we think about how banks are exposed to risk, we're exposed usually indirectly across the whole economy through our clients' activities, and we look to manage these risks. It's really important to think about two key things first, so we're clear on what we're trying to do, to David's point earlier. So risk to who? Yes, we have to manage financial risk to the bank, as our regulators are increasingly asking us to do, but we also want to consider risk to society and the environment as well. So the second element of that, I guess, is for those risks that are risks to the bank, how do they manifest? So are they credit risks? Are they operational risks? Are they strategic risks? And the reason that's important is it informs how we integrate these relatively new emerging risks into the risk management machine that banking is, so the new issues. So banks can manage risks really at 3 different levels. So if you think of a sort of inverted pyramid, the basic building block is where banks are directly financing projects. So a real economy asset like a mine or a railway. And there we can look at environmental and social impacts assessments to understand what are the risks at that location to a whole range of issues: water resources, biodiversity, communities. And then we can work with clients to support them in managing those risks through an action plan that can form part of the loan agreement. So the Equator Principles offers a framework for doing this, and many banks globally apply those principles, but it only applies to a few specific transactions where banks are directly financing projects. So it's not the norm. Then next up from that is where we have management of risks at the client level. So that can be where banks are lending to companies for general corporate purposes right across their lines of business, right across the geographies that they're operating in. And there, that's a naturally much higher level assessment. We think about things like clients' commitment, capacity, and performance. And so a couple of examples from Citi. We have a climate risk assessment scorecard that we are using with our clients to try and build up an understanding of both transition and physical risks across our portfolios in key sectors. And the other is a net zero review template where we're really trying to deep dive into those transition plans in key sectors. So those are two separate things. Climate risk management on one hand and net zero inform each other. They are related, but they're not entirely the same thing. And then finally, at the portfolio level, that's where risk metrics come into play, our metrics and targets. I would say we're probably still at a relatively early stage in really understanding the full set of risk metrics that we need to manage new risks. That's very much a focus for us. Banks can use policies, so we have an environmental and social risk policy framework that sets out for certain transactions what is the review process. So for example, we recently updated ours to include review criteria for beef and soy production in Latin America. And it also sets out our milestones for reducing our lending to the thermal coal mining sector. And then on the other hand, we've got our net zero targets. So we've set net zero targets in 6 sectors, and we're working towards achieving those. In all of that kind of risk management work, I think foundations are really important and shouldn't be underestimated. So training, for example, is and will continue to be a really important part. We need bankers to be able to engage our clients and engage in a good conversation about risks, opportunities, and their transition plans. There are challenges, of course. I'm not going to even mention data. But one of the challenges we find when thinking about transition plans is regional variation. So different countries have different energy needs, and understanding the context of the region's development is really important and something that we're trying to capture in our transition plans, in our transition review process. And secondly, that this is really ever-changing. So we're finding that expectations of regulators, what we're learning from our own analysis, really means that we're having to constantly shift our approach. You know, what a good transition plan looks like today is different to what a good transition plan looked like 2 years ago, and we expect that to continue evolving. So really, it's an ever-growing exercise. And I'll just make 2 final points. The first is on transparency. So we try to be really clear about why we are trying, how we're thinking and why, so that helps investors and other consumers of our climate reports understand and interpret the results of where we're going, what's captured and what's not. And secondly, just finally, I think in all of this, we would be missing an opportunity if risk management was solely about risks. So one of the key things we should use risk management for is also, yes, absolutely manage the risk, but also a platform for identifying opportunities for us to support client transition plans.
Thank you.
If I may just ask one question, because you know, the biggest challenge for us is the banking is done on calculated risk. So my question would be, and to be honest, this is a kind of I haven't found for that a solution. How do you calibrate the climate-related risk? Because we don't really have, from the past, a kind of relevant observations. Mm-hmm. And as we heard, the climate change is overriding the past. So how you are doing that?
Those are excellent questions. So we are, I think we're really building up our capabilities on climate risk. So the US at the moment, the Fed is running a stress test, a first stress test for the big US-based banks. And so Citi is going for the first time through a global stress testing exercise. We've learned a little from participation in the ECB exercise from Hong Kong. So really, I think, this issue of how do you incorporate forward-looking risks when we can't look back at historical data to understand them is really being fleshed out now.
Okay. I think that if I understand, you are in the same shoes as we are.
Mm-hmm. I think we all are. Yeah.
Okay.
That's clearly a challenge.
Mm-hmm.
Yeah, an interesting part is that you cannot kind of back testing. You are so used with back testing, but for this risk it's hard to back test. And also that your, let's say, care for what the clients are doing, it's also directly, it's related to what is impacting you also. Because depending where they are in their journey, it's where your portfolio is actually in your journey. So that's why it's so even important maybe to set the context so very well with the new customers, because at least here you can have an impact now. And to practically to leverage on the opportunities, because that's an important part of the ESG side, as if we just look at risks, we just think of costs and so on, but if we look at opportunities, the optimism rises again. So, so Tomasz, if you can detail us a bit how the market for the green or greener products looks like now.
Sure. So, in fact, it was great to have this presentation before about like a snapshot on how it looks from the global perspective and how the fixed income market looks for green financing. I will try to put some context from the regional perspective because it's a CEE summit. So, first of all, I think that what is very visible is that from the product perspective, there are basically at this stage all products that are necessary. It's not an issue of the product. The issue is about really allocate the funding to the right places to achieve the impact. Because when I compare large deals and smaller deals in our regions are crucial to really have this transition impact. Those are two completely different words. When we have been as mBank issuing our green bond, that was a very big success. We have tapped the global market. We have 80% of ESG investors. But when we look at the geographical division between them, it's basically UK, France, Scandinavian countries. There was less than 10% of investors from the region. And then if we go down the scale and we look at deals not of the like 500 million euro size, but 20 million euro, 100 million euro, and then because we are issuing a number of green bonds in this scale, then it's extremely difficult to attract ESG investors to this market because it's too small, too far away, doesn't fit the allocation criteria in many portfolios. And then that's really the place when we need more funding and where the funding really makes a lot of impact. So I believe it's not about the products are there. It's more about finding a way to attract the capital really to the places when the impact is really realized. And then I will react a little bit to your comment because you were not that optimistic about the impact of banks on the client in respect to carbon footprint and overall strategy. And I may be slightly more optimistic on that. I really believe the impact is not going through this like few margin difference on ESG alone and whether the targets are achieved or not. That's very important, and really that's like a real proof of the fact that those structures are working. But I really believe in the impact which goes through like everyday meetings with clients, and then meeting them one day, and then 6 months earlier, and then coming back to the fact, last time we discussed about your green strategy, what was the impact, what is your strategy, and when you will have the exact data on your carbon footprint, what are your strategy in respect to the reduction, when it will start, what are the results, and really this like constant pressure. This is something which I believe is the main channel to realize the impact on the client. And for banks, that's extremely important, because mBank and many other banks have already net zero pledges. And then, of course, it's still far away. It's 2014, 2015, 50. So it's like quite a long perspective. But at the same time, there's an enormous work to do, because our clients, majority of them today, they are not even able to calculate their footprint. So, and there will be very difficult decision at some stage in the banking sector. Yeah? There will be very tough decisions at the credit committees level of type, this is our long-term client, we've been working for 20 years now, and then they are not delivering on the transition. They are not delivering on the reduction of carbon footprint. What do? Do we increase pressure and still keep them on our books, or at some stage there will be tough decision to just quit this relationship? And it's not today. Probably we are not there yet. But this is how it will work in a couple of years' time, and that's why I believe banks are one of the key elements of transition.
May I just very shortly react? So don't take it wrong. I'm optimistic, and you can see it on the Erste profile. We are going ahead, and I think in some extent we are setting the trend in the CEE region. Nevertheless, look in the region. If we are just counting how many banks in the region already disclosed their ambition, their targets until 2030. You will find that this is way more than 60%. Almost all the big banks in the region already have certain target setting. Point number one. Point number two, look how many companies are setting targets. If you just check the sites of the Science Based Target Initiative, in Austria there is 31 companies who set targets, in Czech Republic 2, in Slovakia 0, in Hungary, I think also 2, and in Romania 0. So, what I'm saying is at this moment, the banks are much more progressive than the companies.
Sure.
And the banks are much more progressive than the sovereigns as well. Because just look, how much kind of public information the sovereigns, our governments are putting available on a yearly basis, how they are progressing on their carbon footprint. Where are the targets? What they are doing? This is what I'm saying, that banks can do a lot, and we are putting in a lot of effort, and we are setting ambitions, and I do believe that we are setting the trend. But we need that all the rest of the society is following, and even I would expect that some part of the society, like the government, should take the leadership, right? So, fully agree. We are on a good way. Mm-hmm.
So, in conclusion, also we have like two pillars on like pressure for the companies is like the regulators, because they impose them to report through, especially in Europe, through CSRD in the near future, and also you as banks through your pledges, you will have to pressurize your clients so that you can respect your commitments, because without them not reducing their impact, you will not be able to also to respect your pledge. And to go to even more practical aspects, I would like to ask Ben, what is your experience in how companies are implementing their net zero strategies?
Yeah, thank you for that question, and thank you for the kind invitation to be part of this panel. So what I wanted to do was really to build off Catherine's remarks and talk a bit about transition plans and transition planning, because that underpins transition finance, which so many of the speakers have spoken about already. Two quick plugs, though, before I do, partly because Ulf and David set those up so nicely. So we actually have a conference on natural language processing and sustainable finance in Oxford on the 19th of July, and we also have a conference on fixed income and engagement and net zero also in Oxford on the 19th of June. So if you're interested in those things, do come along. But transition plan, and transition planning, transition finance. So we have this context where, and you were just saying this, a very large number of commitments from financial institutions, less so from corporates in this region, but that's not necessarily the case everywhere. Great. How do we make sure those actually become real, and that these companies in the real economy or financial services firms actually change what they're doing? And there's a sense that it's very easy to make these promises, and that firms that have made these commitments are not fulfilling those commitments. And there's sort of growing evidence to suggest that there are quite a few institutions that aren't backing up words with action, backing up their words with action. So how can we resolve this? How can we make sure that their commitments are credible? And this is something that is a very live issue. It's live from a conduct, greenwashing, regulatory perspective. Obviously, civil society organizations are very concerned, wider society is very concerned. And the answer is these credible transition plans. And we need to make sure that companies that have made commitments have ambitious targets, they have credible strategies, they have appropriate accountability and governance mechanisms in place, and that they have transparent and robust metrics to track progress. And in many cases, those things do not exist. So a couple of jurisdictions, as well as some international processes, have been calling for the introduction of transition plans. In the UK, for example, it's currently a requirement on a comply or explain basis to prepare a net zero transition plan. The government in March in the UK announced that it was going to make that a requirement for large companies, so a net zero transition plan. Transition plans look set to feature in the International Sustainability Standards Board and their standards that are going to be finalized next month. You have GFANZ has got working groups on transition plans. You have IOSCO and the NGFS and the FSB all looking at how transition plans can be introduced in different jurisdictions in different ways, covering off different types of security. And I think one of the things that's coming through in this work on transition plans is the need not only for companies to think about how they can prepare for an economy-wide transition to net zero, but how they can also contribute positively to it. So that means having a plan to manage the risks and capture the opportunities of the transition, but also demonstrating very clearly how you can support the transition in the jurisdictions you operate in. And that's actually quite a different way of thinking about all of this. So when we think about banking and how banks can make a difference, well, where do they operate? What sectors do they lend to? How can they help transform those sectors? What is their strategy for doing so? It's not just about providing a few more loans to slightly cleaner companies. I think there's a sort of more expansive, more interesting, more strategic way of thinking about these things and developing theories of change and thinking about the levers at your disposal in different bits of the world to make a difference. I think transition plans are going to underpin quite a few things that have already been mentioned. They will be used in sustainability-linked structures. They will obviously, I think, also determine access to capital through the banking system. You know, banks will be more inclined to lend at a lower cost of capital to companies that have credible transition plans. They will drive stewardship and engagement activities, including in the banking sector. And actually, that's one of the key levers actually for encouraging the transition within banking, and the role of banking within the transition is stewardship and engagement of and with the banking sector. Transition plans will be used by supervisors, particularly in microprudential regulation, but also there'll be conduct issues that I alluded to before. This will drive policy. You'll see policymakers going, well, we only want to support companies that have credible transition plans. So we will allocate subsidy in that way. We will create regulations that support those companies that have transition plans. We will increase burdens on those companies that don't have transition plans. We'll start to see that. And I think this will also drive future litigation and liabilities as well. You know, did you as a company or a board have a transition plan when you should have had one? And I expect a lot of those legal actions to begin. We're also going to see, and we're seeing this in the UK context through this transition plan task force that's been set up to kind of define what good looks like for transition plans. It's not just about net zero. So increasingly, this conversation will be about adaptation. What are your adaptation plans? How are you going to become more resilient and support wider societal resilience to climate change? And also nature recovery, biodiversity. How can you, again, manage the risks associated with ecological dependencies, but how can you also support nature recovery? One other thing I wanted to mention in terms of how banks can support decarbonisation and things we could do to enable banks to do more is exploring open banking standards in this space. So one of the issues, as sort of alluded to, but not said explicitly, is that, you know, banks are going to find it difficult to ask their clients for an awful lot of information. And that's one of the things that's preventing them from probably doing more. And so if you have open banking standards where information can flow more freely, where clients don't have to prepare different disclosures for different banks, that there's a common way of disclosing information, then that unlocks competition. Different banks can see the same information and go, okay, well, we can use that to provide this transition finance package for you. Oh, no, well, we can provide a better transition finance package for you, and you have competition in the market.
The same as with the financial data. There are no different sets of financial data for different banks.
Indeed. And there's another aspect to that OTA, to kind of sharing more information, which is these sustainability-linked instruments, particularly sustainability-linked loans. If you come up with a structure with a KPI and it's rubbish, you're not going to share that information with anyone. Similarly, if you're a bank and you find a great one, you're probably going to hold it on, keep it to yourself, keep it close to your chest. In fact, what we need is for really effective KPIs and structures to be adopted widely across the sector, and that's going to require sharing information that isn't currently happening.
Thank you. And to actually point out on your mention about transition, because through taxonomy, the regulators try to define what sustainability means and what a sustainability company means. So how, in this year, all the companies that are reporting on non-financial regulation, they have to report also their taxonomy alignment indicators. How would you see that in your clients? How will you use that data from your clients that are already preparing that kind of information? Especially from the capital perspective, because one of the indicators is also how much CapEx is sustainable in total CapEx. Will that be an information that you will use it?
Okay, if I may start. So firstly, I so much like these taxonomy-related disclosures, because I do believe that there is an enormous amount of information in. Now, of course, for us as banks, the primary use of this information is to complete our reporting, right? Whatever our customers are reporting, we need to translate it to the financing of the customer, and through the financing then into our reporting how much of our so-called green asset ratio is then reaching by the year end. But that's, to be honest, a reporting exercise. And this is important for our investors, for the regulators, for the public. But most importantly, I do believe that in the information from the taxonomy reporting, we can read out a little bit, you know, what is the intention of the company, how much they are going to invest into green technologies, how much they are going to invest at all. But I need to confess that the bankers are doing a business which is typically much more simple than to use all the available information, and the taxonomy is something very new. So it's still a way to go that the bankers are integrating into their assessment of the client, the taxonomy-related information, not just to assess the risks, but also to assess the opportunities. And this is, to be honest, a quite long process. I mean, the group sustainability officer in Erste is sitting in the credit committee. And I many times asking my colleagues from the business side, so what was the reporting of the client on the taxonomy eligibility last year? How much you expect out of the client's CapEx, OpEx turnover to be green? And at this moment, this information is not yet in the DNA of the business side of the banks. Yeah? And then let me make here one more thought for the discussion, and I'm then giving over the talk to the other colleagues here. The taxonomy is one part of the story. What I'm really looking forward is with the CSRD, the obligation to explain how the companies and the institutions are aligning their business strategy to the 1.5 degree climate scenario. Because the 1.5 degree is a very challenging scenario. And again, turning back, the wheel a little bit, the governments are not committing to 1.5 degree scenario, but we as institutions, we as companies, we are obliged to explain how we are going to reach the 1.5 degree scenario. Okay, I'm handing over to the colleagues, maybe some other thoughts are coming on that.
Yeah, if I may just go back to the point on taxonomies for a second. I think the EU taxonomy is an amazing, astonishing piece of work, and we know there are issues being raised around the usability of it, and it was good to hear yesterday that is a focus, is what will the impact be. I think one of the challenges for international organisations is understanding how we can, yes, we have to use the taxonomy to report in our EU entities, but how we can use that as a tool when it's applicable in one market and there are other national taxonomies being developed all over the world, and how we try and think about building a system where we can both report and identify opportunities in quite a fragmented landscape. So that's a concern. Like many of our peer banks, we have a sustainable finance goal, and by necessity, we have to define quite broad criteria for that. For us, that includes both finance and facilitation, and we deliberately made it broad because we wanted to engage as many parts of our organisation as we possibly could. So how country and regional taxonomies will interact with, and be interoperable to define kind of a more global standard is a really important concern.
Yeah, that will be a very big
it would be a very big
scheme.
Yeah.
Yes. Thank you.
So maybe just one more quick comment on this, because effectively it's not natural right now for the companies to report taxonomy CapEx in the overall CapEx. It really requires initiative and then additional questions from the side of the financial institutions, and this is happening. But I would get back for a second to one very important point, which are those standards, because we are working with SBTI, with PCAF, and so on, but it's extremely important at some stage to set a standard for everyone, because otherwise there will be no way for corporates to really do this job. This is an amazing, huge work on the bank side to find and to create teams, to learn, to teach people to really implement this in the bank. And then for corporates, which often have like smaller structures and then less committed, or I would say less focus on those sustainability issues, it is really crucial to make it as smooth and as practical for them as possible, having common standards.
Thank you. And regarding data, because again, how you mentioned, it's a challenge to get the right data. Ben, maybe you can develop on this from your experience. What are the main aspects to be considered here?
What are the main aspects to be considered in relation to climate change data and banking? God, that's a big question. There's a lot there. Look, I mean, I think they're sort of two points. So one is, one thing we've been doing a lot of work on for, I don't know, 5, 6, 7 years now, is really focused on asset level geolocated data. And if you can have consistent global asset level data sets tied to ownership information, that allows you to do all sorts of very cool stuff in relation to different kinds of climate risk, different types of environmental risk, understanding externalities, understanding impact attribution, all sorts of things. And that's kind of missing in many sectors. So it's really important that we address that requirement. We're doing that at Oxford in coalition with others for high impact, as in very polluting sectors of the global economy, iron and steel, cement, pulp and paper, these sorts of things, petrochemicals, creating these open asset level data sets. So we kind of need an endeavor to do that systematically and quickly, and we can do that. And that's partly enabled by developments in technology that David kind of alluded to, but I'm thinking particularly around Earth observation, machine learning. So that's point one. And by the way, I think policymakers are just not being sufficiently ambitious in that area. They can step up and organize something very quickly, but they haven't. They've been wasting a lot of time on things that are much less impactful than solving that data requirement. Second point is, again, building on David's opening contribution. There are these sort of two families of approaches that do overlap. So there's natural language processing, and then there's this Earth observation machine learning thing that I mentioned before. So we're very excited about ChatGPT and all those applications. There are a lot of kind of ESG startups, innovators working on both tracks, and I think that's really exciting. So keep an eye on both those those tracks of development and innovation. And I think we're also seeing more generally. Actually, a lot of the innovations we're seeing in the climate sustainability space around data and finance have applications well beyond sustainability and finance, right? They become useful for understanding risk and return just generally for different sectors. So I think if you're a financial institution, it's worth kind of thinking about, well, if you want to have cutting-edge capabilities that can help you figure out risk and return in different sectors just generally, it probably makes sense for you to spend some time in understanding developments in sustainability data and analytics, because actually that's where a lot of the innovation's coming from.
Okay, thank you. And to continue with the data, because as we were saying, it's one of the biggest challenges. Maybe, Catherine, you can detail what were your lessons learned from the past years regarding data at the global level.
That's a big topic. And my colleagues who are out crunching numbers on net zero could probably talk on this for days. But I think one of the most often cited is the availability of data. So we know that clients, my data science colleagues would tell you that there's only about 3,500 companies globally that are disclosing greenhouse gas emissions, and that's a reasonably basic disclosure. We follow the PCAF methodology for estimating our data quality when we're calculating our net zero baseline and progress against it. And that is improving over time, which is good, but there's really a long way to go. And we're sort of trying to fly the plane while we're building it, to use a really terrible analogy, because our baseline will improve as we're moving, as we get more disclosed data from clients. I think, and the UK regulator has been quite clear on this, that banks have a role in helping our clients to take that first initial step by opening a conversation, by engaging with clients. Quite often our focus has been on the carbon intensive sectors, but that's something that needs to happen right across the economy. So I think as a sector we need to get much better at helping companies just get started. I think financial products and services have a role to play in that, but also relationships and conversations between clients and their bankers on expectations of disclosure and how people can move forward. And of course, CSRD will have a huge impact in the next couple of years.
Thank you.
May I also bring here a thought? I think that we are still, experiencing the easier part of the data challenge, because we are just, starting to or trying to establish the starting point. We are using also proxy informations like using, emission factors from the PCAF database. But the challenge is different. If the banks are committing to reduce 50% of their financed emissions by 2030, which is in 8 years' time, that means that on the yearly level, they need to report 6% reduction annually. I mean, and that update of the information that the client made the investment, what was the impact of the investment, so how is my position changing? This is something which will be a kind of major challenge, what I see, because that means that we are not, collecting one-time information, but we need to ask the client to regularly update us on the progress of his investments. And this we need to start also already now, because, we are already experiencing the first year of the transition. Next year, then second year. So, this data challenge, and I also would like to, just give this information to the audience, because many of the companies are sitting here as well. Please be patient with the banks. We need to see how you are progressing, and I do believe that this will be to your benefit as well, because ultimately what we are doing is we are trying to accelerate the transition, trying to put it in a track, and hopefully with that we are reducing the risks, and with the reduced kind of risk positions, we should sooner or later be able to reflect it into the pricing as well.
I have completely the opposite advice for people in the room, which is really accelerate the pressure on the banks and up the pace. And there's a lot more that can be done, I think, very, very quickly. And some of this is regulatory as well. We've fantastic progress on the climate stress tests, the exploratory stress tests that have got supervised firms to really think about this stuff and build up capabilities. And we've just got to make sure that that momentum isn't lost, that these exploratory one-off stress tests become recurring. And that's one way, and there are many ways, but that's one way in which pressure on the banking sector can accelerate and then speed up what you guys are doing.
Yeah. So my point on this would be, we don't need more pressure, but we don't need less pressure. we don't need to ask an additional patience. The level of pressure is just right, and banks are really doing a lot. The pressure now, I think it's more on the corporate side, just to help them to fit within what we need on the bank side. So that's, I believe, banks are properly motivated to do the right thing, I believe.
Pressure's just right. Sounds like you need to rank it up.
Okay, I think that the better word is the challenge, right? And to be honest, the kind of rising level of challenges is something what I do believe that at some point in time will bring a very kind of good understanding also of the policymakers, that to live up to these commitments, i.e. to facing the challenges in a credible way, we need to join our forces.
Okay, thank you. So it's like now we are in a general consent that we are still in a transition period for everyone with data, for banks, for corporates, for everyone. But soon the pressure will increase, how you said, from all the perspectives, from the regulatories, from the society, and hopefully on the banks and from the banks.
I would be more concrete, to be honest. 2024 is something what ECB declared that they do expect, that the banks are fully complying with the guidelines on the climate and environmental risk management, right? So we are in the midterm to the compliance period or the expectation of ECB, and just, again, relating to the discussion what we have had yesterday, at this moment, 60% of the banks are dealing in a kind of sound and well-progressed way with the ECB expectations. So 40% is still at the beginning, but the ultimate horizon of the expectation is 2024. So that is the magnitude of the challenge. And I do believe that the transition risk, as Catherine mentioned, the physical risks are still kind of topics which the banks need to digest, need to frame, and need to be able also to calculate and calibrate. Yeah? So that's one part, and the other part is, of course, how they are living up to the net zero challenges. And I also do see here some questions coming in.
Okay. The last question from me, and then we can go also there to the screen. Do you think, because we are talking about risks, do you think there should be a higher capital requirement on brown firms, or contrarily, would you agree with an easier capital requirements on the green assets?
Let me guess what a bunch of bankers are going to say.
No, but the reasoning is the important, you know.
What's the reasoning then?
And if I may, I have had yesterday a very interesting discussion on that, also involving Martin Spolz. And my point is, you know, if you are putting a brown penalization factor, you are slowing down the thing. If you are putting in a green kind of premium factor, you are accelerating the transition. Yeah? So for me, the choice is very, very easy. The green is, you know, a positive motivation. And this is what we see in the competition of Europe and the US. That was the discussion yesterday in the evening. US is putting in, you know, motivating forces to accelerate the transition. In Europe, we should do the same.
Tomasz, what is your...
I believe you're absolutely right. Banks would be for like positive stimulation rather than for penalization with capital ratios. But at the same time, I believe this like some kind of premium for green assets, this is something we see already, yeah? And I believe as well, this is something which works already quite well. I believe today there is no issue of financing green energy, green assets in CEE, of course. If there is an issue, it's an issue related to the stability of the regulatory landscape, and that's the main issue. Yeah? It's not, I believe, the issue of the banks not willing to finance green economy. At least what I see on my side, banks are really willing to finance all green projects without like excessive additional stimulation.
So I mean, I agree with that. I don't think there should be subsidy through risk weightings for green assets. I do think it's a risk-based framework, and using that lens, you can apply. I think it would be justifiable for there to be additional capital charges on polluting assets if you demonstrate they were riskier. And by risky, there are two things, right? Riskier for the lender, but riskier that they generate risks for society as well, right? Through creating climate change and contributing to global warming. So I think we should be thinking about those two types of risk when we're thinking about adjusting capital requirements. But to your point, there's also and this is also one of the questions here, in a sense, you know, we need more nuance here, you know, particularly if you're thinking about, you know, most companies, most economic activities are polluting. So how can we support the transition of those things? And a kind of a crude green, red, green, brown, whatever you want to call it, is not actually the right way to think about this stuff. And you know, when you're lending money to a polluting company, you should be going, well, do they have a credible transition plan? And if they do, then there might be a good case for us to provide the capital for you to transition. But not every company is going to be able to transition. And so we need to be honest about that with ourselves. At the moment, everyone is saying, oh yeah, you've got a transition plan. Everyone can transition. Hell, yeah, we can lend to anyone. But no, I'm afraid not everyone's going to survive this. Yeah.
Let me come back just for one thought on the argumentation on the you know, capital charge, the risk and the risk position of this whole story. If you know, we are taking into consideration the societal risk, what you mentioned as well, and considering a brown penalization factor, I mean, we cannot, you know, disconnect the brown assets unless we have a green alternative. We are just increasing with that the transition risk. So, you know, from the risk position and especially the transition risk position, I think it would be very justifiable at first, you know, to build up the green assets, and then the brown assets anyway becoming obsolete. Yeah? So here I think that there is a good reasoning to apply the green premium rather than the brown kind of penalization.
Catherine, if you want to add something.
I completely agree with Ben that it should be on a risk basis. So, we would argue for global consistency, as we always do. I think we're still at a relatively premature stage of understanding risks. In some sectors, some subsectors, maybe some clients in some subsectors, we expect the financing needs to go up, so capital to go up, not down. So I think it just needs to be a carefully evidence and risk-based decision.
Okay, thank you.
Just, can I ask, do you agree that a disruptive change, just phasing out all the coal power plants without having the energy sources to replace it, do you agree that this is increasing the transition risk?
Yeah, absolutely. That's a disorderly transition, right?
Exactly.
So energy security, access to energy is, of course, going to be of premium importance to governments and communities. So, yeah, our objective here is a smooth transition, right?
Good, but then, the brown penalization factor, which would effectively lead to a kind of early phase out of the high polluting assets, including the coal power plant, right? Would just increase the risk as kind of systemic risk on the energy market.
No, no one's saying we're going to switch off the lights, so don't straw man us. I disagree, but anyway, should we have some questions in the audience?
Okay.
So the first question, we kind of discussed about it, but does pledging to net zero make sense at all? It's not possible without offsetting, but these projects are often questionable.
Yeah, so if I may, maybe two words to that, because we don't have much time, but
yeah.
And we discussed already a lot about the carbonization of the credit portfolio, because that's the main challenge, and that's the most difficult part. But I believe there is value as well in the fact that banks are giving a good example on their own emission reduction, scope 1, scope 2, because this is something which will, as well, that they can show to their clients, and somehow it's not very difficult for banks, yes, because it's just electrify the fleet, buy green energy, and then take care of your real estate assets. It's not an incredible effort, but it's a very good example shown to their clients.
Thank you, Tomasz. And the second question, because we don't have too much time, have the banks on the panel used the mortgage portfolio standard to manage the climate and transition risks in their mortgage lending? If you used...
Not that I'm aware of, no.
No, definitely not this one.
Okay. And if you want to just add something else about transition risks, because it's the third question there, how do you manage the transition risk for, maybe, Catherine, you can summarize at the end.
Yeah, I think, well, it's a traditional risk management process, so it's identify the risks, measure them, try and understand them, try and dimension them out, put your metrics in place, and critically, for thinking about transition risk, have that feedback loop back into strategy. I think we can be very focused at the moment on understanding the risks and being asked to do asked to enact the regulatory requirements, but it's also that feedback to what does the bank do differently? What extra capacity do we need to build as a result?
Okay, thank you. And a question for the last one, for Erste. Is Erste planning to finance brown assets for as long as possible, and it's expecting not to be penalized for that?
Okay, let me take this one, because
to keep the lights on.
I see that I,
21 seconds.
I see that I made here too many kind of provocative questions. But listen, I mean, Erste is definitely not financing those companies who are not making the transition, and I can say that very kind of openly. We have had a couple of transactions in a size of hundreds of millions of euros, what we turned down on the credit committee, because they were toward companies who did not commit, to a transition. And we have such a companies here in Czech Republic who are even investing into new coal assets. And on such a companies, we have a very clear policy of not engaging. So that's very clear for us. What I tried here to argue was rather the sense of the things what we are doing and the order of the steps what we need to take in the transition. And on that one, I have a very clear opinion that the green investments would need to have some kind of benefits, because simply, and especially in the SME segment, the clients don't understand still why they should invest into green. And the banks today have very limited opportunities to offer benefits to the clients to motivate them for their own sake of investment. And again, just really underlining what is on the question, we are not dedicatedly financing brown assets, and we are not engaging with those customers who do not want to make the transition out of the brown assets as such.
Thank you, Gabriel, and we are out of time. So thank you so much for this practical discussion. And I guess let's have lunch now.
Thank you. Okay, thank you.
Thank you.
And thank you very much, Laura. Exactly. So it is time for lunch, and thank you for the very frank and very lively discussion. That's I think we are still, you could say, at the beginning of the transition, but it's really nice to see some positive outlook and also some desire to collaborate and actually to share knowledge and share practices. Because I think we all agree that it will only accelerate these discussions, and the challenges and some of these things will very much materialize, I think, as we go on. And with this in mind, I do invite all of you to join us for lunch. And thank you once again, all the speakers and moderators for this panel discussion.
Climate change is a speeding train. It's ramming through stations and headed straight for us. So what's ING doing? We're trying to help slow it down while also preparing for what could happen if it doesn't. It starts at home, so we monitor our environmental impact and have targets to keep doing better. But as a bank, for us it's really about two things: how our business impacts the climate and how climate impacts our business. Our biggest impact on climate is through our financing. ING finances today's society, which means, yes, we do finance things that aren't green, but we also finance billions of euros of green projects and companies around the world. We say a flat-out no to certain businesses, and yes, but to others, outlining sustainability changes they'll have to make first, and then helping them to make them. We innovate with things like sustainability-linked products, where rates are linked to sustainability performance. And we aim to steer the most carbon-intensive parts of our portfolio towards net zero by 2050, financing the new technology needed, like battery storage and newer, greener ways to make steel. This is our Terra approach. Of course, while we try to make a positive impact on climate change and continually strive to do better, we also have to limit the impact of climate change on our business. There's physical risks, like floods and wildfires. And there's transition risks, like what happens to car makers who haven't started making any electric cars once those are the only ones legally allowed to be sold. To be resilient to these risks, we have to identify them, understand them, figure out how likely they are, and what their potential impact could be. Those insights shape our business strategy. We work hard to do our part as a bank, together with our clients, and commend others who are doing the same. But fighting climate change has to be a united global effort. We call upon regulators and governments and others to play their important role as well. We've come a long way, and we know that we still have a long way to go. But sitting still is not an option. We're focused on the future, moving step by step as we aim to make the difference. For us, for our clients, for the world.
Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby, and twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, but I don't wanna jinx it, baby. Let's not get ahead of my time. Oh, but I don't wanna miss you, baby. So I stand up and speak my mind. Oh. Baby, you give me ice and fire. You're chilling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Baby, you give me ice and fire. You're channeling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, 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 oh.
Hello and welcome back after lunch. After the lunch break, hopefully you had some nice break. And we are back here in the third section of today with a very full panel with wealth of experience. And we'll be looking again at financing and how, well, financing of the transition and what are some of the strategies, what are some of the products, some practical solutions that can contribute to the transition of the economy. And maybe without any further ado, because we have a very interesting panel ahead of us, so I will very kindly ask all the speakers to make their way to the stage. So the panel will be moderated by Tomáš Piasecki, Associate Director of Financial Services and Sustainable Finance in Mazars. Please, Tomáš. And then we will continue. So we have Petr Fiala, Head of Trading, Trade Financing and Factoring, Raiffeisen Bank. Please, Petr. We have Ota Melcher, Head of Economics Transformation Unit, Ministry of Finance, Czech Republic. Matúš Půl, Chief Sustainability Officer of Česká spořitelňa. We have Pilar Solano, Director of Central and South Europe, for the European Investment Bank, and Jarek Roth, as well, Chief Sustainability Officer of BNP Paribas Poland. So enjoy the discussion, and thank you very much.
Good afternoon. It is my pleasure to lead on this discussion. Today we have representatives from three types of financial players. We have three representatives from commercial banks, Jarek, Peter, and Matusz. We have a representative of a development bank, Pilar, with us. And we have a representative of the Ministry of Finance in the Czech Republic, Otta. Why am I bringing this? So as you may know, in order to achieve climate neutrality, in order to fulfill the Paris Agreement, a lot of financing needs to be found, needs to be made, and key players in that are financial players. In that case, we can speak of commercial banks and development banks. These players have different roles, and we will discuss those roles. So we are going to talk about transition financing, the main strategies, main products, and solutions. I already mentioned about transition, what it means. To give you a little bit more to this, it's worth remembering what the key long-term goal is of all that we are discussing in this panel. So the key goal is to contribute to the effort of limiting global warming to 2 degrees in comparison to pre-industrial levels, as agreed under the Paris Treaty. This is something that individual countries in the EU committed to, but also EU committed itself. And what EU wants to do, particularly, is to achieve climate neutrality by 2050, which means a serious transformation of all of the key sectors of the economy. So we here talk about energy sector, transportation sector, manufacturing, agriculture, and real estate. And this can only be done with the private sector. The public sector itself cannot do it. According to the European Commission, the EU itself should be investing at least 1.5% of its annual GDP, which is roughly about 210 billion euros per year. Some of the leading advisory firms, they estimate that the world as a whole should spend up to $280 trillion by 2050, which is roughly around $9 trillion a year. So what is the role of commercial banks here? What is the role of banks in general? The same studies, they say that commercial banks should probably facilitate 1/3 of that financing. But we also have to remember that there are other challenges. It's not only about climate neutrality, meeting the Paris Agreement, but it's also about facing the short-term challenges. So here we face inflation, we face the military conflict that we have in Europe right now, but we also face trade conflicts and what is expected to come. So with a great representative of a development bank, the European Investment Bank, which is the bank of the European Union, development of European Union, the first question would be to Pilar. What is, in your view, the role of the European Investment Bank, and what are the current strategies for financing transition?
Thank you, and thank you very much for everyone for being here after lunch. Hopefully you're not too asleep and you got a coffee. So in representing the EIB, I'm not sure how many people know what the European Investment Bank does. Thank you. So just a couple of, taking a step back 1 second. So I'll put a context and I will dive into your question. So we are indeed a bank, an investment bank, but we're a bit of a special investment bank. We're owned by the 27 member states. As it was introduced, we are a development bank. We are rated AAA, and we are slightly large. We have a balance sheet of about €500 billion. We operate both within the EU, but also outside. And our purpose is to develop and bring inclusivity also within the European Union. And so I am saying this because our main core business is to finance projects, provide financing, long-term financing to projects that are contributing to our policy goals, right? And I will get in a second as to how we do this, but in the context of the transition, I'm not sure whether I can bring a factor as a new strategies, because we are consolidating a strategy that we set ourselves out to deliver almost 5 years ago now. We started with our energy lending policy, so that was focused on the energy space, where we consciously selected to avoid financing unabated fossil fuel projects. So on the back of that, fast forward another year, and our ambition grows, and we wish to become not only what we are, which is the EU bank, but also the EU climate bank. So that meant that as of the end of 2020, all the 100% of our financing, which hovers between 60 to 70 billion a year, 100% of that financing is Paris aligned. And it means as well that 50% of our financing contributes to climate action and environmental sustainability. So with that in mind, is our strategy changing? Absolutely not. We are confirming the path we set ourselves out to support, which has been further reinforced by the events last year with the invasion of Ukraine. You may have heard of a program sponsored by the European Commission, which is REPowerEU. And so we have also committed in the space of energy to deliver an additional 30 billion over the next 5 years. So bit larger numbers. Now, how do we get there? As I was saying, we do mainly and foremost long-term lending. That is across the board in terms of client segments. So we do lending through public sector, both sovereign. We partner with the likes of the Ministry of Finance in Czechia. We also support the municipal sector, for example, through sub-sovereigns. We support public and private sector entities, corporates, mid-caps, SMEs, although the SMEs we partner with commercial banks, speaking of the role of commercial banks, and also structured finance or SPVs. So the role and the cooperation with the commercial banks is actually really important for the EIB. For those that don't know, when we finance projects, we finance up to 50%. And so that means we need to crowd in or co-lend with other actors, and oftentimes is with our partner financial institutions. So that is the major thing, but we have changed in that change of strategies in order for us to support even more green financing or transition financing into to a sustainable economy, is we have also fostered different types of instruments to complement our toolbox that is supposed to address and adapt to the circumstances that you were describing. For example, we saw before the increase of the interest rates and the inflation, there was a need for the banks to be supported through capital relief products or de-risking certain structures, and so we offer also guarantees. We also offer, we participate in capital market transactions, sometimes with the banks through securitization, sometimes outright in the debt capital markets. And we also support a great deal of innovation in the green space. The EIB has a program rolling out venture debt, and we are pretty keen in scaling up our clean tech program, We do these things typically supported by guarantees from the European Commission, but we can do a lot of those. Since the onset of the crisis and the increase of inflation and the interest rates, for us, in our counter-cyclical role, we have seen an increased demand for our products and for our support. We are a very patient long-term investor. We also oftentimes transfer our funding advantage to our beneficiaries, so demand has gone up. Our supply is not going up, unfortunately, so we need to prioritize where we invest ourselves. Hopefully, we can liaise and contribute more to the private sector. And so I'll stop there because I think I'm taking too much time.
It's perfectly fine. So you mentioned that the European Investment Bank is setting itself as a bank for climate, right, for financing transition. So there is a clear path set that EIB is part of the EU's, I would say, plan to transition to a climate neutral economy. So it's perfectly in line with EU's plans. A question to Ota to maybe comment on the current EU regulation landscape with regards to sustainability and in terms of strategy for the banking industry and financing transition in Czech Republic in general. So what is your view on the current regulatory landscape, and what is the role of the government in all of this?
Thank you. Firstly, let me say it's an honor to speak at such an important regional event. My name is Ota Melcher, and I'm here represent the Ministry of Finance, where we recently established a unit on economic transformation. It's one of those initiatives of the Ministry of Finance to digest the boom in sustainable finance agenda and the regulation coming from the level of EU. But to address your questions, maybe I'd start touching a little bit on what's our perspective on the banking and financial industry in the Czech Republic, and what are the necessary conditions to unleash the potential of financing the decarbonization. So first, I think what we need is a regulatory environment that's conducive to the transition. We need to set clear rules and procedures and a set of principles that the financial market actors should follow. We also need some kind of a common or shared vision or a view on what constitutes a sustainable investment. And third, I think one of the key elements of the decarbonization and sustainable finance transition is that we need to make available robust and reliable data by setting some kind of like industry-specific or sector-specific data standards. So we all talk about the same points. Now, we see that it's creating challenges for the banking industry and for the financial industry, and what we see that the industry will have to adapt to these developments. And in terms of management practices, internal governance structures, or performance matrices, and the industry should prioritize the sustainable investment by identifying sustainable activities and investments. And I'm mentioning these because when we look at this from the side of the government, we have some kind of similar challenges. The government also has to prioritize sustainable investment, and I mean across the policy making, whether you negotiate about preparation of the budget, whether you negotiate about energy policy, whether you negotiate about sustainable transport, whether you negotiate about construction and housing, we have to reflect sustainability principles in all these preparation. Government should also focus on supporting green infrastructure. This is one of the key pillars, how to leverage also sustainable finance activities in the private sector by showing the way and making sure that the public expenditures devoted to infrastructure spending are invested in line with these principles. Next element I would mention is that the government should be very active in kind of educational and awareness activities in terms of making known to the financial sector participants, but also to consumers what are the risks and opportunities coming with together with the transition and sustainable finance agenda. And this way, we're trying to build some efficient platforms how to discuss and negotiate the upcoming developments with other departments in the government, but also with key stakeholders in the financial sector. And we would like to build on these initial discussions that we had with a number of financial sector participants and representatives of the financial sector, and build something more robust as a discussion and exchange platform in the future. Now, back to the legislation changes that are coming. I think yesterday I've heard you had a very nice discussion, a robust discussion on the EU taxonomy, so I'm not going to spend time on this. It's a kind of a classification system that builds what we call a common language around like how to identify and categorize sustainable investments. This will be a very important element coming from the EU. It's complemented by some disclosure tools, some reporting mechanisms. This will be very important and challenging for the private sector. First, it's the directive on sustainable finance reporting, which will make the kind of reporting on sustainability performance of companies mandatory. And the other one for financial sector participants, and this is the sustainable finance reporting regulation, which will mandate financial sector players in terms of disclosure on how they kind of reflect on sustainability risks in their activities. And a fourth one, it's a couple of standards that are under negotiations or on which negotiation has been already concluded. One of them is the EU green bond standard, which kind of unifies the view on how sustainable bonds are being issued and what are the minimal thresholds or minimal conditions that should be fulfilled by these. Within the Ministry of Finance, we work on transforming the developments on the EU level into the domestic legislation. So we are currently working on the legislation on accounting and legislation on auditing. I might come back to our further activities if there's time, the discussion.
Perfect, thank you very much. So you mentioned the key regulatory developments in EU taxonomy, disclosures, green bond standards. I can add the ECB climate stress test. So this is all part of the sustainable finance landscape. Pilar mentioned that EIB aims to be the development bank of Europe for climate change, for climate transition. And in all of this, it would be very interesting to hear opinions from representatives of commercial banks. So given that EU has a clear vision on how it wants to get to climate neutrality, it has started to set regulations around this. How do you find yourself in all of this as a commercial bank? What sort of solutions do you bring, and how do you see your role in parallel, for example, to what a development bank can offer to the market, to the different industries? Petr, if I could ask you.
Thank you for the question, and thanks for having me here. I feel really privileged to be part of this summit, and I feel very privileged to speak on this panel with such individuals and the speakers as you guys are. The role of the banks, especially in the, not especially, but in the CEE region, we have to understand that basically the banking sector is playing a critical role in financing the transition. I'm not saying that we don't need the governments, that we don't need multilateral banks, but the key and the most critical role will be played by the banks. Therefore, all the environment which we have to create to support this transition is based on several stakeholders, and those stakeholders and those pillars in the transitions have to communicate and have to have a dialogue. That's why it's important that these summits are taking place. That's important that we have a dialogue, even though some of the pillars are having the more critical role than the other ones. We will see a huge development in that in coming year, especially within the solutions and the products related to the sustainable finance. A huge development, a huge evolution. The question which I'm asking to myself always is, do we need to create a new product, or shall we use properly the products and the solutions which are already in place in the other countries, in the other regions? Let's take the example of Czech Republic. Why the example of the Czech Republic? Because I'm from Czech Republic and we are sitting in the Czech Republic, so that would be the easiest way to take the example of that. Because the new versus innovation of the current products will be different from each another country, because the Austria, for example, from the region is far away or ahead of the other regions like the Czech Republic or the kind of countries, like Czech Republic, Slovakia, Romania, Poland, whatever. So they have a special role, and I think we, from the regional perspective, we can consider them as a trendsetters in sustainable finance. That's what I always appreciate, that we talk with our colleagues from Vienna, because we can just copy paste and repeat what is already successful. But what happened in the Czech Republic? The most of the transactions which were realized in sustainable finance the last couple of years were green asset transactions. Why? It's absolutely natural, because there is already a clear guidance what asset is green, what asset is not green. So, and you can prove it. Yeah? So that's why basically all the banks, if they were providing the sustainable finance products, it was very much related to the financing the assets. While in, or actually that's why basically if you look at the portfolio of green assets and the portfolio transactions in the banks in the Czech Republic, you will see plenty of real estate transactions, you will see plenty of renewable transactions. But then we are focusing only on not a small, important, but still couple of the pillars. We need to go more on the top, on the overall balance sheet of the companies. That's why I'm a big fan of sustainability linked transactions. This is what can play a significant and very important role in the future, because then you have a clear strategy and you have ambitious targets. And that's where innovation will take place. Because if we again will stay with the example of the Czech Republic, sustainable strategy. How many companies already have sustainable strategy in the place? Not too many. Yeah. Obviously, this is far better than it was 2.5 to 1 year ago, when my colleagues, which they are sitting here in the auditorium, were visiting the clients 1 year ago, because we established the team which is really advising and advocating ESG topic to the corporate clients. When they were talking to the clients 1 year ago, it was more about, you should take care of that, explaining what sustainability means, what ESG means. Yeah? Now the discussion with our clients is absolutely different. It's more, we have a sustainability strategy, please the bank look at that. Is it correct? Is it not correct? How you would shape it? What kind of KPIs we should apply, and etc. Yeah? So this is a huge development. And then the ambitious KPIs. Ambitious have two brothers. Yeah? One is naive, and one is secure. I'm not saying that we should implement ambitious KPIs, which are absolutely naive, which we will never fulfill. And now we are pretty much in this space because there is not methodology, there is no standardization on the market. We don't know what the KPI is relevant for steel industry in North Bohemia, South Moravia, in Romania, in Poland, whatever, because each and every region has a specificity. Yeah. So we need to be very careful with the KPI setting. That's where the innovation has to take place. And that's why I'm very happy that initiatives like science-based targets is in place, because this is exactly the way to go. Yeah. And we've heard on the previous panel how many companies in the Czech Republic already have science-based targets in place in the Czech Republic. Yeah, too. Yeah. It's not a victory, yeah, by the way. So this is why it's very important to have this in place. But what I just explained is related to the copying and innovating sustainable finance debt instruments. There is another sphere which will play even more important role in the future, in the coming future, and that's transaction banking. Something what will happen in coming years, and I don't know if that will be next year or in 3 years, 5 years, I don't know yet. But the sustainable global transaction banking will be a catalyst, will be something what will leverage all our efforts and actually help even the sustainability strategy of the companies. And when I'm talking about sustainable global transaction banking, I'm really pointing to all the aspects of the transaction banking. Trade finance, guarantees, letter of credits, which are related to the transactions or which have a positive effect in the transition. All the techniques in the supply chain finance, that's the very important in the Czech Republic and in the region, because we are not living in an isolated place. We are very much connected. Czech Republic is export-oriented. All our companies are part of the supply chain. So basically, if we implement the sustainability within the supply chain finance, then basically we have immediately data which we can analyze, which we can use, and which we can evaluate if we are heading to the right direction or not. So basically, this is a complex task which will come in the future. But transaction banking will play a very much crucial role. We can talk about the deposits, we can talk about the other products, but sustainability has to be there.
Okay, thank you very much. So interestingly, you mentioned sustainability-linked bonds, loans, trade finance, different solutions that you can find in these types of products. A very similar question to Matuš right now, also related to sustainability, your experience with sustainability as a representative of the biggest Czech commercial bank. We mentioned already a few products, but maybe you could mention some other products that maybe are developed for some smaller clients, because we not only talk about banking for large clients, big companies, but we also have SMEs, we have retail clients. Maybe you could share some insights on that.
Absolutely. Thank you, and good afternoon. When we are the biggest retail bank in the country, and when we were thinking, what kind of impact we can do and what our customers need in this time of 3 crises in a row, maybe we can take this as a new normal. So we have to be ready for what's coming, and our retail customers, we can see that a lot of them are really struggling, and there is a growing share of those customers who are not making money, not making enough money every month to meet their needs. We have started 2 years ago a program to grow the financial health of our clients, because we think that it is really important to strengthen their standing for the social cohesion of the country. And we also think that by building their financial basis, we will build also their capacity to tackle also environmental issues. And when I come back to environment and climate, the largest impact that we all have is our housing. So how we live, especially how we heat our homes. So we think that the key initiative is energy efficient mortgages and energy efficient renovation loans. And we have launched energy efficient mortgage more than a year ago. We see a growing number of people and growing interest in this. When we were developing it, that was before the Russian invasion. We were thinking how we are going to sell this to these customers. Why would they invest into energy efficiency? Unfortunately, we don't have that problem. So now the problem is how to make it available for the people so that they can really take. It's an enormously complex project to renovate your house. If you know, how many of you have tried that yourself? Yeah. So I have a university degree and it wasn't enough for that. So to make it simple for the client and to also make it more affordable, together with the state, we have a very good state subsidies, and we are also looking for enhancing the role of the building societies. Stavební spořitelny play in the renovation. So this is for retail, and for the SME clients, it is a very complex task to understand what is going on with the green transition and how how is it relevant to them. There was a poll about a year ago asking people about what they think about the Green Deal, whether they support it. It was roughly 40% of people that said that supported in Czechia. But then if you break it down and ask them, do you support clean energies? Do you support less hazardous materials? Do you support energy efficiency? And then over 80% say yes. So it's all about explaining these concepts to people and making it relevant for them. So we believe we have a role to play in explaining our customers how the transformation is relevant to their particular business. Yeah. And it will be different in all different industries. Czech economy is very sensitive on subsidies. So basically, people and businesses do what is subsidized, and that is very true in the green transition. So we are linking our advisory with the subsidies in circular economy, in water, in energy efficiency, in renewable energies, and also with some benefits on funding, making this a package that is easy for the businesses to understand and to manage. So, and I think that there is still a way to go for us, and it's also, and we combine this with our decarbonization effort, because you have to on the portfolio. If we look at the portfolio and manage the emission and measure the emissions, there you can see where we have the risks, but also this clearly shows where the opportunities are. So that's what we are trying to do, set up decarbonization pathways, and then on these high-emitting sectors, find targeted solution combining advisory, subsidies, and loans.
Thank you very much. So we spoke about facilitating different industries. So depending on the sector, there are different challenges in transition. We spoke about different clients and what those clients face in terms of challenges of transition, size, type of clients. We spoke about the fact that there are products that can be developed that can facilitate the transition, about creating new opportunities, but transition is also about moving out from certain sectors and probably divesting rather than investing. A question to Jarek. What is your view on setting limits to fossil fuel financing or carbon-intensive sector financing?
Super, thank you. Thank you very much for this question. Thank you for an invitation. Actually, I don't know. I'm the last. That's why I'm receiving the less sexy question. This one, because I would really like to focus on the business opportunities, and I will switch to this part. But being serious, of course, that's an important topic. So it was already visible in previous panels that we have those two sides, like stick and the carrot. It's true for the banks in terms of the regulations, but some programs looking at EIB and Pillar, but also on this positive side. So for clients, it's true as well. So there are those two elements, and looking at the science, there is no space for a discussion, right? If you look at IPCC, if you will look at International Agency for the Energy Agency, the message is very clear, and this is science-based, so it's not democracy. You cannot argue with this. The fact is that we have to limit the emissions, which means that we have to end up with the fossil fuels. And we will not succeed on this point if not having strict policies, especially within the commercial banks linked to this point. So in BNP Paribas, we have already in 2015 said that we are not engaging in new coal-based projects, transactions. We have a very clear strategy, exit strategy from coal. In 2030, it will be full exit, and this is in line with the pledges given and in line with the Paris Agreement. And we have to remember that more than 60% of global GDP is already subject to the pledges, net zero pledges. So we have to follow this. Having said this, I would like to come back to general topic, because when we are discussing this, at least myself, I have the feeling that we are talking about this very heavy duties or penalties when we are talking about the transition. Whereas it's really about the opportunities. Of course, there are challenges for sure, plenty of them. But there are also opportunities, especially for our region in which we are. And I'm a very big fan of certain simplification of topics. If you will look, for example, at Repower EU program, this is investment plan for 300 billion euro investments till 2030. If you will look at the details, 96% of this investment plan is focused on renewable energy and energy efficiency. So we should be doing the same within the banks, translating those directions into products, our knowledge, advisory for clients. We have a very interesting case in Poland. We have more than 5 million of single-family houses in Poland. Within the period of, let's say, 3 years, 1.2 million houses were installing the individual PV on the roofs. 1.2 million out of 5 million, roughly. This is huge. We have reached, in terms of photovoltaic installed power, we are more than 12 gigawatts of installed power. We had something like, I don't remember by heart, but like, 4 or 5 gigawatts in the official plan for 2030. So the plan that was created a few years ago is completely exceeded by the reality. And the question is why those people have decided to do so. I mean, they are all science-based and very care about the environment and very aware of all these facts. I doubt it, right? So there was a very simple subsidy being created in Poland, covering around 20% of the cost of the installation. And then, of course, there was commercial banks providing the financing. And for the people, it really paid off. I mean, they were looking, okay, these are my bills. This is the investment. So I will be repaying this. And in fact, my saving will cover most of the installment. So yes, let's go for it. The return on investment is very short, like with the subsidy, 5 to 6 years, okay? And we should be doing this. So we have to, in Poland there was this false, maybe true at the very beginning, but false concept created, a little bit of mathematics. So there was a triangle in which there was, in the climate, the cost, so efficiency, and the energy safety of the country. And there was a concept, we can't do everything. I mean, we have to choose, right? Right now, actually, if you look at the renewables, if you think about the cost, this is the cheapest energy source. If you think about the environment, this is pretty obvious. And also, after the war in Ukraine started, if you look at the new understanding of the energy safety, what is more safer than photovoltaic panels on every single house and the windmills around the country? You are really immune to different scenarios. So I believe we should really focus on the simple things. We should separate the cost from investments, and this is very important. We've been discussing that 1.5% of GDP should be roughly used or spent on the investment supporting the transition. In Poland, there are different estimates. We should go for around 70 billion Polish zloty per year of investments. Huge. But on the other hand, there is a question, what Poland spent on fossil fuels? And it occurs that last year, it was almost 200 billion Polish zloty that we paid. And this is, one-time ignite, fired, and only polluting the atmosphere. So I really believe that this is a big business opportunity in terms of transition. We should simplify, and we should really focus on those main topics like renewable energy and energy efficiency. It makes sense. In the cases it doesn't make sense fully commercially, then this is the role for the state, for the blended finance, to combine our forces and to create programs, guarantees. In the previous panel, there was a discussion about the risk weighting and the capital absorption, very important for banks. If you have a guarantee, which is covering that kind of portfolio, from the state perspective, for this guarantee, commercial banks are happy to pay. So in fact, this is not something that we are giving as a subsidy. This is something you are, in fact, earning money on. But for the banks, if you will compare the product covered by the guarantee and not covered, you can decrease your interest for your clients, but having this pay for a guarantee, but after this, you still will have much higher return on equity on this product than for other. So there are plenty of solutions that could be created, used to make those investments really attractive economically. And this is the way we should be, that's what I believe we should be promoting, not necessarily, I mean, the education, of course, on the climate, etc., but through the simple financial motivation. Sorry for a long answer.
May I just add to that, because that was very interesting. All the speech was interesting, but especially like the last part. With having the institution on the local governmental level, on the EU level, which provides guarantees or the insurance. Look at the export finance industry. Each country in the Europe is having ECA, Export Credit Agency, supporting the exports from that country to the other country. And this is exactly the products which you just displayed. Risk mitigation tool in the terms of guarantee of or the insurance. How many such institutions do we have in the Europe for transition of the economy to sustainable? I don't know, except with one exception. Yeah? But you are focused only on the long-term transactions. We need something what is more for the small SMEs, because core of our activities, core of our economy is based on the SME clients. So we need something more. Let's put it flexible. I'm not saying that your institution is not flexible.
We're super flexible.
That's what I'm saying. Sorry for that.
No worries. Pilar, would you like to add something?
No, I think maybe I went through a bit fast, but that's part of the objective. So when we partner with financial institutions, we look at what the financial system operating with smaller beneficiaries are requiring, right? That's why we select whether it is going to be a funded line, a credit line, or we go through guarantees, precisely to de-risk a portfolio, or even packaging portfolios of exposures and selling them outright through securitization. So it depends on what the bank needs to lower the cost so that they can pass that benefit on to whether it is the exporter or it is the SME or it is the household for the energy efficiency. I think in our observation in the energy efficiency space, I have to say we had been struggling a lot for many years to make headways into the energy efficiency space. I think there's still a lot to do, and the gap is humongous, whether in the retail space, SMEs across the board. But our observation, and that's the point I wanted to make, is precisely what Jaro was saying earlier. Last year was a turnaround moment for that space, I think. And it's on the back of the crisis. I mean, most of Europe, this is not specific to Czechia, it is not specific to the region, that cuts across the entire Europe. The business case all of a sudden made sense. People were looking at their energy bill compared to the investment that you have to make. That's brilliant. And we should take opportunity of that and roll it out at scale, because that's going to have a humongous impact.
Very well, thank you. Jarek, you brought some very good points. You mentioned the opportunities that are there. The program that you mentioned, please correct me if I'm wrong, but it was a program developed by the government, right? So it was a governmental initiative where the commercial banks stepped in, and in a way the market was created for that. So what obstacles do you see in grasping some of those opportunities? What players in the financial industry, should it be the government or maybe some other institution? What these different players should do to facilitate, to be able to grasp some of those opportunities better? Would you like to add something?
I can start. Maybe I can start, and
yes, and then
will be supplementing.
Sorry.
But of course, it depends on the business segment. So completely different, and it was already said by Matusz, completely different need for support will be with the retail individual clients, especially when we are talking about the big thermomodernization projects, and the support should be much broader, not only subsidy financing, but also the technical advisory, which, by the way, also in many programs is financed through EU programs, grants. And completely different discussion based on sustainability-linked financing with the top corporate. These are completely different levels and different skills, know-how, knowledge needed from the bank. So retail and SME much more subsidized, and this is the reality. It was also said by Matusz that those clients expect that kind of approach. And here the cooperation, with the SME, it's relatively easy to implement those subsidies, whereas for individual clients, especially for more difficult projects, stronger cooperation between the public and private side is required. So answering your question, depending on the business segment, but the cooperation, like under 17th of Sustainable Development Goals, this is key.
Very well. So here we use an example from Poland. I don't know if you, Ota, could you bring a similar example from Czechia, how government facilitates some of the markets, helps create a financial product?
Well, I believe there's a number of initiatives in terms of providing subsidies and incentives into investments that should lead to a higher energy efficiency. All these frameworks of refurbishing the houses just because of the kind of structural issues of the housing fund that we have not only in the Czech Republic but in the whole region. It has a lot of common issues. If I come back to one of those points, I want to underscore is that we definitely understand the private sector to be the primary mover in terms of the transition, in terms of financing the transition. From the side of the government, we like to play a role of facilitator or a broker that sets a kind of transparent and clear regulatory environment. And part of it is, of course, some kind of incentives and subsidies to encourage sustainable investment. But what's very important is also to avoid or to remove elements that discourage sustainable investment. As a part of this, one of the important points that Petr mentioned is that we would like to screen the current existing disclosure and reporting mechanisms that are currently in place and see to what extent they comply with the new requirements coming from the side of the EU, because some of them are already used by companies and by financial sector players. And this would allow them to kind of follow up or build on something that they already know. One of these things that you mentioned, Piotr, it's a very important issue in kind of making the housing sector more sustainable with all these investment into renewables and energy efficiency. Ministry of Finance is part of quite a robust modeling exercise that's currently in place in the Czech Republic. It's organized primarily by Ministry of Environment, but other key stakeholders like Ministry of Industry and Trade are playing their important role too. And this is a couple of models working together, and it's a very important exercise because it informs these currently revised two key conceptual documents, which is the state energy policy and climate protection policy. And one of these preliminary outputs of this modeling exercise is an information that, given that gas was primarily meant as a transition source of energy before the Ukrainian conflict, and now the kind of taking up the renewables is much quicker, and it's accelerated. And in terms of all these requirements that this will mean, we have an information that, for example, there's going to be 10% to 15% additional workforce needed in the construction and building sector to install all these heat pumps and photovoltaic. And these are very important information that we need for medium-term to long-term strategy planning in the government sector.
Very well, thank you. Conscious of time, I suggest very quickly if each of you could summarize and maybe bring some remarks and think of a way forward with regards to transition, how to speed up the transition. So very quickly, a few remarks.
Master plan. We need a master plan on a European level. We need a master plan on the Czech level, on the CEE regional level, and for the industries. Unless we have a master plan, then we don't know where we are heading to. Right? Then transparency, methodology, simplification. All the players are really playing their role, meaning the state policy, which is transparent, regulatory framework, risk mitigations, which we touched already, incentives, and the commitment from the government. Commitment which goes beyond the election period.
Thank you very much.
It's a difficult...
Please.
All of the above.
So it's difficult to actually, you mentioned all the possible elements. I mean, from our side, I guess I can say we're open to cooperation on all these important initiatives. We definitely need a master plan. Our thinking is about providing all the key stakeholders with some conceptual documents like the sustainable finance strategy of the Czech Republic. We're working with the European Commission number of projects that should help to deliver this conceptual thing. But I guess it's really cooperation, working on like shared understanding and common vision of where we should go and what different stakeholders should do in this process.
Thank you. Pilar?
All of the above? No, I will choose three. Two I'm echoing, actually. One is all for collaboration of all actors involved. That is critical, everyone on the same line. Second, I think people are suffering from an overdose of concepts and spread of different standards. It is about standardization and simplification. That one I greatly echo. We're all getting an overdose. It's a tsunami of legislation, a tsunami of regulation, a tsunami of all sorts of things to amaze to make anything clear of. But the third one that I wanted to bring to the table is also innovation. I actually am relatively new to this region, and I think it has such a potential. And it has a potential in very many different respects, in vertically integrating into manufacturing and getting an industry out of the transition. And I think there's a lot of youth and talent and potential also to innovate. And Europe needs, guys, a lot of innovation to really scale up solutions that we will need to really get to net zero. And I really hope and I trust that this region can play a key role there in innovation too.
I do agree.
Thank you very much.
I think we need to get people aboard and not to leave anyone behind. Yeah, because it should not be just for the rich, and it should not be just for the fast ones. There are, of course, opportunities if you adopt faster, but even if you're slower, we should drag you along. And to achieve that, I think we need much better communication of these issues. Yeah, so communicate really the solutions and opportunities that are there.
Eric?
Yes, so my first comment would be, Poland specific. So here the clear leadership on the political side that's pretty obvious. We are missing this,
strong direction and consistent, that's the voice. And the second point, because I also do agree with all the points mentioned by you, I would also say about this data, it was all well covered in the previous panels. We haven't been speaking too much about the data, but this is also an element that would easier our life.
Thank you very much. So a few last words. We spoke about the role of governments, development banks, commercial banks. We spoke about different products, different solutions, different strategies. We spoke about the tsunami of regulation. But we simply also have to remember what is the setting and what the problem with this particular transition is, because the economy has been going through various transitions over the last hundreds of years, right? It's a kind of structural shift. I think that the challenge here is really timing. What sort of reality we want to end up with? Do we want to end up in a reality in which we will have to face even more risks coming from some of the physical changes, or do we want to tackle some of the transitional risks right now and diminish the physical risk of the future? So that's a question. That's something that everyone has to answer. And here we come to this question of speed, right? At what speed all of this should be really happening. Thank you very much. Thank you for listening to us. Thank you for joining the panel. And I guess now we are looking to a break, right?
Yes, exactly. Thank you very much for helping with my job as well, and it's no, it's good. This I think has been actually a very, very constructive, really forward-looking discussion, and it's really nice to see the consensus on the collaboration, which is amazing. Also, Pilar, I'm going to steal "Tsunami of Regulation." I'll definitely will start using that one. But it's really nice to see, I mean, especially to have actors on different sides and different parts of the financial industry and financial system, and I think especially for sustainability topics and climate risk and what it means and the impacts on the capital markets can be very complex. So I think especially going across sectors and actually going across different groups of people and society. So that's why the collaboration, I think, is key, and it's really nice and really inspiring to see that this is the consensus here. And I agree with Mateusz as well, and I'm glad you brought retail into the discussion, because exactly just transition and retail clients and small SMEs are at the core of that transition, so we cannot forget about that. And talking too much now, but exactly as you said, we will have a 30-minute break, and so enjoy some coffee and some refreshments, and we'll be here in, I think, approximately maybe 2-3 minutes after 3. Thank you.
Thank you.
Climate change is a speeding train. It's ramming through stations and headed straight for us. So what's ING doing? We're trying to help slow it down while also preparing for what could happen if it doesn't. It starts at home, so we monitor our environmental impact and have targets to keep doing better. But as a bank, for us it's really about two things: how our business impacts the climate and how climate impacts our business. Our biggest impact on climate is through our financing. ING finances today's society, which means, yes, we do finance things that aren't green, but we also finance billions of euros of green projects and companies around the world. We say a flat-out no to certain businesses, and yes, but to others, outlining sustainability changes they'll have to make first, and then helping them to make them. We innovate with things like sustainability-linked products, where rates are linked to sustainability performance. And we aim to steer the most carbon-intensive parts of our portfolio towards net zero by 2050, financing the new technology needed, like battery storage and newer, greener ways to make steel. This is our Terra approach. Of course, while we try to make a positive impact on climate change and continually strive to do better, we also have to limit the impact of climate change on our business. There's physical risks, like floods and wildfires, and there's transition risks, like what happens to car makers who haven't started making any electric cars once those are the only ones legally allowed to be sold. To be resilient to these risks, we have to identify them, understand them, figure out how likely they are, and what their potential impact could be. Those insights shape our business strategy. We work hard to do our part as a bank, together with our clients, and commend others who are doing the same. But fighting climate change has to be a united global effort. We call upon regulators and governments and others to play their important role as well. We've come a long way, and we know that we still have a long way to go. But sitting still is not an option. We're focused on the future, moving step by step as we aim to make the difference. For us, for our clients, for the world.
up my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby, and twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby,
Okay, and we are back after the short break, and we will kick off the next part of the day with a video message from Valerie Smith, who's the Chief Sustainability Officer of Citibank, who recorded a message for us from New York City, from their headquarters. So I think we can start with the video from Val, and then we'll move to the next parts of this section. Thank you.
Hi, I'm Val Smith, the Chief Sustainability Officer at Citi. Thank you for the invitation to speak with you today. I'm sorry that I'm not able to join you in person and to see the beautiful city of Prague, but I appreciate being able to join you virtually. I can see from the agenda that you are touching on some of the priority areas of focus in the sustainable finance space, certainly for Citi. The ripple effects that we are seeing from European sustainable finance regulations, the impacts of sustainability disclosure standards like the ISSB, the importance of considering social elements within the broader ESG agenda, and the incredible amount of change and pressure on financial institutions as we grapple with everything that is coming at us, operationalizing our net zero commitments, growing our sustainable finance book to meet the demand and opportunity, and explaining our transition plan to investors, regulators, and other stakeholders. I spent the first decade of my career in the nonprofit sector, serving in the Peace Corps in Honduras and working for different environmental NGOs. I joined Citi 19 years ago to work in what was then a relatively new sustainability function. Even then, the few of us who are in this new sustainable business field believed in the inherent business connections with sustainability, that it was about better managing risks and it was about business growth and opportunity. Now we are really seeing that concept take root, and we certainly are seeing and feeling that shift at Citi. Probably nowhere is that shift more evident than through the lens of our net zero commitment. As part of our net zero plan, so far, we have set targets for 6 loan portfolios: energy, power, automotive manufacturing, commercial real estate, steel, and thermal coal mining. And these targets are climate science aligned and consistent with 1.5-degree pathways for each sector. This commitment is requiring us to assess where our clients are in terms of their decarbonization, to understand their transition profile, and identify ways that we can help to support their journeys through transition finance. The duality of our position, that we have a strong and global presence in carbon-intensive sectors, and that we have strong emissions reduction targets for each of those sectors, has really created a powerful incentive internally. We have restructured key businesses to meet this opportunity and grow our transition finance business. I'd like to conclude by underscoring one of the themes of this summit: the importance of ensuring that social issues are top of mind as we lean in on the energy transition. I'm thinking both about the workers and communities that can be left behind as the energy system decarbonizes, and I am thinking about the low-income communities around the world who contributed the least to this climate crisis, but are already bearing the brunt of its impacts, from droughts, flooding, and other extreme weather events. I believe that the only transition that is possible is a just transition that ensures access to energy and access to opportunity, and that they are both widespread. Thank you so much for your time, and I look forward to hearing about how the rest of the summit unfolds.
Thank you very much as well. Val couldn't be here in person. We are hoping that that would materialize, but it didn't work out in the end, so hopefully next year. But also still, thank you so much for at least sending the kind message. And again, very forward-looking and really, really positive as well. So now we will move to the next section, which it's a keynote speech which will be delivered by Peter Sweetman. If I can ask you to come to the stage. Peter is the Chief Executive and founder of Climate Strategy and Partners, and he will tell us more about the EU Renovation Loan, to which he was one of the architects. And we already touched on buildings, even in the previous discussion, and buildings and energy efficiency as some of the most important strategies for climate mitigation. So very curious to hear more. Thank you.
So thank you, Julian. And thank you, Linda. Thanks, everyone, for inviting me to give the speech here in Prague. And thanks also for having me patiently on your advisory board since you set up. It's been a wonderful thing to be a part of the growing of this really successful organization. So just to get you in the mood, I'm certainly going to do in this 15 minutes, I'm going to break the 3 cardinal rules of keynote speeches at conferences. The first is I'm going to tell you something you don't know, giving away all the intellectual property. The second thing I'm going to do is I'm going to tell you something very specific, which is an opportunity the size of which will change everybody's life in the room. And the third of which I will do is connect it directly to the comments that the previous panelists said. So in the last panel, Matus from Česká Bank said he talked about the potential that they had found in their own mortgage book. Then Jarek said, among other comments, that in Poland, they looked for a climate opportunity for which would really pay off for the people. And Pilar then said that since a year ago, the energy crisis has created a humongous opportunity for renovation. So let me tell you straight off the bat that the size of the opportunity is 2 trillion euros. 2 trillion euros. And just to conclude with the concluding remarks of the prior panel, every master plan needs a financial instrument to match. And that is what I'm about to tell you. So, this is a photograph of me. These are my clients, and I've spent 31 years in investment banking, private equity, and climate-related consultancy. There are 3 sections to this keynote. I'm going to tell you the things you need to know to understand how beautiful and brilliant the product is. I'm going to tell you what the product is, and then I'm going to tell you the things that need to happen for this 2 trillion opportunity to be unlocked by this financial product. So, buildings. Buildings have a very long useful life. Most of the buildings which are currently standing in Europe will still be standing in 2050 when we have to be in a net zero emissions economy. They use 40% of our energy. They emit around 1/3 of the greenhouse gases of our continent. Most of the heat that is used in buildings comes mainly from burning fossil fuels. And there is nothing that technically prevents our buildings from being efficient and aligned with our climate and energy targets. However, today, 75% of them are inefficient. Now, those of you thinking, so in the last panel, a panelist asked you to raise your hand if you tried to manage a renovation project. What I'm going to tell you is that 10% of the room should have raised their hands because 9% of homeowners renovate something in their house every year. Now, that may just be changing the boiler or repainting a wall. So let's not get too excited. That's just something in your home. Now, 1% of renovations impact energy performance. That could be changing the windows, installing some extra insulation, or changing a boiler. However, just 0.2% of the renovations that happen in Europe are what we would describe as being deep renovations, or the renovations that are needed to align a building to its net zero 2050 standard. The second thing you need to know about buildings in Europe is how many there are and how they're financed. So there are 131 million buildings in Europe, of which around 100 million are residential and the rest are commercial. Those buildings are worth, the residential buildings, the 100 million residential buildings are worth about 17 trillion euros. And most of us in Europe, 70% of us in Europe, live in a home that we own. The total amount of residential mortgage debt that there is against all the homes in Europe is between 6 and 7 trillion euros. So when you subtract the debt, 7 trillion, let's say, from the value, 17 trillion, you conclude that there is 10 trillion euros worth of home equity in the residential buildings in Europe, against which we need to borrow 1/5 in order to renovate the buildings in Europe that have to be done in the next 30 years. So, for those of you who are interested to know whether or not the public sector can lead on this, just 8% of those residential buildings are owned by the public sector, so it's not nothing, 21.5 million, a substantial amount, but not what's needed for the entire building stock. And for those of you who are thinking that a lot of these homes may be unoccupied because they're at the beach, 15% of European households own a second home. So when I talk about the EU renovation loan, I'm talking about a financial instrument that deals with the middle of the distribution curve. So very often in the energy efficiency discussions, people love to talk about the end cases, the ludicrous cases so either these are the people who can't afford to heat their homes at all, or the people who live in palaces and don't care what their energy bills are. I am talking about everybody else who sits in the middle, the people who own a home, who can borrow against the home, and according to our calculations, there's about 50 million of those, and they live in it. So let's just deal with the 50 million. Why the 50 million? Because 35 million of those, according to the EU renovation wave, are expecting or need to have their home renovated before 2030. What do people think about renovation? So, according to this big survey done by the International Union of Property Owners, 44% don't want a renovation because they don't think they need it. Fine. 44% don't have the funds. So they want to do a renovation, but they don't think they can afford it, or they just don't have the money. Below 10% saw some confusing issue about lack of information, lack of qualified services, etc. So a lot of the kind of excuses that you often hear sort of like don't really appear, at least in this survey, to be the kinds of reasons why people aren't renovating. Of course, we don't know what not having the funds really means. Some people say that may mean not being paid by the government to do it, and some people think that just means not being able to have access to a loan. However, there is one thing which will never convince somebody to do a renovation, and that is if it doesn't make any economic sense. So this is important to understand because, to me, this influences the instrument design, which we're about to discuss. So this graph looks at a survey that was done of the per meter squared renovation costs for both medium renovations and deep renovations. So it's two graphs on the same picture. The dark blue area is the cost of a medium renovation in south, west and northwest, southwest and northeast and central. So depending on where you are in Europe, the renovations cost different amounts. Deep renovation, the light blue, so the higher of the two figures in the background, medium renovation in the dark blue. And that is offset against, on a euro per meter squared basis, the yellow bars, which are the discounted present value of all the energy savings, assuming that you save 50% of the energy costs. So that would be, if discounted at 3%, which is the discount rate that's been used here, that would be the amount of value you would perceive if you were using a 3% discount, thinking about 30 years worth of energy savings. Added to that is a green bar, which is 5% of the value of your home. Why? Because if you take a home from being inefficient to being efficient, its value goes up. How much by? JRC says 3 to 8%, EFIG says similar numbers. I pick 5. So when the bar is higher than the blue, that means that an economically sensible deep renovation can occur. And this is the reason why they don't. The reason why they don't is because the yellow bars, if you use a 15% discount rate, which if any of you have read behavioral economics would understand the reasons why. So these are the kinds of discount rates that people use to judge everyday decisions. They do not use 3%. So how would we get, so in this instance, the economic calculation that's going on inside a homeowner's head about a deep renovation just doesn't make economic sense. So that's why they changed the boiler. Because just one element of a deep renovation might make sense, but the whole deep renovation may not make sense if you use the wrong discount rate. So how do we solve for that? Well, we have a new financial instrument. This is the definition of an EU renovation loan as put forward by me. So that is an EU-backed, privately contracted, collateralized loan that provides all homeowners fair and equal access to long-term financing for the deep renovation of their home. The funding is provided on a zero coupon basis, which I'll explain, with repayment of principal and accrued interest at EU borrowing costs upon the earlier of transfer, sale, or its 30-year maturity. So we'll dig into that. You don't have to remember it. They'll also send you the presentation afterwards. As I said, I'm giving this stuff away. So the zero coupon structure. For all the customers and clients who are forever confused about whether or not the energy savings will pay the interest and the principal coverage of the loan that they just took out for their deep renovation, that calculation in this structure just goes away. So here you have to imagine that a lot of the home equity is built up by older people who can't access new mortgages, let's say, a classic EU renovation audience. So older people, they want to do a deep renovation, they want to save energy costs, they've got limited pensions, they've got no savings, so they want to borrow home equity to do a deep renovation, which may have accessibility thrown in because they want to stay living in their home as long as they can. It's a zero coupon structure, which means that all the energy savings flow immediately to cash because they're not paying interest or repayments at any stage during the 30-year period or up to the point at which their home, they are deceased and their home passes on, or they sell their home and get the cash and can pay back the loan. So the interest accretes, it accrues on top of the principal, and it's paid at the end. There are several interesting and good features to do with that, which will also involve the fact that you can't default on a zero coupon instrument. Because if you don't have to pay anything back during its life, you cannot default, which means that the originating bank doesn't have to watch you to worry whether or not you paid interest or not. Because you can't default because you don't have to pay any interest. So the only thing the originator needs to worry about is whether or not the value of the property against which they have the collateral is still worth more than the total amount of your existing mortgage and the additional EU renovation loan, which will be protected because you won't be allowed to borrow more than the value of the property to start off with. And if you borrow, as I'll show you, at a rate which is the EU rate, which is below inflation, the chances are the property is going to increase at a value faster than the debt will accrue. Apologies, I'm going to use some complicated words today. Collateralized by the home, but it's a junior to the existing mortgage. That means as an existing lender, as an existing bank, any of those who you've seen on these panels, who all have a mortgage book of millions of clients, they will want to use EU renovation loans because it's not going to impact the seniority of their ability to claim back their loan in the event of a default on the primary mortgage. This will also come with an EU guarantee, which means that they won't have to do credit analysis, which will open up a whole segment of the market that today they cannot extend credit to because their credit departments won't let them. So that's the fairness point. So when we hear, so it's fair because a person here in Prague will get the same borrowing costs as a person in Madrid, where I live, or Portugal, or Bulgaria, or Brussels. It's completely fair. Everybody gets the same interest rate. Sound like anything? Sounds a bit like Eurobonds. Sounds a bit like a shared obligation. Sounds a bit like the kind of obligation we would need if we all shared a climate challenge. The challenge to reduce the amount of energy that we need to use to make us more resilient in the face of a conflict. So the interest rate level, there's a typo here, for those of you following. So just to see if you were, the interest rates today, 30 years in Europe, are 2.3%, not 3.3%. That would be a great advantage to anybody who had an EU renovation loan today. In the interest of greening central bank liquidity, I also think there should be a central bank liquidity facility which would provide liquidity, because the other question a bank will have is, hold on a second, okay, I get it. So I've got a guarantee, so I'm going to get the money back for sure. Because it's guaranteed, it doesn't go essentially on my balance sheet, I can keep the risk capital. But what about liquidity? I wouldn't really choose these terms to lend to these people. I choose other terms that are more beneficial to me. Well, okay, but in the event of a liquidity crisis, these have a pre-prepared facility at the central bank so that you can get them funded. That just means you're not going to go, these are great to have in a liquidity crisis. You put them into the central bank, you get attractive funding on the back of these assets. So it makes you want to have these assets. What's the problem with renovation is we don't have banks as proactively offering renovation loans as they should be, because there aren't enough people clamoring at the doors of banks yet to get them. So loans have to be for a renovation purpose. The loan itself has to be, the renovation has to be compliant with EU taxonomy. Why? It just means, therefore, that the existing mortgage, any existing mortgage you have against that property, can be greened. Why would the banks want to do this, therefore? Because their existing mortgage books, not green, need to be green by a particular point in time. Transition plan, you heard them say that. This would be the kind of financing that you would need if you were transitioning your mortgage book. So, who will benefit from these? Most likely, the elderly people with reduced pensions with no savings, who are suffering the high energy prices and whose pensions aren't keeping pace with inflation, and who also are more likely to own home equity and own homes and live in them. And, not forgetting, young couples with a mortgage, but with the maximum amount of loan to value on their existing mortgage, but needing to do a renovation. they will be happy with it because it won't change their cash position, which may be tight, but they will feel that in 30 years' time, they will be able to afford to repay the renovation loan. A few little technical rules about the innovation loan. What's interesting about a zero coupon structure is this. It kind of has an inverted S curve or an inverted J curve in terms of how much you borrow versus how much you pay back. In English, that means if you borrow with a high zero coupon rate, the amount you have to pay back would appear to be really frightening when you take it out if interest rates are, say, 5%. So at 5% zero coupon, you borrow 20,000. In 30 years' time, you've got to pay back nearly 90,000. Now, the optics of that just don't look attractive. Nevertheless, if you're down at the current EU borrowing cost, which is, say, 2.3%, the amount that you're going to pay back on a 20,000 loan after 30 years is around 33,000, give or take. So why do I suggest that we should have a cap on the interest rate? It's a detail, but it's an important one, because historical home prices have increased 5% per annum since 1839. So what that means is that if you borrow at a compound interest rate below the price that you expect your home to go up, you're always going to have enough value in the home to pay back the EU renovation loan, assuming that the rate is struck below the historical expected and anticipated future price rise of your home. Why would governments and the EU be keen on the EU renovation loan? Well, mainly because they just don't have enough money to do the renovations that they want at the moment. I took the number of the recovery funds that was the biggest amount of money yet that was placed in the hands of member states to be able to invest in a strategic priority, which was renovation, and the amount of recovery funds per annum is around 25 billion going into renovation, give or take. The Commission's EU renovation wave says that we need 235 billion annually to renovate the homes that are necessary to deliver us our targets by 2030. There is a big 215 billion euro gap that you have noticed. So that gap currently is not being filled very well, and we need to change the paradigm, and we need to do something which is completely new. Why would the ECB provide a liquidity facility? Why would the EU provide a guarantee, apart from all kinds of spreadsheets that we could talk about? Well, fundamentally, I think it's because a guarantee against the release of home equity is a much safer instrument that can deliver hundreds of times the number of renovations than just paying it through grants. I'm not saying grants aren't important. Grants are important for people that don't own their homes and are energy poor, and for social contract reasons must be able to be kept up with the times. Those 25 billion euros are perfect for those segments of the population. But the rest of the population can have an EU renovation loan. So the lenders in this matrix need to be incentivized to go out and offer EU renovation loans. They need to be doing, why are the lenders here in the first place? Why isn't it local authorities? Why isn't it governments? Why isn't it energy agencies? Well, because over the last 20 years, all of those other organizations have failed to deliver millions of retrofits. They've delivered thousands, they've in some cases delivered tens of thousands of retrofits, but they are not delivering 3.5 million retrofits a year. So given that we have to take the number of deep renovations up by a factor of around 10 to 14 times, we just need different operators to come to the table. So who might there be who has millions of retail customers, who already understands the dynamics involved with financing their homes, and that have branches, 138,000 branches to be precise, in every country of the Union? It's banks. It's mortgage lenders. In fact, you don't have to be a bank to give a mortgage. There are funds that provide mortgages. So it's anybody who's willing to provide a mortgage. The size of the opportunity for those banks, I think, is €1 billion of fees annually. So that's why all of the people who should be sitting in the empty chairs, who went out and still having a coffee, should be here, because they didn't see the €1 billion annually of fees, which I just put on the screen. Please tell them later. So Here's a nice complicated diagram because you couldn't end a presentation without having one of these. This is the whole structure. This is kind of like playing you back everything I've said all at once. So you have little ERLs, millions of them, going to homeowners at a rate of 3.5 million a year, provided by 138,000 branches of retail lenders or thousands of retail lenders, backed up by, on the one hand, an EU guarantee to guarantee a fair and single borrowing rate, which allows them to do that economic calculation to ensure that the renovation is going to make financial sense, and in a structure that is provided liquidity through the ECB, because otherwise, why would you do it on a zero coupon basis? Because you wouldn't. Apart from a financial instrument, you also need other things. I wish, as do all people who have a financial background, that the world could be resolved into a financial instrument. Most people on this stage still believe that's true. I don't. So what I think is we also need a facilitation framework, and when answering the questions, political questions I get to this instrument, they say, what's the most important thing that we need in Europe to deliver renovations? And I say people. So not only do we need people to be trained and qualified to deliver high-quality renovations so that the project management exercise that was referred to earlier isn't everybody's nightmare, we also need everybody to know that they're being fairly treated by the system that's delivering them the financing, and we need to know that they can participate in the EU renovation wave and deliver their own personal contribution to the climate targets through a sensible operation that's completely fair because it's the same for everyone. How many people do we need? 350,000. We need 350,000 extra project managers who are going to take away all that pain that you would normally have to do as managing this for yourself. In Germany, they have currently a network of 13,000 registered project managers that work with the state bank KfW and the energy agency Dana in an accredited system where you go onto a website and you type in your postal code and it tells you who the project managers who can provide a renovation in your local area are. We need one of those or several of those or as many of those that can fit in each country, and we need 350,000. How did I come up with 350,000? Basically, it's assuming each one of those project managers can do 10 projects a year. We need 3.5 million projects. Divide that by 10, you get 350,000. But luckily, in the world of big numbers, when you take one big number and you divide it by another big number, it becomes a small number. So when you take the 138,000 banks, which is divided by the 350,000 project managers, you discover that each bank in Europe has to train 3 project managers. So that now begins to sound like both a reason to include the bank branches in this discussion and a way of simplifying and rationalizing this huge training program, which you may have heard others talk about before. So am I just talking about things that are complete, sort of like space-age stuff? Well, no, because the European Parliament, this is a picture of the paragraph 46A, in the Parliament's position on the recast Energy Performance in Buildings Directive, which is currently just about to go into trilogues. Here come your actions. So the EU renovation loan is there, inside that document, right there. At union level, a special renovation instrument, the EU renovation loan, should be established to provide homeowners with access to union long-term borrowing costs for deep renovation. What did I say? Then, as if that wasn't enough, paragraph 4, somewhere in the appendix, notes that the Commission and the European Investment Bank shall ensure access to finance at favorable conditions, facilitating the deployment of financial instruments and innovative schemes, such as a European renovation loan or European guarantee fund for building renovations. EIB, you're here, right? Or you're there on the TV. So there you are, Commission, EU. So all we need is the Parliament position on the EPBD, as described here, to be approved through the trialogues, and an EU renovation loan will become real. So the 6 things you need to remember are, there's 3.5 million deep renovations that we need annually, and there's 10 trillion worth of home equity in the hands of the 70% of the people who live in homes they own. We need thousands of approved lenders who've got over 100,000 of bank branches to be working on resolving this issue. But the instrument that I've described contains existing components that we all know and love in the financial markets and have been well used, tried and tested over time, such as a zero coupon instrument, an EU guarantee, and a TLTRO facility from the ECB. This will, in my opinion, align the interests of lenders with EU institutions and customers, a prerequisite for an EU renovation wave, and it would provide confidence to member states to train and engage project managers for the renovation supply chains. So these are the 4 actions you now need to do, having understood all of that. We need to find them. There's a lot of technical sort of know-how sort of behind all of this, but we clearly need a task force that's going to come together because institutions need to coordinate. We need to have endless amounts of discussions about models and how does this actually really work and what are the fee structures and everything else, for which reason I and my team just put out a survey to banks, which you're very welcome to fill in if you'd like to contribute to that. We need the EPBD to outline this framework that I described. We need retail lenders to urgently address mortgage portfolio climate risks, which it sounds like they're doing, and support their customers to renovate their homes. And we also need, as a side point, the EU financial and prudential frameworks to be reviewed to ensure there aren't any hidden capital constraints or other issues that sometimes, or regulatory barriers, which might prevent that from happening. So this, obviously, it's been covered in the technical press, so it's not a complete secret. So I wasn't telling you the absolute truth. You can find it out there. And as promised, you can shine your phones at this QR code or write an email to me at that email address, or even call me on these phone numbers, or even send a message via Twitter if you want the whole world to know what your question is. Thank you.
Thank you so much, Peter. I'm sold. I mean, that definitely sounds like a classic win-win-win solution, actually, because it's not only really big win for people to be able to renovate and finance renovation of their homes, also for banks, as you pointed out. And we will definitely share the presentation, and we can even highlight 1 billion in potential fees for banks, but also for the EU to reach the targets and actually reach the goals. So if there's any more questions, I think Peter will probably be very open to discuss that further during the break later, or maybe during the drinks. So thank you so much for that. That was, again, an amazing example of what I've been saying this morning, is that we try to focus on tangible solutions and practical solutions, and this has been a very practical, tangible instrument that can deliver on some of the targets. So thank you for that. And now we will move to the next panel discussion, which actually is getting even more technical now. So that's good. So I will, if I can, ask you to come to the stage, Lucy Fitzgeorge-Parker, the editor of Responsible Investments, and also the speakers, Martin Krivaniek, director and head of CEE Sustainability Services, KPMG, Dr. Tony Hughes, columnist from Global Association of Risk Professionals, and also Pier Paolo Cristaudo, senior director and head of Global Data Science for CRIF. So in this discussion, or maybe I will let you introduce the discussion as well, Lucy.
Thank you very much, Julian. Yes, well, after that incredibly upbeat and uplifting presentation by Peter, we're now going to go back to some of the slightly tougher questions for banking. It's not all good news. And we're going to be discussing climate-related risks. Now, you may say, well, this has been discussed on some of the panels already today. Undoubtedly it has, but I think we've still got quite a bit to say that maybe we haven't heard elsewhere. We're going to dig into this a little bit deeper, looking specifically at sort of climate-related risk management. And I've got 3 great panelists here with me. I might ask them all if you could just introduce yourselves very quickly to the audience, just so who you are and what you do. Martin, do you want to start?
Hello, everybody. Thank you for having me here. I'm here for a second time. I was also in the panel last year. I work for KPMG here in the Czech Republic. I'm head of CEE Sustainability Services, and I would say that my key focus is, in addition to ESG, is also combination regulation, risk management, and let's say the whole sustainable finance.
Thank you. Pier Paolo Cristaudo from CRIF. CRIF is a global data-driven company and a fintech. And here I'm not the risk management guys like, for example, Martin, but more on the data side, not only for ESG, but trying to give everything we learn in terms of aggregating data and augmenting data to the ESG environment as well.
Hi, my name's Tony Hughes. Right now I'm an independent consultant, and I also work as a columnist for the Global Association of Risk Professionals. In the past, I was a managing director of research at Moody's Analytics, and before that, I was an academic economist in Australia and the US. And I've worked around the world, and very pleased to be here in Prague speaking at this panel.
Fantastic. Okay, well, I think I'll start with a question from Martin. We have got a lot to cover in this, and we've already, you can kind of see where we're going to go with some of these questions, given the expertise we've got on the panel. Martin, so just to start off with, maybe you could just give us a sort of bit of an overview of what you've seen has been some of the more successful sort of sustainability, climate-related risk management strategies for banks.
Yeah, maybe I first will start with asking another question. What do we mean by successful strategy in risk management? We hear a lot about green transition, increasing, let's say, the volume of green assets and so on. But this is not the same as, let's say, managing the risk. No one says that the green assets bear, let's say, lower risk. They technically can bear higher risk, not just related to climate risk, but also to other risks, business and strategy risk, and also the credit risk. So I would say that the successful risk management, we would be able to answer this question maybe after we will count what happened maybe in 10, 20, 30 years. So now it's not easy to answer this, but the successful strategies would be those that, let's say, the firms survive, the banks survive. They will also, let's say, maintain some yield. It's not about, let's say, reducing the risk at some minimum level. It's still managing the risk at some, let's say, related yield, and those would be the winners. And the question is, what is the right trajectory for, let's say, the greening the finance? We know that the key milestone would be 2050. Is it feasible? Now, let's say, we already have some doubts. Let's say, this will not be easy to make it by 2050. We are kind of delayed in several areas. And what is the right speed? Being, let's say, the first one to have the higher volume of green assets or not. Also, we are here in the, let's say, CEE region, and I can see, let's say, another approach for several clients that, or several, let's say, corporations and financial institutions that have no direct, let's say, connection to global investors. One of the strategy is not, let's say, being first with the green assets. Another strategy could be, let's say, the last. Financing the green assets and so on. This has some risk, but if you manage the risk, you, let's say, can increase the yield, and you can win it all, and you, let's say, learn from the leaders afterwards. So we will see how this region will tackle this. If, let's say, I answer this question from another perspective, if we ask what is the successful risk management in terms of, let's say, compliant risk management and the quality of the risk management, I think that we have a very good guidance right now provided by ECB on climate risk management, and this is 13 recommendations for various agendas of risk management, and this is already in action for a couple of years. We can read the progress from the market participants, but still we are in the middle, somehow. And I have some fresh survey made by KPMG in ECB supervised banks, and what's interesting message here that this is made by self-assessment of the institutions, and if they answer this question last year, how they assess themselves in risk management, and all of them were on track, like 30, 40, 50% in several areas, and now there is a drop. There is like 10, 15, 20%. So what's the behind that? Did they, let's say, got back in their risk management? Definitely no, but it's about, let's say, it's a moving target, yeah, to having the final risk management, and if you move, you understand that you need to move a lot, and we will discuss probably the data, and we are still at the beginning, but if I select just the key practices I see that would be essential for the good risk management, I see scenarios as a good component, but let's say from the perspective of risk, if you are tackling a new risk and which is forward-looking, this is typically the climate risk, we cannot trust the history, and we don't have let's say the time arrays for the data. We know that the future will be significantly different from the past. So starting with scenarios, I think it's a good exercise. Yeah? We can discuss the setup of the scenarios, but also I see, let's say, not just the scenarios, but the whole process behind the scenarios, like training people, discussing this, having, let's say, discussion across the institution, yeah, and so on. The second point is extending horizons in risk management and in business planning as well. Yeah? Now, the typical business planning with exact data is like 2-3 years, but the climate risk, we must learn how to work with longer horizons, like 10, 20, and 30 years. And already there is a regulation that, let's say, would like to have this. And the last point is the data. Yeah? Now, I see the data are still non-structured, yeah, in non-financial data, and we need to extend this, increase the trust in the data, and so on. So if I, let's say, summarize the key practices, leading practices, I would say these.
Okay, great. Well, there's a lot there to go into. Now, I think one of the things, as I said, this is going to be a bit more technical, so I think one of the things I would like to make sure that we do here is to make the distinction between physical and transition risk when we are talking about this. Now, obviously, the sort of some of the climate scenarios I think you're talking about there are physical risk, and I'm going to go to Tony, because I know you have some very strong views on this and about physical risk scenarios. So could you tell us what you think about physical risk climate scenarios?
Well, I mean, scenarios, the use of scenarios in general, I think I'll start with. I mean, so one of the things I've noticed over the past, I've been in the industry, throughout the past couple of decades, and so I saw the rise of stress testing after the global financial crisis, for example. And one thing that you really notice if you've been tracking it for a long time is that the methodological developments in stress testing have stagnated over the past couple of decades. So really, we're doing the same type of work that we were doing in 2009 in terms of stress testing our portfolios. The reason for this, I think, is that we've got a very strong methodological bias toward scenario analysis. And scenario analysis, though, has a number of pretty major problems with it. So, obviously, if you've got a really strong empirical background to the work, like in the physical sciences, so the data work that's been done over several decades has developed some very powerful physical models of climate change. And in that type of context, scenarios are a natural extension of that type of work. But on the finance side, we don't really understand how climate change impacts, for example, a bank's balance sheet. And so for us to jump straight to like a tertiary method like scenario analysis, I think is very premature. So the thing about it is that if you were to poll the panel and provide us with a portfolio and a scenario and say, project this, okay, then you might get a very wide range of opinions about what might happen to the portfolio under that particular scenario. So Lucy might, for example, predict 15%, and Pier Paolo might predict 5%. And the problem with scenario analysis is that there's literally no way to tell whose prediction is better. Okay, so the only way that you could do that, even in hindsight, so even if we wait 30 years, of course, the scenario will not play out exactly as it was proposed, way back in 2023. And as a result of that, even in hindsight, we can't say, ah, yes, looking back, Lucy's prediction was the best, or whatever the case may be. So what this means is that, that we, as practitioners, as analysts, we don't get any feedback about what is working well in terms of our analysis and what is working badly. And so as a result of that, the methodology stagnates. So what's the solution to this? The solution to this really is to follow the lead of the physical scientists in the climate change world, all right? And that is, you know, make the trip to Antarctica, at least metaphorically, you know what I mean? Collect the data and analyze the data and just try to answer the basic questions. And these are basic questions like, you know, how does climate change impact the borrower? What's the impact on credit risk, okay? And so you can imagine asking those questions both from a physical risk perspective and from a transition risk perspective. I think the transition risk is more, you know, proximate in terms of its likely impact on the banking sector. But a lot of the data development has sort of been in the direction of physical risk, which I think is sort of a little bit of a, you know, it's just sort of a blind alley, if you know what I mean. Because the real problems for banks, I think, will be on the transition side.
Okay, great. Well, I'm going to come back to you on one of those points. But just before I do, just to remind everyone, if you do have any questions for the panel, please use Slido. I think that it was hashtag CEE Summit 2023. I think that's right. People are nodding in the audience. Yes, it is. Fantastic. Yeah, so if you have any questions, please do keep them coming in. I'm going to turn to Pier Paolo for the data in just a moment, but I just want to ask Tony first. You're saying, obviously, that we could come up with different, you know, 5%, 10%. Isn't that kind of the point of having sort of best case, worst case scenarios and somewhere in the middle?
Well, I mean, sure, but here we're talking about a specific scenario. So the scenario that we're all asked to evaluate for a particular portfolio is the same scenario. And the point about it is that, so when you read a scenario report, you know, how often do you see error bands provided for the scenario projections? And I would say close to never, all right? I won't say that I've never seen them, because I think I can kind of remember it. But the thing is that just because the error bands are difficult to calculate, and the fact that the person who produced the models hasn't calculated them, doesn't mean that they don't exist. And so one thing that you should ask yourself is, how wide are the confidence bands around these particular estimates, all right? And when you start to ask those types of questions, you know, you have to, you know, so there's this sort of tendency, because error bands aren't reported, people, you know, people who aren't perhaps statistically trained will look at these things and say, oh, you know, they're perfect. You know what I mean? I can rely on them. These projections are 100%. But the reality is very, very different from that.
Okay, well, now I said I'd come to Pier Paolo, and as both Martin and Tony have mentioned, you know, data is at the root of all of this, and that's what you're doing. So, I mean, could you tell us a bit about sort of how, well, how data fits into all this, but particularly where the issues are with data for banks in assessing climate risk, whether physical or transition risk?
Okay, well...
It's a big question, I know, but...
Yes, it's very wide. I mean, I think we need to set the scene, I mean, saying that probably it's similar to what Tony was saying about scenarios. We can try to do the best that we know. This is the approach. This is important. It's a general approach, and it's very important for data. We know the data are sometimes unreliable. We know that we are lacking many data, that first-party data, maybe we will need years to have a very good coverage, having information not only from the DNF, but also from small businesses, very, very tough thing. But we need to understand that we are, at least many banks are on the right path. Over the last 24 months, we had the opportunity to meet many banks of different sizes in many countries, And there was a clear watershed between the banks that are making the major steps in improvement in using and collecting and using data, and those that are still far behind. And this is an approach to knowledge, let's say, humility, and an approach that is able to understand what data are saying, if they are able to listen to data, talk with many providers. Obviously, I'm a provider. I give my type of quality. I try to do my best. But I can have one approach. There can be, I'm not saying many, but there are some approaches. Some are consistent with the thematic review from ECB and so on. But what is important is to have an open mind when you work on the data. And this means understanding not only the data, but also the necessities that you have pragmatically when you're talking of spending, for example, for data. One of the major issues that we experience, for example, is budget. Sometimes, I mean, it was a chaotic situation in some cases, participating to a tender, for example, big tender, big bank. All of the supplier giving their quotations, and after that, bank saying, oh, oops, sorry, I had the wrong budget. Quite low compared to all of your quotation. So this is, it's not a rare situation. It's something that we see every day. Obviously, in 2021-22 was really a big issue. Now they are adjusting, calibrating their needs in terms of what are the gaps that they have to fill. But still, we see that there are some approaches that are just meeting the regulatory requirements, nothing more. And another one is saying we are just at the beginning of a journey. We can start understanding. This is common to transition risk, physical risk, or biodiversity, that it's beyond climate. It's more or less the same. I mean, we are in the first step. Then we will need to progress. And another important aspect, we need to learn from other industries. For example, sometimes I was with one of my big clients in insurance. He was really saying, why banks are still struggling with physical risk and the methodology and so on, that we are working with this kind of modeling since I don't know when. Obviously, granularity is different, reinsurance is different, but some methodologies, some exchanges of competences is something that we as a banking actor, let's say, I include myself in the banking actors, need to understand that the discussion with this kind of different approaches is really a win-win.
Yeah, I mean, I think that the thing about data, so I think that there's this impression, I think, that we don't have a good handle on the relationship between banking portfolios and climate data. But another way to look at it is that, well, but what if we actually do have a decent grasp on that? Okay, that question. What I mean by this is, I think a lot of people in the banking sector are going at this problem and they're thinking that they're going to find a really, really powerful, strong relationship between, global warming and, credit risk, for example. Okay, but the reality might actually be a lot more subtle than that. So it seems, certainly from history, that there doesn't seem to be a very strong relationship between climate change or climate events and the behavior of the banking sector. So for example, I mean, one of the ways that I got into this area was I started doing an analysis of New Orleans headquartered banks before and after Katrina. Okay, Hurricane Katrina. Bear in mind, Hurricane Katrina caused the population of New Orleans to fall by 50%, basically straight away. And then that's gradually come back over time. And it's caused, ongoing considerable damage to the economy, both in that area, in that city, and also in the broader region as well. So the thing is, like, and yet, if you look at the data on credit risk for banks that are headquartered in New Orleans, these are small banks with very little regional diversification. So they're basically stuck in New Orleans, if you will, and you can't see the barest murmur in the data. Okay, the banks are sailing on through that as if basically nothing has happened. Like I might be sort of exaggerating a little bit here, but effectively that's what's going on. And so but the thing is that if you think about it, like climate change really should be impacting these small regional banks, you know, and they should be the canaries in the coal mine. So for a really large bank like Citibank or what have you, that's very, very diversified regionally, you wouldn't expect them to be the first to go.
Completely agree. Completely agree.
And so the thing is that, like, you know, maybe the evidence is just that, you know, this is a very subtle relationship that we need to try to tease out. You know, so we shouldn't be expecting this really, really powerful relationship. And, you know, maybe we should just basically be monitoring these canaries in the coal mine to see if they start to fail.
Yes, I completely agree. I mean, really thinking about even, I don't know, Pillar 1 development and so on. Yes, I know, but the adjustment or what we need to do is to find new ways to see methodologies, see how model should be developed, take into consideration, and so on. It's a completely new scenario.
Yeah, but that's certainly, but I mean, like I was talking more on the physical risk side, obviously. And I think transition is more pressing, you know what I mean? So I think that you know, it's certainly possible that policy missteps, you know, substantial changes in consumer behavior, these types of things can happen much more rapidly than the buildup of physical risk in the environment.
Yes, and transition risk, you have less levers to work directly. So the impact that you can have on companies, on small businesses, aside from what we will see in the future with regulation or benefit that we will have. Whereas on physical risk, I'm not saying that adaptation to the physical risk will be easy, but at least predicting the impact, the vulnerability is something that it's already in the capacities and the skill that you can lever on.
Yeah, I agree. And the physical data is amazing, you know what I mean, already.
Yes.
Yeah.
And yes, for regional banks, I think it's something that is really urgent.
Yeah.
The diversification, it's sometimes absolutely nothing.
Well, so I mean, obviously, at the moment, sort of talking about the robustness of U.S. regional banks seems a little bit of an odd time to be doing that, but it's clearly not climate change that has been causing the problems at the moment. But I was just going, I mean, you're talking about the data that is available and saying there's a lot of data, but also the budget constraints. And yes, I mean, I do know that the data is very expensive. I don't know about your data, but generally, I mean, a couple of years ago, I was sort of interested, like, who is actually making money in sustainable finance? So I went around, I guess I'd kind of assumed that, you know, banks that were arranging green bonds were getting well paid for that. And I asked them all, they said, no, you know, this is just kind of a, you know, it's a must-have. It's not something that you actually get extra for. And I asked around everyone, asset managers, who I suppose, asset managers a bit, but you know, who's actually really making money in this space? And they all said the data providers. So it's obviously a good space to be in. But it is, I'm not going to ask you, but no, I'm just saying, it is, the point being, what we're saying is that the data is expensive. I mean, as you're saying, there are budget constraints, particularly for smaller banks, that, you know, what a city can do with data and what, say, I don't know, a medium-sized Czech bank can do with data is very, very different. But I think one of the questions I did want to ask about that in terms of the sort of the data ecosystem is that we heard this morning Ben Caldecott was talking about the work they're doing on asset level data and geolocation, and I mean, I've heard this from several people. There is a lot of data out there. This is great. There is a huge amount of data available. It costs money. That's one hurdle. But also, I mean, how do you actually then? I mean, you know, data doesn't just feed itself into models. It has to be, somebody has to do that. Somebody has to have the capabilities, the understanding. How is that sort of working thinking at the moment? Is the setup of the sort of sector as a whole optimal for enabling banks to get the data they need to the places they need it?
Okay, if I may, first about the cost
of the data.
Of the data. Yes, I agree with you. They are expensive, but why? Because really, if you want to apply good methodologies, let's say, and have a good level of quality, data providers, exactly as the bank that started by their own, know that you hit the head so many times, you need to find another way, test again, validate, see if it works or not. You selected, for example, the wrong partners. Why? Because you are working, for example, for physical risk. I think you need to have a scientific approach. I mean, you have acute and chronic risk. Each single risk is completely different in terms of competences that you need to handle. And then you have to combine all these aspects, for example, in one risk. This is something that is very, very difficult to do if you are, for example, a data provider or a data-driven company like us. If you want to do it internally, you need to have competencies. You go to the, I don't know, one company, another one, combine them, or find academics that want to share with you their knowledge. So really, it's really a very costly process on one side. In terms of where we are, well, usually, especially if you are providing data to banks, you need to adjust to where they are. And where they are, I think they are still understanding what type of investment they can do, considering that we are not near or close to a target, let's say, data ecosystem, because data are still in their preliminary stage. So they're trying to understand what kind of investment they worth doing, if it's better to just process what they have, batch, and then see what can be fitted by, I don't know, APIs and so on. So we're still in the middle, or at least what I have seen in every size of banks.
Maybe I would say that there is no need to reinvent the wheel. Yeah? We already have, let's say, the strong history of financial data, preparing the data, having the methodology, IFRS, having, let's say, increased the trust in the data, like in audits, assurance, and as well. And also banks are used to work with these data because those are structured and comparable, and you can have long, let's say, time frames of comparable data. And we are needing a game changer here, let's say, to move to another step. So this, from my perspective in the European Union, this would be CSRD. Let's say another wave of preparing non-financial data in, I would say, significant extent, and this would be standardized as well. And now, let's say, the sources of non-financial data are, I would say, not comparable so far. Each, let's say, institution, firm is having different sustainable report, different KPIs, different data. Yeah, so if you pull this data together, it's not easy to work with this and create some, let's say, scientific metric. Yeah, so that's my point, that this would be probably 24, 25, the next wave, and we see, I think, that significant move in working with data and data models in risk management.
Yeah, I mean, I was going to say that I think that in terms of physical risk, you can sort of see the path forward. I mean, there are companies out there that are building these databases at a very fine granularity regionally. The banks know where their borrowers are located, where the secured properties are, and so I think that you can see that coming together. But I think that on the transition side is again where most of the the intellectual muscle should be aimed, On transition, I mean, so I've been thinking about this one quite a bit. And you can imagine doing, for example, event studies of past examples where new legislation was brought in, environmental legislation even. So you can think about things like the Clean Air Act, which was passed in the US certainly in the late 1960s. And you can imagine going back and trying to, this is more for a data aggregator like Moody's or someone like that, but going back and trying to see whether the passage of that legislation actually had an impact on the credit risk of corporations on either side of the introduction of that legislation. And the other thing that's interesting, I think, is that if you think about like car manufacturers and the introduction of emission standards, like I would imagine that the first time emission standards are brought in, so basically, before that it's just Rafferty's rules, build whatever cars you like, and then all of a sudden there's legislation which says you have to build cars to a certain emission standard, even if it's quite generous, or generous if that's the right word. But, and the point about that is that I would imagine that that would have a bigger impact on credit risk than a subsequent marginal tightening of emission standards. So you can imagine for a car manufacturer, they have to build, they have to set up engineering, they have to set up design processes to be able to take account of the emission standards. There's a lot more activity that has to be done in that situation. Whereas if you're just going from 10 to 20, okay, we just have to twist the knobs, okay, and that's a much more straightforward transition. And then you can sort of, I know I'm sort of thinking about this historically, but you can then think about like the failure of Chrysler in the late 1970s and ask whether that was due to climate transition risk. Okay, so for example, the gradual introduction of emission standards in the 70s, and Chrysler did that very, very badly, and all of a sudden in 1979 they fail. Okay, these are the sort of empirical questions I think that we should be trying to get on top of from a transition risk perspective, and it's a much more challenging problem, and I think much more pressing as well.
If I may, regarding the CSRD, because I agree with Martin about that, and about the fact that probably supply chain leaders as well will push on their supplier in order to comply with the regulation, because they will be mandatory for them as well.
Yeah, there's the supply chain due diligence regulation coming in as well.
Exactly.
Yes.
But do you think, for example, it's for both, that this will be enough? Or public incentives or tool like Peter was, for example, before talking about the renovation of building and so on will be necessary? Because this is, I think, a very challenging situation.
You mean enough for what? For effective
to trigger,
risk management?
yes, to trigger the vast majority, let's say, of the SMEs to start fitting with first-party data and fill in the questionnaire. Because, for example, one of the aspects that we as a company see in our platform for first-party data is that when you go, for example, to banks or to supply chain leader, ask him to fill in the questionnaire, the reply is, the last one that is asking us to fill in a questionnaire. You know that we have a lot of questionnaire to do every day, so sometimes it's better if we do this, because otherwise we're not allowed to work with this or to participate to a tender or some. But sometimes, like in this case, they will be saying,
This itself wouldn't be sufficient for CSRD is still, let's say, only part. We can discuss granularity, we can discuss if the data is scientific enough. We would need, let's say, additional scientific data, and probably we would need also national providers regarding the physical event hazards and so on, with detailed maps, flood maps, and all other We already have something, but we still need to have also forward-looking data and prediction. Yeah? That's what's happening in climate. It's changing still, and we have some estimation about the change, but what about the data? They are still lagging the predictions. Yeah? So in order to calculate the good results, we would also need to learn how to quickly update the scenarios based on the current situation happening globally and so on. And also one point is trust in the data. Yeah? If financial data are being used, the key decision is it audited or no? If it's not, this could be like almost garbage, yeah, for the user, because you cannot trust the numbers. You must have, let's say, some process increasing the trust in the data, and that would be also included in CSRD, at least, let's say, the assurance, like a first step. So I think this is a huge limitation right now, that data are not structured, are not comparable, and also the verification is very limited. Yeah, right now.
I mean, obviously, you are a KPMG. You are one of the big four, so I mean,
Yes.
you could be accused of talking your own book in that sense. But I mean, actually, just as I know this is not exactly what we're talking about, but I'm just interested. I mean, in terms of people providing that sort of auditing or assurance on this sort of data, is that something? Is that sort of, again, is that infrastructure ready for what needs to be done for the amount of data that's going to be, or reporting that's going to be done?
Obviously, this would need, let's say, additional capacities, because this doesn't mean that we stop, let's say, checking the financial data. Yeah, so now we have additional non-financial data, and if you look currently, what's the, let's say, the scope of financial report and sustainable report, I think sometimes it's non-financial part is much larger right now, and what will be the future. Yeah? So there is, I would say, some infrastructure, because these audit firms, not just only Big Four, but let's say globally, they have processes, methodologies. There is a sector regulation, what is meant by audit, what is meant by assurance, international standards. But also, let's say, the people would be needed for this, additional technologies, artificial intelligence to, let's say, help with the data checking as well. And there's a future for in all areas. Yeah.
Well, there's something that I'm sure that there will be another new job, because sometimes we talk about losing the job for AI and so on. We heard in the previous speech about the need for new project managers to renovation. Here, people that will certify data and practice and so on, I think it's another job that will grow a lot.
Yeah, tell your kids to go and train as non-financial auditors. That sounds like
we are discussing like costs of the data, but I would say that the benefits, also the financial benefits, are also significant. Like we discussed risk management. It's a key for survival for institution, the effective risk management, and also for the systematic, let's say, the health of the financial system, in terms. And also the banks can use the data, also let's say, corporation, to increase their production, target, let's say, services, and so on. It is not just only, I use the data, I disclose non-financial data, and that's it. I use it for risk management. I use it for, let's say, sustainability-linked products, for financing the transition, also for saving the losses for, let's say, house owners. If I speak about, let's say, gathering the new data, I discover new information about, let's say, what type of buildings could be constructed where, what can happen in the next couple of years, how the technologies should be adapted, and so on. So also, there is not only costs here.
Okay, so I'd like to, I'll go to Pier Paolo next. So I wanted to, there was a question I was going to ask, and I see there are a couple of questions that are coming in from the audience that are sort of around the same topic. So we've got a question about what level of granularity should be pursued for scenario analysis. We've got another question about to what extent can we piece together the puzzle by pulling small localized event studies together. And my question was going to be about some of the sort of fleshing out some of the learnings, potential learnings from the insurance industry. And I think those all sort of go together to a certain extent. Tony's not quite sure. I think there's a sort of a common thread in some of that, certainly to the extent that these are issues that insurance firms have had to deal with. It's a core part of their business. So yeah, maybe I don't know which end of that you want to start at, but some thoughts on that.
Yeah, the only point that I wanted to say regarding this is that I'm not sure if we are going to learn from the insurance sector or we will develop together something when we talk about Europe. Because most of the models and everything was developed outside Europe because of the events, the natural catastrophe event that were more in other regions. So the level of granularity and the necessity to specialize the models, it's both for banking and for insurance. So I'm not sure that, I mean, we can work together. I think this is a good point.
But still, this may sound like the insurance firms will have nothing to do in climate risk management, yes? So this is still, let's say, a good building block, what insurance firms are already doing, working with the climate data and the hazards. But we can discuss this also. What about the future data? Yeah? Is this all integrated in the insurance models? Yes or no? So also the insurance business must, let's say, focus on this, and the volume of premiums will go up also for reinsurance as well, and this will impact the other industries. Yeah, the
again, though, I mean, but it's very focused on physical risk. So I'm not sure if the department stores that have gone out of business in the last 20 years could have insured against the growth of the internet, if you know what I mean. And that's really what we're talking about there. So, and I guess this goes to the question about the event studies, which I brought up. But again, I mean, the thing is that I think that again, most of the interest is on transition risk, and that currently the industry doesn't really have a clear direction in terms of how you go about modeling transition risk. But one thing that I will tell you is that there have been, certainly my life, climate-wise, is very different to what it was 30 years ago, and certainly the legislative landscape has changed a lot, and the corporate landscape has changed a lot over that time. And so I think that there is a lot to be learned from an analysis of the empirical relationship between past transition efforts and credit outcomes, for example. And like I said, I mean, there is a sequence of legislative changes that have taken place, and it's possible empirically to look at the behavior of the corporate sector prior to those changes, in anticipation of the changes when they're announced but not yet passed, and then the impact of the introduction of those changes when they actually do come into effect. And when we talk about transition risk, that's one side of things. The other side is sort of changes in the behavior of consumers and businesses in the face of an increasing awareness of climate change, okay? And that's obviously going to be very evolutionary more than, there's no specific shocks that really come about in that, I don't think. I suppose there are. There's things that happen that make you think, gee, climate change is real, and that sort of really, shove that in your face. Things like Hurricane Katrina would be an example of that, I think. But the point is that on the transition side, I think it's going to be a really, really substantial challenge. It's very hard to commercialize, because what I'm talking about is a very academic sort of a view of this, and going back and sort of looking at specific events and trying to see whether they actually had an impact on climate change or not. But when we talk about transition risk, that's what we mean. We mean if the government passes a piece of legislation that wipes out certain companies or certain sectors of industries, okay, then that will feed back to the banks and cause credit problems for them, okay? And so the only way to really understand that, beyond just rank speculation, is to try to understand what the impact of these types of changes has been in the past. And like I said, it's very hard to commercialize that. How do I sell that to a bank? I've got no idea.
Okay, well, I think, I mean, obviously, you're talking about, whether or not, scenario analyses, are fit for purpose, or indeed, whether the whole concept makes sense. The fact is, of course, that they are being used by the central banks, and so banks have to pay attention to them just from that perspective.
Banks like it.
But, well, that's the kind of the question is, in terms of, now, I know we're not going to discuss the actual sort of the NGFS side of that here at the moment, and how what the central banks are doing precisely, but looking at it from the banking sector, the sort of incentives that those are creating for banks. I mean, what does, let's say, well, Tony, I mean, yeah, banks have to pay attention to scenario analysis, but they can't ignore that. What does that mean?
Yeah, they're required to do it for regulatory, to keep their regulators happy. That's certainly true. But my point is just that, if they had if you gave them the truth serum and said, how good is this analysis? You know what I mean? I think it would be very hard for them to answer that question.
So, Martin, you had some thoughts on that.
It was already asked. Do we have anything else? Yes, this is not the only tool. Yeah, this scenario analysis is one of many of the tools. And if we start with let's say, the zero history of data, this is, let's say, one of the tools we would need to put in force, and we must know what will be the results, yeah? How to work with the scenario results. Is this not, let's say, resolve everything, yeah? Not trust as the only, let's say, resort. This can help also if we have the standardized scenarios that have, let's say, benefits or disadvantages as well. Benefits that those are comparable, and I can compare like the sensitivity across industries and economies and so on, because the climate risk in Czech Republic would be different to UK and to Italy as well.
The only issue with that though is that like there's a tendency for banks across the industry to take a conventional approach. So in other words, like, so everyone sort of locks into a sort of a way of doing things, like a way you do stress scenarios or whatever, and it becomes very, very consistent across the industry. And again, though, and if someone came along who was perhaps a bit more, like if an academic did it, someone from outside that world came and had a crack at the same thing, you would then get into this situation where you have this comparison. So in other words, the academic says 15% and your model says 25. How do you decide? You know what I mean? And it becomes, and the conventional approach says 25. So I think there's sort of like a tendency for techniques and methodologies to become standardized across the industry. But that doesn't necessarily mean that they're right. They're the right methods or the right techniques.
I would say that I'm much more skeptical to climate value at risk than the scenarios. Yeah? So in the traditional financial risks, also this has been proven in practice that even the inventors of value at risk failed with using it. Yeah? And the regulation is replacing with other tools. So I'm not sure if, let's say, it's fitting the purpose and the situation we are right now with the value at risk for climate.
Yeah, I agree. And value at risk, especially over such a long time horizon, value at risk in a short horizon sort of makes sense, But the point is that, like, across the long term, I mean, you've got the option to move, you've got the option to abandon. There are various options that companies can exercise across the life of that loan. So I'd like to see things like, so the investment, so the investment is I need a factory to build widgets, okay, and I've got my factory in this particular location today, but like in 20 years' time, I'll still want to produce widgets, but I don't really care if I do it, in a different location, okay, and so between now and then, I've got various options. I can run my factory into the ground. So basically, extract as whatever I can from the investment in the current location, and then move, and then invest elsewhere. So a lot of the value at risk at the moment is very location specific. People are thinking about it in a, there's no way that widget company can possibly move their factory. But of course, over 30 years, they've got options to do that at various times. So, so value at risk has to become agnostic to location.
Okay, well, I've got so many questions, but I think I feel bad. We've got a lot in from the audience, so we should take some of those. And I think this one for Pier Paolo, I think. What kind of internal capacities should banks build to appreciate climate data?
Well, it's difficult to say because it's very different based on the size of the banks. I mean, I think that the point is relations. So focus on relations. That means probably having a limited capacity to what is, let's say, what you can sustain in the medium and long term. So meaning not base your structure based on peaks, let's say, but invest only when it's clear that some areas will remain the same, or the specific competences that you are building will be helpful for many necessities or needs to be compliant. For example, physical risk is one of this. I mean, you will see it in many areas. Taxonomy is at the center, adaptation to climate. So this is an area, I think that it's very important to understand, to, let's say, establish a first layer of knowledge about the different aspects. Now the new one is biodiversity, for example. Working on that, be open to discuss with academics, with third-party providers, consultants, and so on, and then understand what is the right capacity. But just to give the right continuity of your business, not the peaks, or not once you have done this, okay, I will use it as people to something else. No. There's another aspect that is related to talents and the type of people that you need to hire, for example. This is not the usual guy. These are people that need to work with passion, understand very difficult competences in an environment where 99% of the workers speak another language. And you need to convince the others, the risk managers and so on, that you are right. And they need to adjust to your opinion and so on. This is a very big challenge.
Okay, great. We are nearly running out of time, but just one more question. I do think this is, I think this is an interesting one. How can we set confidence bounds? Again, we're back to physical risk, I guess, mainly, but how can we set confidence bounds for government-led decarbonisation pathway analysis when target set still does not meet 1.5 or even 2 Celsius pathways? And certainly 1.5 seems to be a very, I hesitate to say hot topic, it's not pun, not intended. At the moment, I certainly think everyone I've spoken to recently has said...
Hot is not the right word.
Well, certainly everyone I've spoken to recently has said, 1.5 is gone, I mean clearly. And yet, those are still, the government... so government decarbonisation pathways are nowhere near even 2. And what does that mean for how banks are looking at this? Maybe Martin, do you have some thoughts on that? Or anyone else?
This results from the Paris Agreement, and this is some target. And probably what will happen that we will need to reconsider this target by 2050. Yeah, and because we are lagging a lot of stuff when we discussed, let's say, the scenario pathways like the smooth transition and quick transition. Now we know that this will not be smooth if we stick to 2050. Yeah. And also all countries are very different. Like 2 degrees in Czech Republic would be a good result, yeah, because it's the statistics say that we will be faster than other. So this is just an average globally. So
yeah, I mean, I think it's obvious that the key to being able to measure what you're suggesting is very difficult. You know, let's face it. I mean, so trying to measure the temperature impact of the loan that I'm about to make to company X, you know, that's an extraordinarily difficult question to ask. Is it realistic for us to actually even imagine that we can do that well and do that with a tight error band? Is, I think, questionable. But one thing that I would say is that, you know, the answer to that type of question is not in speculation and, you know, making a raft of assumptions and then constructing projections of our portfolio that are probably wishful, you know, more than anything. They're more aspirational than anything. The answer to that question, I think, is in science and data and trying to do empirical analysis to the best of our human ability. But I suspect that, you know, it's going to be, you know, that's one of those sort of challenges that is probably beyond us. Perhaps our AI overlords can do a better job of it, I'm not sure.
In any way, no, just to say, I think that the lawmaker, they didn't have any alternative than setting such ambitious targets. I mean, like in very ambitious project, you need to set very ambitious target. Otherwise, probably we would not here to discuss about how to reach it without having it so difficult to reach. But probably this was the only option they had. Now, I think we had to think more on the real ambition that the single institution can put, or the companies, to reach in the midterm their targets.
Well, I think basically, I hope we're using Tony's analogy. I hope we do have some canaries in the coal mine, perhaps, and that we're not frogs in boiling water, in water that's heating up. But anyway, sorry, I've kept you quite a bit of time over. I do apologise. It's such an interesting discussion. Thank you very much to all of you for sticking with us, and thank you very much to the panelists.
Thank you.
Thank you.
Thank you. Thank you, Martin.
And it is me again, probably for the last time. Thank you so much, Lucy and gentlemen, the panelists, for adding today to this mosaic we're trying to create today about what is sustainability in banking. And I think going from the entire banking and European banking system to pledges and commitments all the way to financing instruments and now to climate-related and sustainability-related risks. I think we're nearly there. I think we managed to cover pretty much everything, but there's one more very important topic we'll be touching in the last section, which is central banks. So I'm really hoping you're staying here to listen to the last discussion. I need your energy up, so I'm going to give you one more break. Please have some coffee. If you don't drink coffee, have tea. If you don't drink tea, get some fresh air. If you don't like fresh air, there's not much I can do anymore. Good. We'll see you in 30 minutes, please. Thank you.
Climate change is a speeding train. It's ramming through stations and headed straight for us. So what's ING doing? We're trying to help slow it down while also preparing for what could happen if it doesn't. It starts at home, so we monitor our environmental impact and have targets to keep doing better. But as a bank, for us it's really about two things: how our business impacts the climate and how climate impacts our business. Our biggest impact on climate is through our financing. ING finances today's society, which means, yes, we do finance things that aren't green, but we also finance billions of euros of green projects and companies around the world. We say a flat-out no to certain businesses, and yes, but to others, outlining sustainability changes they'll have to make first, and then helping them to make them. We innovate with things like sustainability-linked products, where rates are linked to sustainability performance. And we aim to steer the most carbon-intensive parts of our portfolio towards net zero by 2050, financing the new technology needed, like battery storage and newer, greener ways to make steel. This is our Terra approach. Of course, while we try to make a positive impact on climate change and continually strive to do better, we also have to limit the impact of climate change on our business. There's physical risks, like floods and wildfires, and there's transition risks, like what happens to car makers who haven't started making any electric cars once those are the only ones legally allowed to be sold. To be resilient to these risks, we have to identify them, understand them, figure out how likely they are, and what their potential impact could be. Those insights shape our business strategy. We work hard to do our part as a bank, together with our clients, and commend others who are doing the same. But fighting climate change has to be a united global effort. We call upon regulators and governments and others to play their important role as well. We've come a long way, and we know that we still have a long way to go. But sitting still is not an option. We're focused on the future, moving step by step as we aim to make the difference. For us, for our clients, for the world.
and welcome back. So after the last break, we are here at the last session, last panel discussion of the day, focusing on sustainability in banking, and you could say the best for the end. As we already touched on quite a few topics, we have one very important topic still left, and that is what exactly sustainability means for central banks, which look after monetary policy, financial stability, but how sustainability principles are integrated and how climate risks can be integrated into what central banks do. And we have a very interesting panel, and we hopefully will try to answer some of these questions. So to the stage, I will kindly ask the moderator of this session on central banks. That is Rainer Martin, Head of Research of the National Bank of Slovakia. Then we also have Mark Campanale, founder of Carbon Tracker. Please, Mark. We have Eva Zamrazilova, Deputy Governor of the Czech National Bank, and Norbert Holzinger, Head of Department Sustainable Finance, Magyar National Bank. So, please. The floor is yours, and to you, Rainer.
Okay, thank you. Thank you very much. So I'm very much aware of the fact that we are standing between you and the subsequent drinks tour to somewhere and your free evening. So I think we have a very interesting topic, but we'll make sure that we stick within the allocated time. So let me just to set the scene a little bit. I've been a central banker for about 20 years. And when I started, central banking was a pretty unidimensional business. So you had the mandate to ensure price stability. Now that was, of course, not always easy, but it was quite clear what the mandate is and what you need to do. And then came the sequence of the global financial crisis, the euro area sovereign debt crisis, and that complicated things already quite a bit because suddenly there were issues like you needed to preserve banks' liquidity for longer than you would normally do, or you had to think about asset purchase programs, and quantitative easing was developed, TLTROs and the like. So it was an outburst of creativity on the central bank side, I would say. But that came also at a cost, because in some countries at least, it led to questions already then about the mandate of the central bank and whether it's stretched too much and going into areas that really central banks shouldn't be covering. And now, of course, we have the involvement in the climate change agenda, and that is also something where the merits, I think, are clear. But at the same time, questions come up whether this goes maybe a little bit too far. And I would like to open with two quotes from a conference that recently took place at the Riksbank, the Swedish National Bank. And there were some very, very different views on the topic we had. So let me start with a quote by Mr. Powell, the chairman of the Board of Governors of the US Federal Reserve. He is saying, "We should stick to our knitting and not wander off to pursue perceived social benefits that are not tightly linked to our statutory goals and authorities. We are not and will not be a climate policymaker." And then at the same conference, there was also a presentation by ECB board member Isabel Schnabel, and she had a completely different view. So she said that the ECB should step up its efforts to make its monetary policy more climate-friendly, possibly by harnessing its multi-trillion euro stock of bonds. She said, and I quote, "It would be misleading to use tighter financial conditions as a scapegoat for further delays in the green transition." So you have a pretty large spectrum between Powell on one hand and Ms. Schnabel on the other hand. And I think it will be very interesting to see what our panelists think about it and where you stand on this Powell-Schnabel spectrum. So without further ado, let me give the floor to the first panelist, and I would kindly ask you to also briefly introduce yourself in line with what we had in the previous panels. So Eva, if I could start with you. And the question to you is, have central banks been pushed too far in terms of what they might be expected to do with regard to climate change? And should central bank mandates be changed to include action on decarbonization or climate change related issues?
I think that the first and core mandate of every central bank should be price stability. Well, we all know, as you have kindly mentioned, that during the financial crisis, the world has discovered the problem that the inflation targeting itself doesn't safeguard financial stability automatically. Therefore, in the previous decade, many of central banks have got a new type of mandate, that's financial stability mandate. And new kind of policy has been created, that's macroprudential policy, completing the macroprudential policy. And why I'm speaking about that? I think that, for instance, in our country, the climate risks have been already incorporated in the financial stability, network, the system, because the tests, all the stress tests, etc., we have just been incorporating the climate, the risks of climate transition and the materialization of climate risks, like of course, some problems of natural character. We try to work with those risks as just to incorporate them into the traditional set of risks. And the bank themselves feel very strongly that there is a reputational risk and the negative sentiment risks for them if they don't comply with all those new needs of the green transition, of course. And of course, we all know that the decarbonization is a must. So the banks themselves incorporate these risks as well into their operational assessment. So I would answer your question that I wouldn't say that primarily or directly the mandates of central banks should be given also the climate change risk, etc. But I think that this indirect peer pressure is very useful for all of us to work with in the new arrangement. And then maybe later in this discussion I may add some more issues and more details into this. But I think that my statement is my position is quite clear.
Well, thank you very much. So on your side, you see that there could be some flexibility on the mandate. At the same time, you're saying that the banks have already very much incorporated what they need to do. It's also interesting you refer to macroprudential policy, because that's another policy area where very often there's been discussions about, should that be done by the central bank. So we may possibly refer to this later on. Okay, let me now move to Mark. And if you could give us your thoughts on what threats to macroeconomic and financial stability does the climate change pose? I mean, we covered some of this already, but maybe we can recap that a little bit. And how, in your view, should the central banks react to this?
Yeah, thank you, Fo. I'm probably the only person on the panel who's not involved work as a central banker. I worked in fund management for 20 years. I'm an economist. And Carbon Tracker, we don't track carbon, we actually analyze the energy transition and we model future coal, oil and gas production. So I just want to pick up on the first point about price stability and inflation. So if we look in the last year, the main driver of inflation, obviously, certainly in the West, certainly in Europe, has been the appalling war in Ukraine. And that's impacted us in two ways. Firstly, energy prices, and that's fed through to industry. And we've had massive interventions by the state to control prices. And the second is food prices. So in the United Kingdom, where inflation is running at 10%, food inflation is running at 20%. And part of that is the cost of heating greenhouses. But the other of it is hey, who knew? We make fertilizers from gas. We don't need to make fertilizers from fossil gas. We can make fertilizers from hydrogen, from green hydrogen. But the big inflation in food has been the rising costs, particularly of fertilizer and the availability of fertilizer, and Ukraine being an important exporter of fertilizers and seeds and so on and so forth. Now, my remarks about price stability is the problem, and it's just reflected in my first points, is that we've got a commodity-based energy system. So we're dependent on two parts of the energy system. One is the stock, actually how do you create your energy, and the other is your flow. So gas, coal, and oil being a commodity, that's your flow, and it's inherently inflationary. So all the cheap energy has been found, and all the expensive stuff is what we move on to next, unless you're in the Middle East. But all the players outside of the Middle East, listed companies, private companies, are playing in the expensive field. So you have to go up into the Arctic, you have to go to ultra-deep water. The costs of extraction are exorbitant. And once you've got your oil, if you're in Canada, you have to boil it up, put it in a pipeline, send it to a refinery. If it's a gas, you have to compress it, put it in a ship, send it across the sea, decompress it, transport it to a power station, burn it in the power station, and then if you're clever enough to remove the CO2, you then have to pay for the CO2. Inherently inflationary. Now, renewables is inherently deflationary. It's a technology. It's based on electrons, as I made in my earlier remarks. It's a technology, and we know from technology that's on learning curves, it just gets cheaper and cheaper and cheaper, to the point where the marginal cost of energy in the future is going to be zero. And the reason for that is once you've paid off the cost of your system, all the fuel, sunlight, the wind is free. So what we're studying is actually how the total percentage of the household spend for energy for the average consumer should fall, and it should fall significantly in the next 2 decades. And that deflationary impact should be good for the household as deflationary. And in turn, these cheap energy systems will actually lower the cost of production for the manufacturing base. So that's good for the broader economy. So my first point is that the energy transition is inherently deflationary, and instead of the volatility that we're seeing in commodity prices driven by things like the war, actually the volatility will be removed, and we should look forward to a period of long-term price stability. Now, my second point is about should central banks really worry about climate risk? And is it straying outside of the remit? Now, let's go back to my old job as in fund management. You've got to do two things well as a fund manager. First, you've got to know what assets are worth today, and you've got to know what the same assets are going to be worth in the future, and what are the factors going to impact the valuation of those assets. So in the clean energy transition, we've built a fossil fuel-based energy system and manufacturing system, and because of that, we have built a fossil fuel-based banking system that sits on top of it. The whole of the banking system and capital market, not all of it, but a significant proportion, is orientated around supporting an energy system which is disappearing and a transportation system which is disappearing. So what are the assets of the fossil fuel system? If any of you are kind enough to download the size and decline and fall of the fossil fuel system off Carbon Tracker's website, you can see we run the numbers. About a half of global non-bank bonds are linked to the fossil fuel system: shipping, aviation, cement, steel, the whole of the construction industry, power and transportation, and about a quarter of global equity markets are linked to the fossil fuel system. And we have about 20 to 30 trillion dollars of fixed assets, and we're going to have to lose half, if not more, of that over the next decade or so if we're to achieve net zero. Certainly if we're committed to 1.5, we're going to have to see that. So one of the first things we're going to see is auditors and accountants stress testing the value of assets held by companies on their balance sheet. Now, why is this a problem for the banks? is you've got loans secured against the value of the assets in the case of a company. So if your assets are worth 500 million, you might be able to borrow 1 billion. If your assets are worth 250 million, the debt equity ratio changes, and all of a sudden, the amount you can borrow contracts significantly. And so you've got a contraction. You've got the banks calling in more collateral against those loans. So you've got the challenge over the value of the collateral. The second is the pricing of assets. What everyone fails to notice is that in the case of public markets, for both bonds and equity, prices are set at the margin. So if you look at the value of oil and gas companies in the last year, they're up by, what, 70%? 70%, probably. Exxon, Shell, Chevron, they're up 70%. What percentage of the total shareholders of Exxon had to buy or sell to drive the share price up by 70%? It wasn't 70%, it wasn't 20%. It was probably closer to about 5% of the shareholders in Chevron turned over their shares to drive the share price up by 70%. So it's another way of saying that you only need to get negative sentiment against the incumbents of the energy system to get marginal selling or buying that will drive prices around. So the corollary is the opposite. You only need a 5% change in the sentiment of markets towards a company for the share price to drop very quickly. Now, we saw this in the case of the listed coal companies in the United States. So when coal demand in the US fell by 2%, did the share prices of the coal companies fall by 2%, 20%, or 90%? I think you all know the answer. A 2% fall in demand for coal led to a 90% decline in the value of the assets. And of oil and gas companies, 100 million barrels of oil demand a day, a 5 million barrels of oil demand drop during COVID dropped asset prices by 50%. So the point being is that prices are set at the margin, and this is the vulnerability that the banking system and equity markets have, is the ability of markets to reprice and derate sectors very, very quickly. And that is the soft underbelly, I'm afraid, of the banking and financial system, is a derating of the incumbents of the fossil fuel system as we move to a new system, and central banks actually being asleep on the watch on this. You could call it transition risk. I do have other remarks on this, but I'll leave those for later.
Thank you very much, Marga. I think two things maybe just to add to this. So the first one, I found very interesting your statement that you would expect in the medium term a deflationary impact of transition, because I think that's in the public debate. This is not so sort of commonly the perception.
I mean, not tomorrow, but the expectation is certainly within the next decade, possibly less than the decade.
Of course, bringing a bit of a regional angle to it. I mean, the banking systems here in Central Eastern Europe, they are kind of typically quite plain vanilla banking systems. So most of the assets are mortgages or SME loans, this sort of thing. So these sort of huge swings in large corporates is not something you would see so much here. But that's just from a sort of regional perspective.
And also, you've got the benefit of all the new investment in the last 20 years has been for modern machinery and equipment designed for an efficient European market. And I wouldn't expect for you to see huge write-downs of assets, unlike other parts of the global economy where you've got systems in place for a long period of time. I mean, what you have to worry about is gas storage and pipelines built with a 30-year life that only have a 10-year life. That's probably where we have to worry a little bit.
All right, thanks very much. Let me then turn to Norbert. So Norbert from the Hungarian National Bank. The initial question for you is, how can we better integrate this climate-related analysis of long-termism in central banking? And are the current prudential policies effective to curb the climate-related risks or alleviate the downturns?
Thanks. At first, I would like to react to the thoughts about central bank's mandate, because I'm in a special situation since the Central Bank of Hungary, or in short MNB, received the sustainability mandate as one of the first central banks in Europe in 2021. But I think that this green mandate is not a precondition for green central bank activities. It helps and it provides more opportunities, but it's not a precondition. For example, in 2019, MNB launched its first first green strategy, the so-called green program, which is a comprehensive program, and in which we took a lot of measures. For instance, issued recommendation for banks to improve their preparedness and green awareness. We started a preferential green capital program to incentivize green lending, or we performed some stress tests covering not only banking sector, but in this year, insurance sector as well. I think that based on financial stability mandate, central banks can do a lot. Yeah, and regarding your question about long-termism, yeah, this is the famous thought of Mark Carney about tragedy of horizon. That he said that in monetary policy, the typical horizon is 2 years long. In financial stability, a bit longer, about a decade. In my opinion, it can be even longer, because there are some financial products which whose duration is longer than 10 years. For instance, mortgage loans or life insurance products or pension products, their duration can reach 30 or almost 40 years. So this long-termism sentiment is in the financial product development, and also in prudential policies as well. So I think the basis exists. So we can't change a lot in our mindset, but we have to use our possibilities.
And could I just ask you, because you said that the MNB was one of the first central banks to get a green mandate. Was this something that was really completely a new mandate, or was it sort of a specification of the financial stability mandate, or how was that done at the time?
It's a new mandate. The first mandate is price stability, and the legal act said that without jeopardizing the first mandate, MNB take care of financial stability, support the government economic policy, and also sustainable policy.
Okay. I mean, in a way, that's similar then to what the ECB is doing. No, it didn't actually have this mandate explicitly, but of course it has the secondary mandate to support the general economic policies, and that's what it's used then to deal with these issues.
Yeah, and maybe one more thought regarding long-termism, because I think that central banking in the spotlight, everybody, or central bank activities are watched by everybody, not only by financial institutions, but also the public. So if a central bank says that climate change is important, we have to deal with its impact, its long-term impact, it will have the consequences. So this is so the example is very important, I think.
I mean, on that, Eva, how is the discussion in the Czech Republic regarding this issue? Was there a discussion to change the mandate, or because some central banks are much more skeptical, and actually also when you look within the euro system, so some of the central banks are much more reluctant to get involved in these issues than others. So what is the situation here?
The situation here is, I would say it's quite similar to Hungarian situation as regards that in our mandate we do also have to support the general economic policy of the government. If the first and core mandate of price stability is not jeopardized or is not under question. So I think that for the time being there is no need, or there is no need and nor will to open again the CNB law, because it should have been opened. And because we have a novel of the central bank law, it's I think 2 years ago. So that we really will be supporting the government stance if our price stability mandate is not in problem. And I have to say, at the moment, we are under really very strong pressure of the media, of the general public, of the entrepreneurs, as for the inflation. And of course, that's terrible. That's really very terrible. It's not like in the Eurozone everywhere. Maybe in some countries there is, I think it's much worse than, for instance, in Poland or Hungary, because we have the highest interest rates in history, and still there are some academicians, economists that say we have to go, we still have to go up more than 7%. So this is our, of course, there is a tie to the energy prices, etc. So we also have to know that and have the analysis that if we are to support or somehow to have some political responsibilities for the green transition, we really have to know and have the analysis that this will be not pro-inflationary, because I agree fully with you that in the long run it probably will be deflationary, because there is technology change and productivity change and everything. But people in the Czech Republic are not very long-term forward-looking, but they are a little bit myopic, and they are interested how to pay the energies tomorrow and what will next winter be. So we are really very strongly pressed by the public opinion now to fulfill our basic mandate. So if we, in some media space or etc., we will start a discussion about green transition, I think that the timing is not perfect today, unless we should be really able to prove that this will help them with inflation in the midterm horizon, at least in the midterm horizon. And so this is difficult.
Mark, I think, did you want to react to this?
I mean, it's an important question. I mean, but it's an area for innovation in the banks. I mean, today in the United Kingdom, we have a mortgage bank called the Nationwide, and they've launched a zero-interest product today to retrofit homes. It's a green mortgage. So you can essentially acquire the equipment to decarbonize your home for heating, for energy at a zero interest rate. And I think we need to see more of those. The other product that we saw last year was a home builder and an energy company offering homes free energy for life. So what they were doing, they were putting in battery storage, they were putting in solar and an electricity EV charging point, and all of the energy that the house generated went into the grid for free. And when the grid needed access to the stored energy through the battery system, they got that back for free. But in return, the household got all of their energy free for life. Who would say no to that?
Absolutely.
I think we need more of this kind of thinking. We need more imaginative thinking, and central banks should be talking to the retail banks to actually say, look, let's think through how quickly we can offer these products to the consumer, because the consumer is also the voter in most cases. But how can we get this quickly to the consumer, but also to industry as well?
Let me get to, we have two quite interesting questions here on Slido. The first one is to you, Eva. Do you also feel that the financial risks associated with biodiversity loss are priced into the Czech banking sector?
Well, I think that the risk management of the Czech banking sector now is very prudent, appropriate, and of course I think that our banks, as most of them, they are not purely Czech. They are the daughters of big mothers from France, Austria, Belgium, etc., and so they are obliged to act in the whole company, multinational company. So I think that it very much depends on the statement of their on the policy in the mother country, and you know, I think that France, Austria, Belgium, Italy are quite responsible countries in this sense, but we have to look at the behavior of the banks also from this point of view. But as for the financial stability, the risk assessment of the banks, I think, is quite appropriate.
Okay, I mean that's certainly for the Slovak banking sector. I would cautiously say no to that, because I don't think this is the biodiversity. I mean, this is really like a new frontier, I would say. Climate change, yes. But let me get also to the second question, because that's of course a bit provocative, but it's also quite a pertinent one. So to what extent does the expansion of the mandate or the activities that central banks are doing act as a smokescreen for do-nothing politicians? So is this something that came across your mind, or you're worried about? I think it's more for Eva and Norbert, but of course, if you like.
Well, I may add to our previous question that in our financial stability report in autumn, we have incorporated a special scenario about the risk of climate change, not only for banks, but also for, let's say, insurance companies, and that were very harsh scenarios, very hard conditions. Well, 2 years of no water, or otherwise floods, etc. So we try to also to be very, very careful about that. And well, I think it depends.
So
it depends on the country itself. I think that you have yourself, you have started with two different kinds of opinion from both sides, two sides of the world. So I
no, but is it
say that it's not the same everywhere.
Is it something you would see as a risk in Hungary?
Yeah, it's a hard question. I think that everybody shall do what they can do in order to reach results. I would like to react for the first question, because biodiversity loss, because I think that this topic has become more and more popular for the last months, but we don't have enough information about this topic. And this is the reason why we started the project with OECD and the European Commission last year, because we would like to understand better the nature of biodiversity loss and the link between biodiversity loss and the financial sector. And as I know, this project is not the first, but among the first. So I think we have we need more information about this topic.
Okay. Any comments from your side on that?
Certainly in the United Kingdom, relationships between the financial markets and the bond markets with UK politicians is, as Dara said, very precarious. So we had a prime minister called Liz Truss. Does anyone remember her? And Kwasi Kwarteng, here and today, gone tomorrow. What happened was that when they announced their programme, the bond markets, the financial markets didn't believe it for a second and sold down the bond markets, driving up interest rates. And the government fell, in a matter of days. Huge embarrassment to the UK system. But what it revealed really is how binary, how close this relationship is. I don't know if you saw it, but two other chancellors of the Exchequer in the United Kingdom, George Osborne and Ed Balls, spoke in a parliamentary committee last week, actually arguing the case that climate should not be the responsibility of the Bank of England, and trying to make this case. I take the different view. I actually think that keeping this responsibility of financial stability and climate stability with the bank actually frees up politicians to find a little bit more wiggle room to develop other policies. Because when they actually look at the bank does something, the politicians can say, well, actually, it's not us; it's the central banks being very prudent. There is something which I do worry about with the central banks, and it's something that you probably picked up in the previous panel. Is how the Financial Stability Board uses integrated assessment models. Ones where they suggest at 4 degrees of warming, asset values only fall by 3% or 4%. And we've actually seen this. I mean, the other area of the assets of the financial system are in pension funds, something that I look at very closely. And we have investment advisors in the United Kingdom that are saying that 4 degrees of warming, assets will only fall by 0.1%. I mean, the reality is nothing happens at 4 degrees of warming. And you've got these smart models also used by the NGFS. And something that the central bank should be doing is shaking off these very, very damaging and problematic, the Nordhaus damage limitation function, the DICE model, and coming up with something more aggressive where actually you have to say at 4 degrees or even at 3 degrees, what's the impact of GDP? And bearing in mind the world's on a 3 degrees pathway right now, what's actually the significant impact on GDP, and then in turn on asset values at that level of warming. And that's something I certainly believe that central banks should be doing free of political involvement.
I mean, that relates to the third question, which is, I think, also quite a good one. I mean, would you agree that regions' central banks should design climate scenarios? I guess yes, probably that would be my guess at least. Because I think generally there is a lot of agreement on the fact that central banks need to get on top of the assessment at least. No, I think this is not really something that has been put into question very much. What is the impact on financial stability and on monetary policy? But let me get to another question, because beyond the analysis, there's of course the idea or the discussion about whether central banks should be more proactive. So should they, for example, tailor their assets, well, previously the purchases, now the sales of the assets in a way that fosters climate change? That deals with that. So is that something that is relevant in your central banks? Is it something that you take into account?
Well, the Czech Central Bank has never been purchasing any kind of assets. We didn't have those kind of non-conventional monetary policy. We have had our FX floor for a couple of years, so we are in a different position, and there is of course some possibility incorporated in the new central bank law adopted, I think, in 2020 or 2021. However, this mandate for purchasing asset is tied just to monetary policy, as a monetary policy tool in case of necessity of further losing monetary policy. I think we are far from the situation that we will be in need to lose monetary policy in some foreseeable future. The opposite is true.
Hungary is a different case, no? You did purchase assets, no?
Yes, MNB had asset purchases programs, but now we don't have. We must find solutions which in line with monetary tightening in this time, and I think that this is the time for methodology developments and policy settings, so which are neutral for monetary policy. For instance, last year the supervisory strategy of MNB was updated, and environmental risk or environmental sustainability became more prominent than before, and I think that this is a clear message for market participants and also for the public that we are committed to this topic. Or, for instance, another example that we continue our capacity building projects, which are utmost important because without capacity, the green transition won't be successful. So we hold university courses and other courses as well. Or another example, which is not fully capacity building, but partially, that in April we started our new application. This is the so-called Green Product Finder, which is a web application. It contains a lot of data regarding green investment products, so which are in line with Article 8 and 9 of SFDR. Now it covers mutual funds, unit-linked asset funds, and pension funds, and people can compare the features of different products and find relevant information about these products. So we hope that this application will support the increase of green investment products.
Okay, let me maybe go to a related question to this. I mean, during the time of asset purchases, okay, not in the Czech Republic, but in Hungary and certainly in the euro area, because this was a big opportunity for central banks to, twist their purchases in a way that would also be beneficial for climate, which was used, I think, to some extent. Now, of course, that is not the issue now. So it's more about shedding the assets now, where you can also influence. But what is, of course, still there is the say the more prudential measures, right? So when it comes to microprudential or also macroprudential policies, what's your view on that? How do you see that? Is this something that should be taken into account when setting these standards? Maybe let's start from the back. Norbert, you start first, because I think you're the only central bank who has also done some green macro-pro measure. No?
Yeah, we have taken some micro and macroprudential measures. For instance, in April, started the so-called green consumer-friendly loans project, which is a kind of macroprudential actions. Or another example that is from this year, we started to check the compliance with our green recommendation in on-site inspections. So I I guess that this can be a good incentives for banks to do more efforts on this topic. Yeah, maybe this can these steps can be possible.
Okay. Eva?
In the Czech Republic, in our central bank, I think that these issues are strictly linked to discussions that we know are now led in European Commission, also European Parliament, and mostly we have contacts with the EBA, European Banking Authority, right. And of course this will be a guideline for our regulation and our supervision, but I don't see most probably no gold plating in this respect. I think that we will comply to what is agreed. I think that we are quite close to some milestones that will be published, some new decisions, some new terms which will have to comply, and I think we will comply.
What's your view, taking into account also financial stability risks that may be associated with it?
I had my one chance to present to the Financial Stability Board with Mark Carney back in 2015. I always worry about whether I blew my chance at the time. But the point I was making was to do the way in which financial regulatory oversight of debt and equity markets is really important. In Carbon Tracker's first research we published in 2011, we looked at the remaining carbon budget to below 2 degrees. Today it's around 300 gigatons of CO2. We currently emit around 40 gigatons a year. If you just take the reserves of the listed companies, your Chevrons, your Glencores, Exxons, and so on, they own around 700 gigatons of CO2 in their reserves. In the last 10 years, if you can believe this, there's been 2,500 coal, oil, and gas IPOs globally. The biggest IPO in the UK last year happened in the middle of the COP, was an oil and gas company, the 5th biggest in Europe. They've raised probably around $1 trillion in equity, probably a multiple of that in debt. And today, 10 years on, there's around 1,060 gigatons of CO2 in the reserves of publicly traded fossil fuel companies. It's another way of saying that with all this regulatory oversight and interest in climate, the capital markets have become more carbon intense, not less. So something's not working. And it's to do with the central banks and the Financial Stability Board's relationship with IOSCO and the World Federation of Exchanges. And I think if there is such a thing as a culprit, I'm not sure that there is, but if there is, we've got to get IOSCO on board with the Financial Stability Board and the central banks, looking at what kind of capital markets do we want. Making them more fossil fuel intensive is idiocy. The year before last, there was an IPO of a coal company that happened in the middle of the COP, 6 times oversubscribed. The capital markets are going very short-term signals. We're not giving them the long-term signals. I have some thoughts about how we deal with that, but probably not for today. But this is where we need to take the central bank conversation, is what does authentic, rigorous oversight of debt and equity markets actually look like, and how do we create a financial system for the next century? And I'm not sure we're anywhere close to it, I'm afraid.
I mean, again, I think here in the region, it's more about banking regulation for relatively standardized assets, right? So
that's true, and that's true. I mean, the equity market problem is not a Central European problem. It's a North American, it's a UK, Absolutely. It's some of the, it's a German and French, and obviously in an Asia problem as well. But so you've I can't say you've got off lightly. It's just that your exposure to the problem isn't so dramatic as other financial centres. But it does mean that probably how you develop your equity markets actually is a chance to get it right. And something that you should all look at if you've not done is something called the Sustainable Stock Exchanges Initiative, which is an initiative of UNESCO of all people. Is that right? I think that it is. Why it's there, I don't know, but it's inside the UN system, the sustainable stock exchanges, about actually how do we get, and many, many local exchanges are part of this, how do we get markets aligned with net zero?
Okay, so the last question is also interesting. So if I think the CB, a central bank, is doing too little, too much, the wrong things to fix climate change, what can I, as a citizen, do to effect change? And I think that's an interesting one because it goes down to the heart of central banking in a way, right? I mean, the central banks have been entrusted with a certain mandate, and they're accountable, of course, but they are largely taken out of the sort of, parliamentary control in a way. So, and for monetary policy, that's clear. No? It's based on research and evidence, and this is fine. But as I said at the beginning, I think for other tasks, this is a bit of an issue. So let me. I think we're coming towards the end of this, and I'd like to just take that last question again and ask you in turn. So what is your take on it for your central banks and for you, Mark, about central banks in general? Are they doing too little, too much? Do they doing the right thing? Of course, you would assume they do the right thing. And how do you see yourself on this sort of Schnabel and Powell scale that I mentioned at the beginning? Are you more on the side of Ms. Schnabel or more on the side of Mr. Powell in that debate? Eva, do you want to start?
Yes, sure. I feel much closer to Jerome Powell, of course.
To Jerome Powell.
Yeah. I think that if the European Central Bank had been taking more seriously the inflationary prices, the inflationary pressures, it wouldn't have been necessary for today to be in such an inflationary mess. So I think that the main mandate should be given priority, and if we have this first and main homework finished, I think we can go farther to be helpful for the economy, the society, etc. For instance, we are very active in financial literacy, by the way, for many years.
And yes, too.
Yeah, we are. But still, I think that the most urgent and pressing issue today is the inflation.
But just to understand you correctly, so is your argument then to say that maybe so the attention was not fully on the main mandate? Is that what you are saying on the ECB side?
I think that the statements of the new leadership were very much oriented to the green transition, etc., and were saying about that they will closely watch the inflationary pressures, and I think that the tightening of monetary policy came too late.
Okay,
that's my.
Yeah. Robert.
Primary mandate is primary, so I think that monetary cycle and inflation situation defines the framework. Yeah, so this is the primary mandate of MMB as well.
If you want to deal with the inflationary problem, accelerate the energy transition. And by dealing with the energy transition, accelerating it, you'll solve the climate crisis. So I'm in favor of intervention. I just want to make a remark about, I don't know how many central bank historians there are in the room. Now, if you know about the history of the Bank of England, there was a competition for two banks. Mm-hmm. The central bank, the Bank of England was going to be a mercantile bank, but there was a competitor. And it was a land bank, because the main form of assets in the 17th century was agricultural assets, land. And if we tie back to this question about nature-based solutions and biodiversity, there is an argument that we should actually create a stock of natural capital, do baselines, which is kind of what you're doing in Hungary, a stock take of your natural capital. And actually, we lend against the value of natural capital. I want to go back 250, 300 years and have the re-argument again about whether UK should have had a land bank, a bank based against natural capital, or whether we should have had a mercantile bank. Well, we know history showed that the Bank of England, as we know it today, was a mercantile bank to fund and support manufacture and trade. Actually, if we look at the climate crisis and the loss of biodiversity and so on, I think there is an argument to go back to a different kind of central bank. A little bit philosophical, but we're allowed to do this. We're at a conference. But I'll leave that for him to think about.
So let me just, I mean, I'm not going to try and wrap this all up, but I would say, first of all, this was a really interesting discussion. And I think, if I understood you correctly, I think we all agree on the fact that certainly the central banks need to fully understand what is the impact of climate change on both on prices, but also, of course, on financial stability. And I think there is still a lot of work to do. I think what I found also interesting is that none of you was worried about more active intervention like you're doing, for example, for this green macroprudential policy. That this would be covered under the mandate. So maybe we don't need a new mandate, but you think that these general clauses on supporting general economic policies is probably enough to do that. But I don't think we have any convergence on the Schnabel and Powell scale. So on spectrum, I think there are still some differences here. And I think this discussion is likely to continue for quite some time. So thank you very much, and yeah, I would like to ask you to join me in congratulating the panelists and thanking them.
And Rainer, thank you so much for the great moderation as well, and thank you, Mark, Eva, and Norbert as well for joining the discussion. And so this discussion wraps up this day, second day of the summit, focused on sustainability in banking. So I do hope that you agree with me and that we actually managed to cover all the different aspects of banking sector and sustainability, and what sustainability means in practice for bankers, not only commercial banks, retail banks, but also central banks. Now, I thank the speakers from today, the audience, all of you, also for asking really good questions, people online. And maybe just one last message. We'll be actually going for some drinks now to the Augustin Hotel, which is also in Malá Strana part of Prague. So we are all welcome. So we'll be actually walking from here in a couple of minutes. So you can join us and we can all have some more drinks and a little bit of networking. So you're all invited. And that's everything for us for the second day. And tomorrow we have a day focused on energy. So again, we need more energy even for that day. And we are expecting some really interesting discussions as well. So thank you so much.